Good morning, everyone. This is really, we've got the lights at us, so it's like you're all silhouettes here. Yeah. Excited to be here. Thank you all for joining us, and welcome to the, what is this, the fourth year that we're doing BAS now? Yes. Our fourth BAS at SBC, I think our eighth big BAS, and maybe 10th or 11th overall with some of the little ones. This is a Blockchain Application Stanford Summit, and we called it the Blockchain Application Stanford Summit. It started off as a side event to the Science of Blockchain conference that Dan has been running for over a decade at this point. And we absolutely loved kind of the research focus that SBC has, but our thing was, okay, well, where are the applications for all of this research and for the latest innovation across cryptography, blockchain, consensus, and the like? Now, what's been interesting is up until maybe last year, definitely this year, there haven't been that many like actual applications live. There have been a lot of like theoretical applications in companies that were trying to build this, but I think we can definitively say that blockchain is really underpinning the entire finance industry, and there are a lot of applications. So the lineup that we have today reflects that, and that's really exciting. A little bit about us, who we are, and then would love to have Dan say a few words. I'm Gil, this is Steven and Kuhn. We run the Stanford Blockchain Accelerator, which is an accelerator put on in coordination with the Crypto and Blockchain Alumni of Stanford. It's an alumni blockchain group, and the Stanford Blockchain Club, basically incubating and supporting founders coming out of the Stanford ecosystem. We co-teach a course on blockchain entrepreneurship every winter, and we run this conference really to try and build ecosystem for founders. And we also happen to run a fund called Blockchain Builders, which kind of helps support a lot of the ecosystem here. But let me pass the mic over to Dan, and you just had SBC. Yes. How was it? We'd love for you to share a few words.
Okay, yeah, welcome everyone. It's wonderful to see the energy in the room and to see everyone here. Maybe just a few words. I'm Dan Bonnet. I'm a professor of computer science here at the university. I've been working on blockchain, kind of focusing on blockchains now for a very, very long time. Everybody keeps saying we're in a crypto winter. I can tell you I've been through these cycles many, many times before. Crypto always comes down, goes down, comes back up, goes down, comes back up. It's all good. So I'm waiting for the next cycle to happen. So I'm hopefully BAS will help accelerate that. Yeah, so it's wonderful to see all of you here, and yeah, looking forward to a fantastic day.
Awesome. Thanks so much, Dan. And lastly, I just want to give a quick shout out to our sponsors here, without which we couldn't have made this happen. That's Blockchain Builders, us, haha. But also Halliday, 1inch, TRON DAO, Zero G, American Fortress, Cambrian, Chain Opera, ICME, Prismax, Cap Lab, Psi, True North, Vishwa, Mantle, and Pax Markets. And we've got a great day here. Excited for you guys to hear the panels, and excited for the panels myself.
Let's go.
Oh, I'm sure he can go back. We walked off. Sorry. Gotcha.
And I get to introduce myself yet once again. Hi, so for our first session, we've got Haseeb Qureshi, managing partner of Dragonfly, and Avichal Garg, managing partner of Electric Capital, and myself, and we're going to talk about, is blockchain boring?
20 minutes on the clock here.
So for the last decade, our sector has really been focused on like building infrastructure to make blockchain viable. It seems like in many ways it's a success, right? We've got, I think just in the last 6 months, we're up to $425 billion in tokenized equity and real-world assets. Prediction markets have grown 300% to 47 billion in volume. Tokenized real-world asset transfers are at 20 billion. We're at 1.8 trillion in stablecoin transaction volumes. But have all the technical people left, right? Is blockchain a victim of its own success, and now it's not actually a sector anymore, now it's just technology? Curious what your thoughts are here. What is crypto good at? What is crypto bad at? Is crypto or blockchain over, and is it now just a technology?
So my perspective is that I think every technology goes through a period of intense generative change. A lot of people know of what's called the heroic period in physics, which was like basically from the 30s to like the 60s, when almost all of the important ideas in modern physics were discovered. And it was largely discovered by individuals. It was discovered by, one imagines Einstein sitting in a patent office, kind of scribbling on a piece of paper, figuring things out. And crypto from 2016 to about 2021, I think that was crypto's heroic period. It was when almost all of the important ideas were figured out. It was when we came up with the ideas for layer 2s, we came up with the ideas for fraud proofs, we came up with the ideas for MEV, like the super high performance blockchains, these new consensus mechanisms, almost everything that led to modern blockchains, even prediction markets and decentralized oracles, all that stuff was figured out in that period. And after that period, most of the rest is implementation. And implementation is naturally more straightforward. It's kind of this kind of grinding process of just building things, figuring out the form factors, listening to customer feedback, putting things out into the world, and making sure that they work and that they work well. Modern physics papers that actually discover important results have like 200 co-authors and cost tens or hundreds of millions of dollars. That's kind of where crypto has gone. I think that's just a kind of stark reality of how technologies evolve. AI will go through something like that too, where we're kind of still doing transformers and we're just scaling them up, and it's been MOE for years now. We may find something similar with AI before too long, but every technology goes through that period, and I think crypto has gone through that, and that's part of what you're noticing.
Well, just to kind of touch point on that. So there's the implementation side, which is like that's the engineering, figuring out the engineering solutions, which still requires technical people and still requires innovation. And then there's just the adoption, which kind of is even further out of the field there of the innovation cycle.
Yeah, absolutely.
For those that don't know, Haseeb's a good friend of mine, and I just disagree with him on everything. So I don't think that's quite right. I think it's more that it's these things ebb and flow, and so I think of like in technology, what you get is you sort of have these like infrastructure breakthroughs, and then people figure out what to do with them and they apply them, and then once you get them into market, you get them in the hands of people, all of a sudden the market grows, and there are all these people that are kind of hacking the thing to do the thing that they need to do, and then they're like, this is busted in all sorts of ways, which opens up like a new generation of breakthroughs for the infrastructure, which then unlocks a set of use cases. So it's sort of this, I think, like cycle that you get into, and I think we are in this period right now of, okay, we know a lot of the basic primitives, and we need to take them to market, and we need to get Wall Street on chain and settlement, yada yada. But I can almost guarantee that at some point in the next 2 or 3 years, as all these folks come on chain, as Apollo and Blackstone and ICE and Nasdaq and CME and Robinhood, everybody's on. All of a sudden, we're going to realize it's busted in all sorts of ways. And you're going to say, actually, we got to fix all these problems over here. Like, we got to be post-quantum. We have to have wallets that work in certain ways. Like, the way that we have to do KYC is busted. It's just, there's all these things that are broken, and then you go back here to a bunch of low-hanging fruit, and then you can go after the low-hanging fruit. And I think these things just oscillate. And so I think the challenge for founders is understanding which part of that cycle you're in. Because if you're building infrastructure, but we haven't figured out who all the adopters are, then you don't really know the problems that you need to solve yet. Right, and if you're sort of building to try to reach users, but you don't know whether the infrastructure can support those users, then you're just sort of building for nobody. So this is kind of what happened with like trying to build games on top of this stuff like 4 or 5 years ago. Right, it's just like that's not where the market was, that's not where the users were. It was just not really going to happen. So I just think we're in this phase right now. We're going to take everything to market, and I bet you in about 2 years we'll sit up and say, wow, like everything is broken, and we need some new infra, and we'll swing back.
Okay, so like if you take the internet for example,
yeah,
right? That was clearly true for the internet. Is that the internet in the year 2000, bandwidth was super low. Like you can't really do video streaming. Like there's just a lot of things that the modern internet demands that the internet at that time couldn't do.
Pets.com didn't work in the end.
Totally. But also like streaming and real-time gaming and all that stuff. None of that stuff could have worked in the early 2000s. But the core ideas of the internet were basically figured out. Yeah. Right. And like scaling it up, making it faster, stronger, cheaper, more cables, more bandwidth, more everything. HTTP 2 is not that different from HTTP 1. Although there are better ideas and there's improvements, most of them are marginal as opposed to real phase transitions. I think that's where we are with blockchain. Now, I agree with you about post-quantum. Post-quantum may be, for Bitcoin and Ethereum, post-quantum is probably going to be pretty straightforward. For something like a Solana, or for like a super high throughput blockchain, post-quantum may be a total rewrite, in that so many of the assumptions in high performance blockchains get broken when the bandwidth requirements increase substantially. and the amount of validators that can aggregate signatures actually has to materially decrease. We may have very different architectures for super high performance blockchains, pre-quantum versus post-quantum. It's kind of too early to say, and with the recent Anthropic paper busting some of the post-quantum signature schemes, like we may have a very different spread of post-quantum algorithms available to us 5 years in the future. And so the answer is that for that stuff, I agree, there may be a paradigm shift there. But beyond that, I think we kind of know what people are going to use blockchains for.
Well, a follow-up question to that. So I think the internet's a great example where people thought of what the internet could do in the early, up until 2000 or the 2000s.
I actually disagree with that too.
Okay, lay it on us.
Well, so, by the way, what's fun about this is like you don't actually know what I believe, so it's just fun to disagree with Haseeb. So, okay, here's what I would assert. I think a lot of the ideas from the 90s we kind of figured out. So we're like, okay, there's going to be news on the internet, there's going to be education on here, we're going to do streaming video. But I would posit that some of the most interesting stuff that happened from the internet was very surprising. If you went into an elementary school, pick a year, in like 1998, right before the internet imploded, there's probably a poster on the wall that said, hey, please don't do these things. Don't talk to strangers, don't go to a stranger's house, don't get in a stranger's car, don't take candy from strangers, right? Like this is like what you would tell a 6-year-old or
Stranger
a 10-year-old.
danger.
Right, and literally the biggest businesses on the internet are like Facebook and Uber and Airbnb. Like literally all of the things you were not supposed to do are actually the biggest things on the internet. And it was like kind of surprising that those things actually became, so there's this like second wave once you hit critical mass where actually the things that the internet was natively good at all of a sudden started to emerge.
Well, the design space opens up as well, even
Correct.
just because of APIs that are available for all these things that you couldn't even consider doing.
Right.
And I guess the question then is for crypto as well, once there's broad adoption across the finance industry, all assets are tokenized, you have liquidity of everything with everything, like what's the design space there?
Exactly, right.
Well,
and then you throw agents into the mix too.
Okay, yeah, fine. So agents, I agree. Maybe
Gil
there's
doesn't even have to
something
ask
there.
us questions.
Maybe there's something there, but like, look, okay, you have an API now. Airbnb now has an API. Uber has an API.
Yeah.
Like the content that's riding over the internet did not need to make the internet itself change, right? Doing, booking a ride versus booking a house versus booking a piece of candy on Instacart is no different than any other API call. The internet didn't need to change in response to those use cases. In the same way, does the blockchain need to change if Blackstone comes on chain? No. Like an NFT of a house is no different from an NFT of a monkey. And the reality is like this is just the metadata that's riding on the underlying rails. So what we're seeing is that the core ideas of the blockchain are actually correct for when Blackstone comes on chain, for when Robinhood comes on chain. What we're finding is that the stuff that we built is sufficiently broad and general that these are the right ideas that they're jumping onto. Now the scale, I agree. If AI agents come on chain, and the same thing like we're seeing with Cloudflare. Like Cloudflare is getting to the point where they're just like, we now have more agents hitting websites than humans. And the idea in the past was that websites should be too cheap to meter. It's basically free to open a website, so I don't need to charge you anything. Well, when agents are downloading, tens of thousands, hundreds of thousands, or even millions of websites all the time, then something that was previously too cheap to meter, it's like somebody shows up to your restaurant or somebody shows up to your mall, and instead of like drinking a little bit from your water fountain, they bring like a hose and are pulling water from your water fountain outside. Okay, the economics need to change now. The same thing might happen with the internet, but it doesn't need to happen with blockchains, because blockchains have always been every resource is metered, which actually works with AI agents.
Right, so the innovation is not at the blockchain layer, it's at a higher level, and is that actually like the blockchain sector, or is that really just like mobility has been redefined now because of all that? So there's innovation, it's just not on the infra layer.
Exactly.
Well, I guess it's a definitional thing. It may not be at the protocol layer, like it may be that ultimately you settle on ETH, but I think there's probably still substantial innovation to do on top of that. So, yeah, okay, so you didn't change ACP, you got SSL, these are like incremental improvements on top of the base protocol, but there's a lot of work to make databases performant, right? Or to make like programming languages work at scale, or to do security and OPSEC on top of that. Like the infrastructure, it depends on how you define blockchain, right? It's like if you're defining it as the full sector of everything that's built on top of the protocols, I think there's a lot to do. If you're saying like, are we gonna have substantially new fundamental protocols that emerge beyond the 7 to 10 right now that have a shot? Probably not.
Okay, this is great. You just teed up my next question.
Sounds like you agree with me.
Wait, so who wins this adoption cycle? Is it like the big money, your Robinhoods, your Arc, your Tempo? Is it the chains of those that are from finance and have distribution, Or is it the kind of open permissionless Ethereum layer 2s, your Solanas, your Arbitrums, or layer 1s, layer 2s, your monads and the like?
It's a little too early to say. What's very clear is that a lot of these institutions that are coming on chain, they are kind of two minds. One thing that we are seeing is that a lot of them are choosing Ethereum or Solana or some of these big neutral chains because they want to get distribution, they want to get their assets out there, they want to get them in the hands of users. Then on the other hand, you've got the Robinhoods of the world, and you see this increasingly commonly, DTCC and so on. They're creating these sort of walled gardens. They have either partial control or some control over what's going on within their own ecosystem. Nobody seems to know yet what the right answer is. And on some level, they will kind of see what works and what doesn't when deciding, okay, what is the next marginal person who enters a space? What are they going to choose in terms of their architecture? People are, institutions tend to be very lemmings-y. They follow each other, and they kind of do whatever they perceive it to be cool or working or whatnot. I suspect in the long run, the answer is that blockchain is a distribution channel for you. And how you get distribution, I think in the long run, they're not really going to care. What they're going to care about is that I get access to more users, I get access to more assets, I get access to more distribution, and however that happens is what I'm going to do.
What if you actually have your own distribution, though, right? So I guess if Stripe is doing its own chain, it's because it doesn't care about distribution of users that it's going to get from Ethereum and any of the other chains. It could just use its own.
Yeah, look, I think in the long run, I think this is a place where I'm genuinely agnostic, but right now my median view is that I think most of the people who think, I should create my own chain. And if I create my own chain, I'll get sequencer fees, and it'll be a great revenue line, and that'll be amazing. I think they're probably going to find that that's actually not really that valuable to you, and it's actually a lot more valuable to you to increase your distribution, cut out intermediaries, and for Stripe, honestly, they care about that, cutting out the card networks. They care about that a lot more than they care about getting some sequencer fees. So I think that is long-term going to be the answer for most of these people, is that I want my financial assets, if I'm an issuer, I want them in the hands of as many users as possible. Because ultimately, my core business, I'm an asset issuer, or I'm a payments network, and I'm not a sequencer fee collector.
So one way to think about this, which I've wanted to write down for years, I wrote it down in 2020 for our LPs, but imagine a graph. X-axis is, all the way on the one end is users, and if you have lots of users, then that's sort of the moat there, right? That's distribution. You work your way back, and there's some sort of middleware integrators, and then all the way on the other end, there's some infrastructure that's really, really valuable, and usually that correlates with requiring lots and lots of capex to reproduce. And you see this NVIDIA on one end, and you sort of have data center people who are sort of building data centers, and you have some middleware software on top of that. And then all the way on the other side, you have Claude, right? Claude Code. And it has all the users, and they sort of do a bunch of hard work. But it's like OpenAI and Anthropic have all the users. If you put a y-axis on it and you say, who captures all the value, right? You actually get a U-shape, which is you either need to own a bunch of distribution and own those users, and that's very, very hard to replicate. And over time, there's network effects and data effects. Or you have to have something that's technically so difficult to reproduce that it would cost many, many, many billions of dollars. And this is NVIDIA, ASML, whatever, right? And that pattern repeats in every industry. And so I think in our industry, that is all the way on the far right, it's Bitcoin and ETH and maybe some of these other L1s, which are really getting an L1 off the ground and getting it to be credibly neutral and high scale and throughput and have all these validators and yada yada. Solana, right? It's going to cost billions of dollars now to really compete. And so you sort of are moving up that side of the curve, and then on the other end would be things like Coinbase, Robinhood, Binance, they own all the users. And if you're kind of in the middle, you get squeezed. And so the question is how do you move up towards one or the other? For a startup, I think you could certainly start somewhere in the middle, Uniswap could start somewhere in the middle, but what they kind of have to do is move up and to the left, or they got to figure out how to make their own chain. They got to go down in the stack and move off to the right. And so I think you'll actually have two different points of control, and both capture a lot of value, but they're both highly competitive now. It's almost like the y-axis stretched up. All of a sudden, the amount of value that you can create is really, really, really high, and so all of a sudden, people who have lots of distribution in adjacent markets want to come in and capture all that value. Whereas 5 years ago, the Y values were not that high, and so you could be Uniswap, and you didn't really have any competition.
Yeah, you almost have to vertically integrate and own the users to be able to actually succeed.
You have to own the users, or you have to own some critical piece of infrastructure that your moat is that it would cost $5 billion for somebody else to come and replicate you.
All right. Next question. I'm going to switch back to the AI side of things. So, do you guys believe that there's hope for blockchain and AI? And Avichal, I want to start with you here, so Haseeb can disagree. So you have a new thesis around kind of user-owned technologies.
Oh, yes.
And does that actually need or necessitate blockchain specifically for AI, right? So there are a whole bunch of, we're using TEs, which aren't blockchains, which kind of provide the same ethos and support of confidentiality and verifiability. You could use zero-knowledge proofs to validate things. We could use staking without blockchains to incentivize people. So do you believe that blockchains are actually necessary and supportive of AI, or is it more the approaches, technologies, and kind of things we've learned that are really going to take root?
A little both. I mean, I think the blockchains can help a lot of stuff. I mean, I think the idea of a shared public ledger that has public APIs and anybody can jump in a network, I think that's a useful thing to exist in the world, and there are lots of places. Like I see this thing about the next talk or subsequent talk is going to be about private credit. Private credit markets should run on blockchains. Like that's just a thing. There are obvious reasons for that. But I think a lot of these adjacent technologies, cryptography, zero-knowledge proofs, trusted execution environments, even we were talking about GPUs, like NVIDIA had this tough period where actually, they had to recognize the role of crypto mining on their earnings calls because there was so much demand coming, right? And so I think these things spill over, and also, a lot of the data center folks are actually, they used to be Bitcoin miners, and you just pivot over to AI because the expertise that you have carries over. So I think some of these technologies and some of these expertise carry over very, very naturally to these adjacencies. The quantum readiness, the cybersecurity, crypto people have been the best in the world at OPSEC because you're going to lose all your money. And I think the AI people are now figuring that out. Formal verification, another great example, pioneered, in other industries like aeronautics and avionics and things like that. Crypto people picked it up years ago and said, hey, we need to formally verify all these smart contracts. Turns out, if all of your code is AI generated, formally verifying that your code is not doing something nefarious, super important, right, for mission critical things. So I think you're just seeing this spillover of all these technologies that we used to sort of bundle together into blockchain. They're sort of being unbundled. And now you have a dozen or so technologies that are really, really useful in other fields.
Okay, so to summarize, a lot of it's the technologies and approaches. There is some use for public ledgers for AI.
Absolutely.
Yeah. Haseeb?
I mean, I don't think I have much to add to that, honestly. Crypto is going to be useful to AIs for the same reason that it's useful to humans.
Yeah.
Crypto's good at what it does. AIs want to do some of those things. I think in many ways, just like how crypto shines most in an international, cross-border, kind of less corporeal, terrestrial environment, it's where a lot of AIs are going to exist. Not all AIs are going to be American AIs. Obviously, everybody in the world is going to get access to this technology. And in the same way that crypto is really designed for a digital-first, 24/7 interconnected world that is nevertheless going to want to be exchanging value and engaging in transactions and finance, that's going to be happening with AIs just as much as it does with humans.
One thing to bring it back to the early opening stuff that we were talking about is I think analogies are always really leaky, so you shouldn't necessarily use them, but they can be kind of illustrative or creative or open up thinking. I think there's an argument that the internet really took off with mobile because you could put the thing in everybody's, you basically unlocked all of these users that didn't have PCs, right, internationally, for example. And I think it may be, and so in some sense, the real users of the internet only became users of the internet because we got mobile phones. And I think you might argue that the real users of blockchains and cryptography and all these things are actually agents. And we actually have now unlocked, this is sort of like the mobile revolution for the internet, where actually what it does is it massively inflects the internet. And I think this massively inflects blockchains and cryptography and quantum and all this stuff because all of a sudden, formal verification, because all of a sudden you have a new set of users that didn't exist before that are actually 10x bigger than the old set of users, and now all of a sudden all the interesting stuff can happen.
Right, so we need to bide our time until first all of the finance industry is on chain, and then we'll have more interesting things popping up in our sector, and then we have to bide our time a little bit more until we actually have agents that are doing things, and those are proliferating, and then they'll start using this infrastructure, and that'll create this kind of next wave.
I think it's happening now. I think it's basically over the next 12 to 24 months, and so then the second order thinking of what happens in a world where most financial transactions are being run through agents, or most data is being created by agents, or most compute is being used by agents. We're I think 12 to 24 months from that world in most of these sectors. So it's not 5 years. I think it's over the next 12 to 24 months.
Awesome, exciting. So blockchain won't be boring soon.
That's a good way to put it.
It's not boring now. It's not boring now.
Thank you guys. I think that's
we're at time. All right.
Thanks for having us, everyone.
All right, everyone, good morning. How was the VC panel? Insightful? Entertaining? I thought so. Cool. Well, welcome, everyone. My name is Stephen Willinger. I am one of the organizers of this event. Quick intro on myself. In addition to organizing BAS, thanks for coming, I also help run the Stanford Blockchain Accelerator, started the Cryptography and Blockchain Alumni of Stanford Alumni Club, and generally am, like my other partners hosting this event, just very involved in helping build a builder community around blockchain, fintech, and AI. And today we have an amazing panel. Stablecoins definitely have product market fit, right? Which is pretty exciting in the blockchain space. And the amount of brain power on this panel is frankly intimidating as I've prepared. I'll do some quick intros. First, all the way to the right, we have Gordon Liao, the chief economist and head of research at Circle. He has a PhD in economics from Harvard, boo, but we'll take him. Before Circle, he was at the Federal Reserve Board, advising on short-term funding markets, and did fixed income relative value work at the Harvard Endowment. At Circle, he now shapes economic research behind USDC, including Circle's token capital adequacy framework, and how fully reserved stablecoins should be thought of relative to bank money, which is going to be a big topic for this panel. We also have Nemil Dalal, a former coworker of mine at Coinbase. He spent 7 years there leading developer products and stablecoins. He helped grow USDC from nothing into a business worth well over $1 billion on the Coinbase side, and built Coinbase developer platform. Also, right before he left, he was most famous for helping bring agentic payments via the 402 protocol into the world. Now at YC, he's focused on crypto founders and fintech founders, including the shift towards startups that quietly use crypto rails while building great businesses. And then finally, we have Professor Darrell Duffie from the GSB, which is where I'm an alum, although I unfortunately didn't make it to your classes, my miss. He was the past president of the American Finance Association, chaired the Financial Stability Board's group on reference rate reform, and his research covers financial market structure, financial stability, and credit risk. In recent years, he's focused specifically on fast payment systems, narrow banking, and stablecoins. Go figure. So with that, we'll jump right in. We'll go down the line, starting with you, Professor Duffie. We have some time here. I want to know, what's most interesting to you today in stablecoins? I think we're going to have very different perspectives across this panel, given that we span from academic to well-established industry to startups. So let's start with you on the academic side.
Thanks, Stephen. Terrific to be here. I'm going to dive right in.
Great.
So the big issue right now for central banks, I'm writing some policy research for central banks on this topic, is how to do tokenized financial markets with safe cash. The holy grail for this is to have a central bank issue tokenized deposits itself. So those would be called reserves. So then there's no question about redemption or market value, because the central bank deposit is not only worth $1, it is $1. It's the unit of account for the economy. So then there would be no issue at all about a run or a sudden stop where financial market participants in multi-trillion-dollar markets like treasury markets, foreign exchange, derivatives markets would step back from markets out of fear that the cash settlement asset is not literally worth $1. Now, no casting aspersions on USDC, but in a trillion-dollar market, or if one of you were to do $1 billion treasury trade, if I were to assure you that your cash is going to be worth 0.999 per dollar, you would not touch that. You would lose your job by taking that risk, because 0.001 times $1 billion is probably too much risk. So financial market participants are waiting for the cash settlement asset, which is the unit of account. Central banks are not doing that yet. Switzerland is the only one. The next best thing is coming along would be a specialized utility bank that deposits all of its assets in the central bank at the Fed and then issues tokenized deposits itself. This is going to be, I hope I'm not disappointing DeFi enthusiasts, this is going to be on a highly regulated, permissioned, or maybe even private programmable ledger. That's my prediction. I could go on, but I don't want to wear out your audience on this topic.
No, all good, and we'll circle back, but I want to make sure everyone gets introduced. But I have two quick questions and sort of what we discussed before, right? There's different markets for currencies and the different use cases for stable coins, and they don't all have to be for interbank settlement and repo, right? And then also, you brought up the soundness of money. Like 99 cents is not a dollar. That's not sound money. But I guess one question for you, and I actually should have sprung this on you earlier, was had a byline in a paper where money in our commercial banking system also might not be that sound. Like there's credit default swaps or specifically pricing the risk of a dollar not being a dollar at a commercial bank. And so I guess a quick question to you, is it fair to say, okay, the redemption at 99 cents on the dollar means that it's not sound, when really our commercial banking system is also not that sound and has a mechanism to specifically compensate for that?
Yeah, so commercial banks all the time are handling hundreds of millions of dollars transactions, and we just take those deposits as though worth a dollar. But you're absolutely right, they need not be worth a dollar, and that's why all the major regulators around the world have agreed that when it comes to multi-trillion-dollar markets, commercial bank deposits are not an acceptable form of cash settlement. It's called CPMI, principle number 9. It's well grounded in this concern that one year out of 100 or one day out of 100 years, there could be a concern. And you don't want to stop the world's financial markets out of that concern. So when it comes to these enormous financial markets, it's agreed that central bank deposits, which are the norm today, should continue to be the norm even after we go to an on-chain world.
Okay, awesome. We'll make sure we get to the other guests, and we'll circle back on this. So Gordon, I'm going to go to you, right? We're kind of going from, how do we get all the money into stable coins, which maybe we can, maybe we can't, to, okay, Circle's a large company with a big, a large amount of stable coins minted, right? And so I'm curious what you're thinking about, kind of at the margin of expansion for stable coins into the largest parts of the market you're going after. And then placeholder Nemil, working at Y Combinator, we're going to talk at the tip of the innovation spear when we get to you.
I very much agree with Darrell on the importance of, some people call it singleness of money, right? Having dollar for dollar redemption, which is what USDC have provided. I think there's a distinct difference between secondary market prices and primary market redemption, and thankfully USDC have always redeemed one for one throughout its history. And I think as soon as you don't redeem one for one, even if it's 0.9999, then people lose confidence and lose faith in it. Of course, that doesn't mean that there isn't a secondary market that's trading at various prices due to liquidity effects. But those are kind of reflective of what's going on in the secondary exchanges that's outside of control of the issuer. Now, I think the biggest opportunity is still just tokenizing money, right? If you think about M2 money, something like 90% of that is privately issued. So the central bank money is actually a very small fraction of the overall amount of money that's in circulation. Of course, there's efforts to, in some cases, to build central bank digital currency, but I think that's going to coexist whether it come online or not. The vast majority of circulating money in the world today is privately issued, and I think more and more so it will become tokenized in different forms, whether it's tokenized deposit or stablecoin. I think that's just a nomenclature almost. The biggest use case, as we see today, a lot of it is related to cross-border settlement. A lot of it is related to, store of value in certain economies outside of U.S. Not so different from the holding of physical cash outside of the U.S. So to put in things into perspective, right? It's $3 trillion, or $2 or $3 trillion of physical cash in circulation, half of which are outside of the U.S. circulating. So I think that's still a very large market to tap of just tokenizing the physical cash equivalent and putting it on-chain, onto blockchain so people would use it more effectively. I'm sure Nemil also will talk about Expo too, and I think the next frontier, especially since we're in Silicon Valley, is how do you actually utilize these instruments for AI agents, for building marketplaces that's transacting in a very high throughput, very fast speed, not just for human users, but for AI agents. And that's a focus that Circle has also been more and more taking on recently.
Awesome, thank you, Gordon. And then, so to Nemil, to you, you're at the tip of the spear. You were at Coinbase with Coinbase Developer Platform, and now at YC. I'm curious to hear from you where, maybe over the past 4 or 5 cohorts where you've been at YC, and then also the incoming cohort, like where are you seeing stablecoins being adopted by builders? So where they've found product market fit, admittedly probably early, and then also, what are the interesting ideas that fresh founders are coming in with as it relates to stablecoins?
Yeah, so first of all, I've been in crypto for 12 years. It is just amazing. I remember in the early months of stablecoins talking to professors at Stanford and debating what the future looks like. Stablecoins were zero, and they've basically grown into a several $100 billion industry. I think it's going to be a pretty massive industry from here. And those early use cases were really kind of out there. They weren't like solving necessarily day-to-day problems. They were like more degen problems or crypto trader problems. So early use cases were capital flight out of China was actually a really big one. DeFi usage was another really, really big one. And then just actually being able to trade back and forth between Bitcoin and stablecoins. I don't think Binance, for example, would have succeeded without having a stablecoin to not have to depend on banks at the time. And so it came from pretty, I would say primordial roots. And now it's really starting to take over the day-to-day lives that we're doing. And I think this is where I'll say is probably a lot of the things that we're seeing are stablecoins as some form of backend. And so like probably the biggest things that we see in crypto is number one is payouts. So you have companies like Deal and Gusto, they're payroll providers. They have to pay people around the world, but they may not have the payment systems in certain countries. They may not have the banking relationships. This makes it super, super easy to be able to pay out anywhere in the world. Number two is neobanks. So what we see is people building banks for very specific use cases. They have some point of view that there's a market that's underserved. The rails in those countries don't work effectively. And so, for example, you're in Argentina, you're in Brazil, and you want to hold maybe a more stable currency. This is one really simple way in which to do that. Another example is you're an exporter, and you want to be able to settle faster, cheaper than you're doing today. And that's like another really big use case that we see. But basically, we've seen various versions of these neobanks. Another one I think I've seen is that you have contract workers in different parts of the world. They're getting paid out by US companies, and so they get in the stablecoin. Now what do they do with it? How do they convert it to the local currency? Third we're seeing is stablecoin sandwiches. And the way this works is on both sides, it's fiat. But in the middle, there's this hop that's stablecoins. So for example, I have money. I just talked to a company that's raising a pretty large round, but they're moving money from Brazil and Colombia to Europe. And the way they do that is they take the fiat currency, they convert it to stablecoins in that country, they move it over to Europe, and then they convert it back to fiat. So no one has to be the wiser that behind the scenes is crypto. And increasingly, I think we're going to see more and more things that are like that. There's a whole wave of developer tooling. So tooling to be able to let you interact with stablecoins in a simpler way. Circle, I think, has some amazing products there. There are companies in YC like Infinia and BlindPay. Each geography, for example, like Latin America, will need their own Stripe API to be able to connect with the various rails and allow developers to be able to integrate with it. And I think the cool thing with those teams is that they're working with a lot of financial institutions. We're trying to figure out how do I integrate, how do I think about safety, risk associated with just like hacks and things like that is probably the core thing that they're working on there. And so last thing I'll say is that this is an area that's pretty new, but I'm personally really excited about agentic commerce. I don't think all of it has to run on crypto. In fact, I think a lot of it will run on credit cards. But I think there's a lot of interesting use cases, and I see Professor Bonet in the crowd. And a year ago, we talked a little bit about this idea of gating websites, for example, with idea of a payment. So what's happening today in the world is that the entire web is being crawled by AI agents. They're summarizing and giving back to you, but there's essentially no money going back to most of those content providers. Now there's huge lawsuits around this. There's tons and hundreds of millions of dollars that are now slowly starting to flow. Like the New York Times signed a deal with like Amazon to be able to provide the data that they have as they train their AI models. But one way you can think about it is that if I want to access a website, if you're creating a blog post, you're even putting your summary thoughts of this conference together, if an AI wants to read it, they might have to pay some amount of money. It might be 1 cent, it might be 10 cents, it might be $1, but they're able to access that and crawl that. And so where I really like crypto in this use case is that it's a low dollar value, which traditional systems have done really poor about. Oftentimes they're a machine, and crypto rails, because of their APIs, are amazing, amazing things for machines to be able to access. And so Cloudflare, for example, announced that they're actually turning this on. Stripe is investing a lot in their own protocol around this. And I'd say it's early days here. So I'm really intrigued by the use cases that people are coming up with. We've accepted a few teams in YC that are doing the infrastructure around this, that are trying to figure out what the use cases are, but it's still pretty early.
Awesome, exciting. Wow, that's a bigger range of businesses than I might have even predicted. Very cool. So I want to hop into the next topic, right, which is the impact of stablecoins on two like structural sort of like parts of the financial institution. One is I'm very curious, you've done some research on the impact of narrow banking, and I think of stablecoins as being like, you know, there's other ways to do narrow banking, but they seem to be the front runner, right? And I'm curious what that impact will be on our commercial banking system from risk, ability to withstand shocks, also just profitability of the banking system. This is obviously playing out as a big regulatory fight in DC right now. So I'm very curious, sort of open-ended question, to get your take on, you know, sort of what the implications are depending on how this plays out.
Fantastic. So, Stephen, the banking industry is very concerned about competition coming from non-traditional banks, and they have been lobbying regulators, especially the Fed just this week, about letting fintech firms, particularly stablecoin providers, from also getting access to the Fed's payment rails. And they've been arguing that there's risk involved. I actually think that the competition coming from the non-traditional payment service providers is a good thing for the banking system. I don't think it's going to reduce credit to the economy. It will reduce some profitability for the largest banks because
Can I answer that? Because that's a pretty important statement. I'm curious how you justify it, right? It does seem like stablecoins are, by law, they don't allow fractional reserve banking, right? And so they have and also if they can give yield to holders, it seems like it could push a large amount of dollar liquidity into like non-lendable positions. So anyway, I'm curious like how you get there.
Yeah, so the largest banks fund on wholesale financial markets, and then they lend based on the cost to them of wholesale finance. That's their marginal cost of funds. Of course, they're relying on very cheap funding from deposit markets. So you and I, everybody in this room, probably has a bank account in which you're currently earning a small fraction of 1% interest. And the banks are putting that to work at 3, 4, 5% interest. That margin will go down. They'll still rely on it to the extent that depositors are willing to go along with that. But when they're deciding to make a loan or not, they're comparing it to the potential investment in treasury securities. So I don't think it's going to harm credit creation, but it may reduce the profitability. Those banks have pretty high profit margins. Some of them may be less profitable, and the smallest banks that can't handle the fixed costs will continue to go out of business, unfortunately.
Insightful, thank you. Gordon, it looks like you have something to add.
Yeah, I can jump in also because I get asked this question all the time by banking regulators, in my seat. And I think stablecoin is a part of a broader shift from a very heavily intermediated, balance sheet driven type of intermediation between the borrowers and the lenders, depositors, to a system that's much more market based, right? Because stablecoin itself doesn't have credit provision, doesn't have maturity transformation much either. But it is an instrument that allows you to transact on tokenized markets, and there is more and more growth of tokenized credit of sorts. A lot of it are secured credits, so any form of DeFi lending is primarily secured credit, with the cash lag being the stablecoin. But now also more and more emerging of perhaps tokenizing invoicing and receipts on chain. So we're shifting towards more broadly, with or without stablecoin, to a more market-based approach. I see on here there was a slide on private credit, right? The private credit is a form of a market-based finance instead of discretionary balance sheet-driven type of finance that traditional banks resemble. But that shift is very gradual, and I think it will take many years, and I don't think banks are going to lose out anytime soon. But overall, I think more and more gradually we'll see more market-driven intermediation, and overall I think that's a good thing.
Okay, there you have it. So the next topic I want to dive into, and we'll start with you, Nemil, and you mentioned this in your preamble, but I want to go one click deeper. In the U.S., stablecoins are not that useful. Like, we already use the dollar every day and have a bunch of institutions and tools to do it. But overseas is where I, as an investor, see the fastest growth in businesses that depend on and use stablecoins. And so, Nemil, maybe going one click deeper on that particular segment, can you maybe speak to a couple examples of companies that are using it and sort of like their rationale? And I guess the question that I'm going to pan out to here, but you're welcome to address as well, is what are the implications for foreign currencies if U.S. stablecoins become so broadly adopted? And then I'll just skip ahead with all my questions and kind of let this be a free-for-all. I have noticed and investing against the growth in non-dollar stablecoins, but I still have some pretty fundamental questions in my head about how big that market can be, what will the actual use cases be, what markets will that be relevant in. So if you guys could help me underwrite my investment theses here, that would be nice.
We'll help you fill it out. So maybe number one is, the controversial thing I'd say is I think stablecoins are really powerful in the US, not just internationally. I think internationally they're massive. But I think in the US, just the idea of payments, I think most of us are still using some form of ACH. The Fed has spent years trying to roll out Fed Now, and you had this issue where a lot of banks didn't want to support it because they could hold on to the float for a longer period of time. So I think the power, at least of crypto or stablecoins in the early years of this, is about better payment system. I think over time, with a whole finance stack that's going to be built in these open financial systems, like a new version of DeFi, probably centralized in many ways, but it allows you to be able to access a lot of these financial products. I think it's essentially a financial internet that's slowly come together, and the stablecoins is just the bottom level thing. It's like America is the magical thing, but the dollar is the thing that allows a lot of that to happen. Same way as that there'll be just a lot of different use cases that will build that are available on the blockchain using stablecoins, but you need the stablecoin to be able to do it. And then to answer your question, I think that the main two things we're seeing is, I call it crypto, stablecoins is a verb or a noun. Verb means the payment itself. And so in the early years of stablecoins, I think a lot of the growth has been in payments. It's a better payment system, and international payments are notoriously longer, they're often more expensive. And so I think the examples that we've historically seen are some version of payouts or remittances. So I'm a US citizen or someone working in the US, I want to send money to India. And there's a YC startup called Aspora that makes that super easy to do. There's obviously large immigrant markets. Philippines, India are some of those large markets where people want to pay out. Other examples.
And sorry to interrupt, but are you getting the impression that some of those users are just holding on to the stable coins, or are they almost always converting immediately?
So what we see happening is that they're sending it out, and then on that side, people are holding stable coins. So example might be Argentina, where the currency that is relatively volatile, high inflation, that is a better version of holding that currency than others. Another example, I haven't seen this as much in India, but I'm curious of when that happens, because in India, gold is massive. And same reason, there's a version that's an inflation hedge. And I think that this is where maybe our other speakers can speak more, is just that obviously this is really controversial as you think about it. And this is why I think it's going to force most countries around the world to add a form of stablecoin and maybe even mandate it in their countries over time. We don't see that happening necessarily in a major way yet.
I think we do, right? Hasn't Europe mandated the crypto exchanges
right.
use a euro stablecoin?
In developing markets where I think it's particularly useful. But I think that that's absolutely an example. So I think that the things that we're seeing is some version of a payout, a money transfer, a remittance, and then what I see is some version of holding it, and I'm doing something with it. And I think historically what we've seen is the primary way people do that is they've already received it in that, and so it's an easy way to hold it because I'm getting some type of yield, which I'm connecting into some financial system. It could be DeFi, it could be some type of centralized product that's offered by a regulated institution, but I'm actually getting that on the blockchain as a way in which to use that. And so those are probably the two main ones, is movement and then some way of holding it. And I think that really what I'm actually excited to invest in more is more stable coins in those countries. And by the way, I think it's hard to talk about stable coins without talking about tokenized assets, because I actually think stable coins is a starting point what we've seen for trading other assets. And so Hyperliquid is probably one of the hottest things that happened in crypto in the last few years. And a lot of that is hey, the Iran war is happening, I want to trade oil 24/7. I can do that in that market. And by the way, when I'm out of oil I need some other financial product to hold that allows me to be able to not take some directional bet. And that's where, this is why how stablecoins first started. I think this is basically happening now, not in like the crypto version of the market, but actually tokenized, real world assets like oil.
Amazing. Professor Duffie, Gordon.
I think one of the most interesting use cases is Afghanistan. They have a stablecoin payment system there called Haseeb Pay in local currency, justifying your hunch. And the reason is that the local banking system broke down during the various wars in Afghanistan. And it wasn't so much an issue of inflation. It was an issue of there was no place to go and get paper money that was nearby and open and working. And so anyone with a mobile phone in Afghanistan today can now make and receive payments, hold the currencies on their phone, and interestingly, receive aid from international aid organizations without having it siphoned off by middlemen that are skimming a piece out of it. It goes directly into their phone. So that's a terrific application in an emerging market where there is no, efficient payment system. I totally agree with Nemil on using it as a store of value, and it's also in to some degree used for evading capital controls or making illegal payments. But there are plenty of applications in emerging markets. I think the most interesting question is in places like Europe, Canada, the United States, the United Kingdom, Japan. Will it become, in fact, day-to-day commercial or retail household payment device? I think it's too early to say.
And sorry, one more on that. Do you think it creates any risk for like non-U.S. sovereign currencies because dollar adoption has been just made so much easier? So far, as everybody knows, like 99% of stablecoins internationally are denominated in dollars. Dollar dominance is not going away, but the easier that payments become because of stablecoins, the more easy it is to avoid dollar dominance. And so I expect the digital euro not only as a CBDC, but as a stablecoin, and likewise in many other, even developed market countries, which are doing trade with nearby countries using a different currency that don't need to go through a hub foreign exchange market in dollars. Okay.
I think emerging markets have emerging market central banks have a choice to make here in whether adopting technology, which could actually level the playing field for payments, especially on not just payments, but also, as Nemil mentioned, tokenization, right? Access to global capital market, making it easier for foreign investors to invest in local sovereign corporate debt. That's a huge deal if you can get the capital inflow alongside with perhaps people who want to use the instrument for moving capital out. And that's, I think we underestimate how difficult it is sometimes to actually even just having capital to invest in these geographies. My first role out of college was working for the Harvard Endowment. I still remember it was, at one point we looked at investing in sub-Saharan Africa and sovereign debt there, and it's not the easiest to figure out even the instrument for investing. So tokenization more broadly as a technology could help in leveling the playing field and allowing capital inflow. And more than that, I think it's also, parallel exchange rate market have always existed in many of these economies. You always have in Argentina a number of different exchange rate, from the official rate to the blue rate to the black rate or whatnot. If you actually embrace the technology and embrace also the programmability and traceability aspect of it, I think these emerging market countries could actually help to manage their exchange rates better and unify their exchange rate market by working alongside with regulated infrastructure players, regulated market participants, to have a more uniform exchange rate. And that's better than the trading of pallets of cash around the world, in which it's currently how some of the countries also offer the financial service, right? It's infamous for the U.S. to fly in like an airplane full of cash to places like Afghanistan after any sort of major disruptions, and hopefully the digital rails make things much more traceable and easier to manage.
Awesome. Well, let's give a big hand of applause to our illustrious panelists. I think that was a lot of fun and really insightful. And so, yeah, thank you very much for me, and we'll hand it off to the next group.
Seats here, so anyone who wants to come and sit down, please do so. We had a slight shift. We're swapping two of the sessions. So next we're going to have Jay Park, head of research for Cap Labs, is going to speak about unbundling and improving private credit. And Jay and Cap Labs are Stanford grads, and we've known them. Jay used to be part of the accelerator back in the day. So thank you.
Mic test? Okay. Nice. Hi, my name is Jay. I'm here to talk about private credit. I'm sure you guys have been following financial news. You might have seen that there might be some problems. So here I am to discuss what private credit is, what is actually the problem, and how we're trying to add value to it through CAP. So what is private credit? In layman's terms, it's basically a private fund lending out money to a company instead of a bank. If you look at the structure of the loan is usually negotiated between the fund and the company. The lenders are usually senior secured and first lien, meaning they have the risk last. The borrowers are usually mid-sized PE-owned companies, and they borrow at a floating rate, approximately 500 bips over the risk-free rate. And the market is rapidly growing. It's at 3.5 trillion today, which has roughly doubled from 2020. 80% of the buyouts are usually through under 500 mil is usually financed this way. And what's interesting is that each loan is has a zero public price, meaning that they are marked by the managers that originate the loans, and the loans aren't traded publicly individually. So why does this exist? After 2008, banks have generally retracted from doing these kind of loans, and syndicate loans take a long time, 6 to 10 weeks. And so private credit offers higher yield, but also at a faster pace. 80% of loans of private credit are roughly private equity buyouts today. And to make this more concrete, let's run through the flow of funds of how money might move in private credit. So for example, there is a company that wants to sell at $1 billion. A PE firm might be interested in buying them out, and they want to spend 500 mil in equity, and they want to borrow the rest of 500 mil. Assuming that this company is in high demand, they would want to go to a private credit fund to borrow money fast. And in this case, the investors or LPs, money is called down to as needed, and then the rest is filled by a leverage bank through a credit line. The interesting bit here is the waterfall. So when all things go well, cash comes back in the following order: the bank, the fees, and then the investors, and finally the manager's profit. If things go bad, the PE's equity gets first loss buffer, and then the investors are protected through senior secured. In the last 2 years or so, private credit has been under some stress. First, I guess in September 2025, two funds called Tricolor and First Brands collapsed. What happened was they were pledging collateral twice, also called double pledging, and these were auto loans. But it was only discovered retroactively in bankruptcy courts, and so they were claiming to say they have 800 mil worth of collateral, which was being double pledged. After this blew up, investors got scared, and so there was a big liquidity crunch. But loans are typically multi-year loans, whereas redemptions are quarterly. And so there has been a liquidity mismatch, and some funds like Blue Owl even stopped redemptions. This led the Fed to scrutinize what's going on, and they asked banks to detail their exposure to private credit. I'm not saying that private credit itself is a broken asset class, because only 1% defaulted over the past 20 years, but there are some structural problems. Just to recap quickly on what the problem might be in numbers, the average redemption request for private credit is around 12%, whereas there's a 5% quarterly gate, so only half of the redemptions are being honored. The BDC price is 80% to NAV, meaning investors are scared and selling. But I guess going back to what are the structural problems here, I want to mention that first there is a portfolio opacity problem. The managers are pricing the loans, and so, but the managers are also the ones originating the loans, so it's hard to see how the loans are being priced. There is a liquidity mismatch because loans are longer, whereas redemptions are shorter. The collateral trust problem is usually self-reported by the borrower, meaning it's hard to see what the actual collateral is and whether it's being double pledged or not. And finally, there is a concentration of allocation, because only a select few managers of the private credit fund is deploying the capital. As scale grows in terms of money or in terms of allocation decision making, it's hard to scale with a handful of managers. Underneath all of these structural problems, I think there is a root cause of misaligned incentives, which I think permeates through the history of financial crises. Basically, it's whoever decides where the money goes is not the one who's paying for the money when things go bad. So in private credit, the sponsor or the PE firm diligences the borrower, but if things go bad, the LPs take the loss. If the manager marks the portfolio and marks it up high just to pump up the valuations, again, if things go bad, LP takes the loss. And if the borrower lies about the collateral and things blow up, LPs again take the loss. This is demonstrated in the fees by the fund managers. So they have a floor of 1.5% roughly management fee. And when things blow up, it's not their money that's going bad, rather it's the LPs. But they do have upside exposure. So if the hurdle is 6 to 7%, over 6 to 7%, they take a 15% carry. Enough about private credit. If I were to now move on to CAP, I first want to explain how CAP works. We're trying to improve private credit, first of all, by using the blockchains, because everything is verifiable and also programmable, hence instant. But more importantly, we introduced something called credit underwriting. So if you look at the flow of funds, a lender would first deposit USD into CAP. Now the USD is being available to be borrowed, but in order to borrow, the borrower must first secure an underwriter that over-collateralizes the loan. If the borrower is able to secure an underwriter, then they're able to borrow from CAP. If things go bad, if the borrower defaults, if the collateral value falls, then the underwriter is liquidated. So the underwriter is basically playing the PE firm's role of being sponsor and first loss equity. The interesting bit about the architecture of CAP is that the loans are each all siloed, and so each underwriter is underwriting a specific borrower with their own collateral. This allows the architecture to scale because more underwriters can come in to underwrite different types of loans, each with their own specialty. So assume a borrower can make 13% yield. How does the yield get split? First of all, the dollar guys would get paid roughly 6%. This is a floating rate, but roughly 6%. The underwriters are getting paid 2% for underwriting the borrower, and the rest of 5% gets allocated back to the borrower. So if you look at how the private credit yield is being split here, we're unbundling the liquidity provisioning for the lenders, and also the credit provisioning by the underwriters. And so a natural question that people ask is, why would they underwrite in the first place? Well, they are underwriting with alternative assets, and alternative assets meaning BTC, ETH, or tokenized RWAs, which have a low cost of capital. On the other hand, the USD borrowers want more exposure to yield, and they want more money to run their strategies. And so CAP is basically a marketplace between these two participants. The collateral holders underwrite the borrowers to get exposure to dollar strategies. And this allows them to put the idle, unproductive assets to work, earning some yield on top of it. So what does CAP fix? Going back to the structural problems of private credit. Well, first of all, the collateral is now on-chain, it's verifiable, so people can know that it's not being double-pledged. The decider of capital is not also the loss bearer, so the underwriter, by putting up their collateral, is the first loss. And if things go bad, liquidations are instant using the blockchain, instead of having to wait for lawsuits and whatever. And the quarterly self-marks are also all verifiable on-chain through oracles on the blockchain. But this, again, is not to say we're fixing private credit entirely. There are still very limited on-chain borrowers today, and so our task is to expand to different types of borrowers, underwriters, and lenders to the blockchain. So we want to onboard more surety firms, more insurance firms for underwriting, for borrowers, also firms that typically don't touch the blockchain, but specialty finance, trade finance, also tech, media. It can, I guess by design, scale unlimitedly. And more credit experts, so curators would fit that role of advising underwriters on where the capital should go. With that, I am out of time, but thanks for your time. Thank you.
All right, thank you, Jay. All right, next we're going to be covering. Next, we're going to be covering next-generation trading infrastructure. We've got Griffin, Dunaif, founder and CEO of Halliday, which was another team that came out of the Stanford Blockchain Accelerator. They were in the first cohort. Wendy Sun, co-founder and CEO of Senal, and they're going to be moderated by Mark Kligman, director of BD and partnerships at Auros Capital.
Good day, everyone. Today we're going to talk a little bit about where trading and infrastructure is today, what the limitations are, where things stand from a regulatory standpoint, what kind of innovations we've been observing, and whether or not they've been successful in either enforcing more staying power or enabling user traction. Figured maybe we would just quickly go around here and give like 2 sentences on what we do in our day-to-day. I guess I can start. Obviously, my name is Mark. I work at Auros. We're a high-frequency trading firm. We trade on centralized, decentralized exchanges and account for anywhere between 1% and 5% of global volume, which amounts to roughly $5 to $20 billion a day of notional turnover.
Hey everyone, my name is Wendy. I'm the co-founder and CEO of Senal. We are a prediction market where you can trade any real-world event on it. What makes us a little bit different from most of the other platforms is that we are built on top of an AI infrastructure. So we use agents to do market listing automatically. We also, for our resolution process, we also involve agents to check against the data source and assume that and allow that there's no human intervention, which has been a problem for a lot of the prediction markets. Users can also generate their own markets on our platform, and we have models that can predict the potential trading volume so that we only list the markets that can get traded. But I think prediction market is just our first step. Our ultimate goal is to build an engine that can provide truth data to institutions. That can be hedge funds, government agencies, or even like insurance companies who can use our data to make better decisions or even hedge their positions. That being said, we're more than exchange. We want to change the way that people contribute and consume data. Yeah, very, very glad to be here and looking forward to the conversation.
Thank you. I'm Griffin. I'm the co-founder of Halliday. We're a fintech company, and our mandate is to supercharge conversion rates and accelerate revenues at the point of deposit and withdrawals for digital asset applications. I like to say that we're a single pane of glass for every digital asset outcome. So if you want to bring money into a digital asset platform or a 24/7 trading platform, we consolidate all the fragmented ways to do that into a single unified deposit and withdrawal experience.
So obviously, two very different businesses that you're both spearheading, but nevertheless, there's considerable overlap between the two. Prediction markets are maybe somewhat new, but nevertheless, it's still a familiar concept. It's a financial product, it's a swap, and therefore it requires some sort of collateral, right? With Kalshi, for example, their approach is to be entirely fiat native, whereas their closest competitor, at this point in time at least, Polymarket, doesn't follow that approach, and instead they have PUSD, which is a Polymarket stablecoin, essentially like a replica of USD fiat. Two very different approaches, both have their merits and perhaps faults, but I was wondering, Wendy, which approach do you think is best? And I understand that your business doesn't necessarily look at these frictions and bottlenecks because you're in the business of aggregating these markets and improving efficiency. But if we take into account the fact that Kalshi has segregated fiat and clears its own trades, Polymarket has issues stablecoins against deposited fiat or other stablecoins, but there's very little intersection between the two. There's no cross-margining, and that is up to debate with the CFTC as to whether this will be enabled. However, if you had to choose one or the other, let's just say the CFTC says, no way, prediction markets are never going to get cross-margining, forget about it, and you have to pick one or the other, which one do you favor and why?
Well, I think the fiat and stablecoin doesn't have to be like the opposite of each other. Before I started Senal, I was actually an investor in crypto payments. So I'm definitely very bullish on the use case of blockchain in like changing the traditional financial infrastructure. Both Kalshi and Polymarket, they have the TC license. I think like for us, we have both like the stablecoin on-ramp, stablecoin solution, and like the traditional fiat solution. That is because like we don't think prediction market is a crypto business. So we don't think like most of the users will be from the Web3 space. We think actually in the future, majority of the people will from the Web2 space that they don't know what is a wallet. That's why like we onboard the fiat solution for people who don't have stable coins, but still they can use, because we actually partner with Halliday. Like Halliday actually did a big favor for us to onboard the users who don't have the stable coins. These people, like they are living not in US, they are not educated about crypto, but like they can use their traditional way of payments like Apple Pay or like their bank accounts to like get onboarded to our platform, and they don't even need to know what is a wallet, what is stablecoin. They just know that with the solution of Halliday, they can use our platform within like 5 minutes after sign up, and they can trade whatever markets they like. And for the people who are, from the Web3 space, of course, they are more familiar with the stablecoin and everything. And honestly, that's a faster onboarding process still, like comparing with the fiat process, just because of the regulations, in different countries. Yeah.
And Griffin, you obviously just got big shout out here and enabling much more straightforward ways of doing business, and also having the capacity to address a diverse and ever-growing user set that doesn't necessarily converge on a single settlement layer or, I guess, collateral asset, so to speak. Where do you see the future of, I guess, if we had to think through how prediction markets and a Hyperliquid and a Binance and a Coinbase, and maybe even throw in, for for all intents and purposes, a Fidelity, how do you see the settlement function evolve? And do you foresee that there will be consolidation in figuring out a single collateral, like on-the-run collateral / settlement instrument, currency, stablecoin, whatever you may call it? I guess, like, to preface that, the Coinbase and Hyperliquid collaboration in designating USDC as the effective settlement instrument is pretty massive for USDC. But do you think that that kind of collaboration and push has the capacity to iterate further, or do you think it's somewhat in a vacuum and doesn't necessarily portray what we're about to see?
Yeah, it's a great question. And I think the consolidation versus fragmentation, there are different forces at different layers of the stack. Something like a stablecoin Circle, right, which has a very strong network effect. Yeah, you might see a single or 2, 3 providers who have 80% of the market, but that's only a small part of the story, right? And especially when you're talking about a trading platform in traditional finance and in crypto trading, the core question is, how do you meet traders and users where they are? And this is where the world gets extremely fragmented. There's around 40 million wallets. There's around, different numbers here, but 300 to 550 million centralized exchange users. There's around 1 billion people who use fintechs like Revolut and Nubank, and then there's around 7 billion people who hold local currency in a bank account. Now, in each of those regulated segments, well, that's localized to the government policies, 150 plus countries, 64 plus currencies. So that is going to be fragmented and always will be, structurally, by sort of the rule of each local geography's regulatory conditions. And so the challenge is, how do we hook in all these different venues and these emerging venues? So Hyperliquid, Solana, different virtual machines, now things like Canton, and offer a venue-to-venue settlement and clearing function. In the old world, we had things like SWIFT and the Visa network for consumer payments and SWIFT for interbank communications, but none of that really exists in a cross-venue sense. And so that's what companies like us are trying to do. And that's not going to change. I think currencies may have extreme power laws, but venues where you actually store your money, the user capture there, that's as fragmented as it gets.
Fair enough. And I guess a question for both of you. I hear what you're saying. However, there is considerable amount of capital efficiency that is not able to proliferate the more fragmentation we see. If you had to decide where the consolidation would occur and why, which areas would that be in? And I guess, like, the context here is not to keep referring to Hyperliquid, but HIP3 versus Hypercore versus HIP1 and HIP4, is all living under the same roof. And the benefit that Hyperliquid is able to glean in this process is a direct result of the capital efficiency they're able to provide across prediction markets / outcome markets, RWA perpetuals, potentially RWA spot, crypto perps, crypto spot, and I think the list will go on further. It seems that team has a lot of a lot of creativity to iterate further and add value. However, there is obviously like the single venue risks that we're all too familiar with, which don't necessarily make the capital efficiencies that are offered worthwhile when you consider what happened with an FTX. Now, I'm not saying Hyperliquid is FTX. I think it's very far from it, but nevertheless, it's an interesting thought exercise to imagine a world where capital efficiency is prominent and valuable, but also able to disintermediate in a way that doesn't centralize our risks. So if you had to guess, like, would it be prediction markets where we see more of this capital efficiency being pioneered, or in other areas of markets and beyond?
Well, I think the case for prediction market is a little bit special comparing with traditional exchanges, in the sense that for prediction market, if you are, let's say you're longing a position, if you buy yes at 60 cents on one platform and you see an arbitrage opportunity of buying no price at 57 on another platform for exactly the same event, theoretically, you lock in like 3 cents of arbitrage opportunity. But in prediction market, like nowadays, like you're looking at all the platforms, the case is a little bit different in reality, because you can see that even if like the different platforms, they are listing exactly the same event, but the resolution criteria can be different. So you actually have your money locked at the two platforms until the event is resolved. This is very different from like the traditional trading, because you cannot like net your margin. So that when it comes to capital efficiency, I think like prediction markets has a lot of room to do. But before we do that, I think there is a prerequisite that need to be done. That is, we need to have like a standardized resolution criteria. Otherwise, there's no way for you to like netting your position across the different platform. That's why at Senal, we want to involve the agents for the resolution process, because every time our agents open a market, at the same time, it writes a resolution criteria. And that is something, and all the settlement will be, settled against that pre-written rule. So, and the powerful part of that is that this rule is auditable. So we can always go back to all the results of the markets to check out the rule, why the money was paid out that way, and that data will become, very useful for like institutions to be put into their model. So I think like before like we solve the capital efficiency problem across the different prediction market platforms, we need to have like a consensus resolution criteria, and that need to be like coded instead of having humans intervene, because like human intervention is subjective.
Yeah, I think I can offer perspective on where I think consolidation's going on some of these open platforms. One thing that I think is interesting about just the way that an on-chain exchange works, they're not access gated in the same way our traditional broker dealer or traditional exchange is. Like you usually have to be a member of an exchange to operate on the exchange. On a blockchain, you don't need to be a member. And so it's actually very easy to take liquidity from one place to another. So yes, Hyperliquid's the big thing right now, but also the volumes that we see today in blockchain are extremely small compared to what you see in wholesale capital markets. And the most durable financial franchises are probably at the sort of coordination layer. So the card schemas, right, Visa and MasterCard, the clearing brokers who mutualize risk, the DTC and settlement functions that haven't been disrupted since they basically were created by bank consortiums. I think things like that will probably continue to be extremely durable, even in a blockchain context. And that's really things like the layer 1 Canton-style networks that are actually getting access to banks and issuers. But everything on top, it's so dynamic because 90% of the projects who are huge today, when I got into crypto and started the company in 2022, it was a totally different cohort of top projects, and it just cycles. So the liquidity moves, but I think the block space and the sort of settlement functions are what will be durable.
Excellent points, both of you. We're coming up on time here, so I'll ask one last question, and feel free to either one of you answer it or both. So with this recent, more than just, so with RWA being front and center, it's definitely become more than just a narrative or a gimmick. And if you had asked me years ago, do you foresee equities, indices, commodities, currencies, fixed income products living on chain, I would say maybe, but I don't really understand why it would be particularly relevant beyond like some of the improved efficiencies around settlement. What we see today is a massive RWA perp market that trades 20 or 30 or 40 billion dollars a day already, notional turnover, but yet a lagging, significantly lagging RWA swap market. And going back to all the points we've touched on today, capital efficiency, consolidation, fragmentation, and what the path forward is, do you think that the lack of interest and activity in RWA spot markets is driven by fragmentation around how shares are sourced, how the mint function, the minting entities are able to source capital and segregate capital, and they're not really being a level playing field nor a template for supporting a uniform, standardized approach. Whereas with perps, everything is almost on the same page, but kind of in line with what Wendy was saying earlier, the configuration of oracles there is like a massive contribution to like disjointed markets around, post market hours. Do you think fragmentation is what's driving the divergence there, or what would be your educated guess?
Yeah, I think my perspective on the main mass of volume in RWAs is primarily happening on permissioned or non-public networks right now, or on private ledgers. But I do think that the activity there is probably 10 to 100 times larger than anything we've ever seen on a public blockchain. Like, I think a lot of public blockchains in some sense have been a sandbox, a test bed for, do we trust this technology to start pilots with entities like the DTC and JPMC putting some assets on chain, and that's actually starting to happen today, but you won't see it on Hyperliquid.
I think I only have 10 seconds. Well, I think I agree with Griffin. I think for RWAs, I think the main point is that it enables financial inclusion. I think the biggest value proposition is for people who don't have access to the US stock market. So I will expect more volume to be from the emerging markets.
Agreed with that. Well, we're up on time. Thank you, everyone.
Thank you.
Thank you.
Okay, thank you, Mark, Griffin, and Wendy. All right, how are we doing? We got the energy up? We're going to have a fun and slightly spicy conversation, potentially, on global retail adoption. So Jaeyong, junior partner at Pantera Capital, is going to be moderating. Sam Elfarra from TRON DAO, and Caio Sousa, engineering manager for digital assets at Nubank. Two very different approaches to retail adoption.
right. Well, thank you guys for joining us. Before we do, so I'm Jay. I'm a junior partner at Pantera on the investments and research side. So we'd love to, we have two amazing guests with us. Maybe you guys can also do a round of self-introductions.
Yeah, hi everyone, I'm Sam Elfarra. I'm a community spokesperson for the TRON DAO. We're a decentralized autonomous organization dedicated to growing emerging technologies such as blockchain, specifically the TRON network. The TRON network is one of the most utilized blockchains to date right now. We have about 4 million daily active users. We settle about $20 to $25 billion a day. And just last year, we settled close to $8 trillion in stablecoin volume. So we're really excited to get into it, talk about retail adoption, stablecoins, payments, and really happy to be here. So a big shout out to you guys for setting this up.
Cool. Good morning, everyone. I'm Caio. I'm an engineering manager at Nubank. Nubank is one of the biggest digital banks worldwide. We have more than 130 million customers, especially in Brazil, Colombia, and Mexico. And around 7 million of customers, Nubank customers, are using crypto. So I lead the digital assets engineering team. And yeah, we are here to talk more about this global retail thing. So happy to be here. Thanks for having me.
Yeah, that's wonderful. So Nubank and TRON are both very famously, something that millions of people around the world touch and actually use in their everyday lives. So what do you think when you're actually building products that millions of mainstream people use on a daily basis, what do you think are the most important factors and things that...
Yeah, I think this what is adoption. I think it's important to take a step back and understand what the problems are currently. That really spurred a lot of growth for applications like the TRON network. There was a problem of hyperinflation when you're looking at emerging markets. There's a problem of expensive remittance costs, and then also cross-border transfers. And I think those two things, as well as, again, as I really want to emphasize on the hyperinflation standpoint, really grew the USDT adoption. So we found a specific problem in America, Africa, and also parts of the Middle East and Asia. And then from there, we built a product with it being the TRON network and had talented individuals, talented organizations build solutions like USDT, and that in itself gained a lot of adoption. And we're seeing importing and exporting companies moving money across border in a faster manner rather than having correspondent banking rails. So that's like the biggest thing for us in terms of that adoption and why we've been seeing it. And we'll probably dive into that a little bit more in a bit.
Yeah, pretty aligned with that. And what I see is that talking about retail adoption and mainstream customers, the main lesson learned along the last years is that normal people, they don't care about all this technical jargon, all this crypto jargon that crypto word brings to the table. Like, they don't want stable coins, they don't want blockchain, they don't want crypto. Even a lot of people are I don't know, scared with crypto. Like, if you talk to your grandma or your cousin, you say, oh, let's buy some crypto. They go, oh, is this a scam? Or what value this brings to my real life? So the main lesson learned is when we have this amazing technology like blockchain, digital assets, but we have to focus on the problems this solves for real people in their real lives. Like, so, okay, this is, I don't know, faster money transfers or cross-border payments or things like that. So people will start, okay, I see the value in this, and I will start using this, not because it's crypto or because it's high-tech, but because it solves a real problem for me. So that's the...
If I can actually add to that, because that's a great point, the abstraction thesis is really big. So effectively, as we like to call it, a stablecoin sandwich, where the individual is never actually dealing with stablecoins. So if I'm an individual and I live in, let's say, Argentina, and I want to move Argentinian peso to Nigeria, and I want to, for whatever reason, I want to do cross-border trade, because I would need to buy some stuff from Nigeria, you have to effectively get the Argentinian peso, swap it into the US dollar, and then find somebody in Nigeria that's willing to buy the US dollar and then sell you Nigerian naira. And there's typically a large amount of FX. It takes time. It's inefficient. We made a joke in the back where it's like it's bureaucratic. There's some political risks as well. But with stablecoins, what effectively you can do now is that individual still has the Argentinian peso, but the solution that they're utilizing, whether it be a neobank, a payment processor, can utilize stablecoins such as USDT on TRON to create that transfer and that swap and find an OTC desk in Nigeria to do that sourcing of local currency at much, much faster rate. So instead of waiting T+2, T+3 days, if not more, and being charged 10%, 8% sometimes on those FX costs when you're dealing with those types of remittance corridors, you're now dealing with just whatever the gas fee is, which is pennies to the dollar, and it takes minutes. So it's a phenomenal product that has been built over the past couple of years.
Yeah, and sorry, if I
Yeah,
can
don't
add to that, another interesting is that, yes, for sure, we have to abstract all this complexity to give real value and the utility for the customers. But on the other side, we also have the challenge of being transparent, like explaining the risks. So, okay, I'm using these products, I love it, so this solves a real problem, but I want to know what risks are involved there. So one thing I like about Nubank is our brand. So our name is Nubank. I don't know if you are familiar with it, but Nu in Portuguese means naked. So we are we are the naked bank because we were created with this idea of being fully transparent. So we want to empower people to do whatever they want with their money, to have control of their finance. And we believe stable coins and blockchain and digital assets are pretty much aligned with it. And it's a challenge also to, okay, we create this amazing product that's powered by crypto, but solves a real problem with a very well designed, good interface. People are loving it. But also, we have to explain in plain English, or in our case, in plain Portuguese, what this is, what are the risks, what are the costs, so that the people can adopt the product they love and fully knowing the risks and what is involved there.
Yeah, this is super cool. So when you actually push some of these products out and look at how customers react, how can you tell, like, what are the parts of the product that the customer really derives value from or really likes versus some other ones might just be like just features, but like people never really use them or really don't care about them. It's more of a narrative.
Yeah, we start by the problem it's solving. Like, we start by listening to the customers and what pains you have in your financial services and wherever. What are your needs? What are the jobs to be done? And then we think, okay, how we can leverage blockchain and digital assets to solve these problems, to create beautiful products for this purpose. So if we cannot sell the product to our grandmas, like, okay, this is very easy to explain, this is, I don't know, this is cheaper way to move money, or, okay, you can put your money here to work for you and earn yield, something like that. If you can't explain clearly the value in plain Portuguese or plain English, probably is most hype than utility. So we don't, customers don't see value in, oh, this is crypto, this is on-chain, this new protocol is amazing, look at these hundreds of tokens. No, normal people don't care about that. They don't want this. They want the utility. So we try to separate this. Like, if it's solving a real problem, we can sell the product for ordinary people. They know what it is, they know the risks, they are adopting. So this is probably where the value is.
In our end, TRON is a open source, permissionless, and decentralized blockchain. So we really act as an infrastructure for businesses to build products that they're either offering to businesses or also directly to consumers. So we're very much B2B2B or B2B2C. So we'll have talented corporations such as Nubank over here who can build on the TRON network to be able to offer to their consumers a better way to move money across border or to generate wealth or whatever it might be. And from what I've personally been seeing gain a lot of adoption has been neobanks. It has been MTOs, so think the MoneyGrams and Western Unions and those types of companies starting to adopt blockchain technology because they see the efficiency that it has compared to traditional correspondent banking rails, which I think to the credit of that certain vertical is starting to also adopt digital assets and blockchain. Because why would I want to have Nostro and Vostro accounts across multiple different corridors where I have locked up capital when I can just start to use stablecoins more effectively to actually conduct transfer, or at least in a more efficient and effective manner? So that's what I've personally been seeing. We've seen projects like, Redot Pay is one that comes to mind that we spoke about, where individuals will top up their Redot Pay card or even Cast card with USDT on TRON, and they can go to their local coffee shop and start actually utilizing it to purchase things. We're seeing a lot of that type of adoption in the global south, Latin America, like I said earlier, Africa, et cetera. So those are some of the features that we've seen built on the TRON network. And the TRON network itself has had no downtime. We have very, very reliable and sustainable fees. We're very fast chain as well. So we really act as that core infrastructure for these developers.
Yeah, that's super cool. Today we're also in Silicon Valley, in the heart of AI land, of course. So I'm actually very curious, as I'm sure most people are, is how do you see AI both changing the workflows of your own teams as well as all of the products that you guys are building for your customers?
Yeah, well, it's a bit more complicated than just using ChatGPT, I guess. We are using that, I guess, as a chatbot, right? Everyone's using that. But I like to look at it, if we want to take a step back, I think agentic commerce is something that we can see a lot of adoption for. Obviously, everyone's using AI to actually automate their internal workflow, but I have been seeing individuals starting to build agentic commerce work streams, where somebody will build an application on TRON, they'll use an X402 standard, they'll use the proper, I think it's TRC 8004, right, for agent discovery, and be able to actually use an AI agent to utilize stablecoins on behalf of their person to buy whatever certain product. Now, who here actually trusts an AI agent to, I don't know, buy Taco Bell or buy anything for you guys? Is anybody here willing to? Okay, I see one person, 2, 3. I think that's the biggest problem that needs to be solved, is the psychological component, getting humans to actually trust an agent to actually buy things on their behalf. I've heard horror stories that, they've basically just got their wallet rugged by an agent and now they hold it ransom against the person. So I think it's really important that we build those types of boundaries and infrastructure so that we can actually see more agentic commerce come to light. Not just in the traditional off-chain world, but also on-chain, because it's just a faster and more effective way for agents to actually move money.
Yeah, sure. Talking a little bit about the internal team, we have been adopting AI in the whole product's life cycle. Since discussing an idea, we can leverage AI models to, act like a person or get all our research context and databases, and we can discuss ideas and understand if the products we have in mind are good products for good people, for our retail customers or not. And since this product design until developing codes, cooperating with our engineers, so accelerating development, accelerate prototyping, so this is amazing. And for end customers, mainly AI can help a lot to create more personalized stuff. So crypto is complex, so we work in abstracting this complexity and providing easy-to-use products. But with AI, this can be a lot easier. The AI will know about the customer context and will be able to, do a conversational interface, like what are your needs? Okay, we can help you with this product is good, this product is not, so much more personalized for end user customers.
That's wonderful. I certainly look forward to a lot more of this sort of personalized agentic commerce, which I think is a really great vision for AI. So as kind of stablecoins and digital assets as a space generally mature, what do you think is one thing that the market is overestimating, and what's one thing that the market is underestimating?
Okay, yeah, sure. Well, I think the market overall, I'm not telling about any specific use cases here, but overall, I see a lot of people in the industry assuming that putting more cryptoness in products add value automatically. So this product's amazing because it's powered by crypto, because it's on chain, because there are a lot of protocols, because that, and people don't see value in this. So I think the market kind of overestimates putting more cryptoness will add more value to the product. That's not necessarily true. And on the other side, what the market underestimates, in my opinion, is the power of simplicity. So get to know your customer, the problems they have, and build a product that solves that problems in a very well-designed interface, very easy to use. And by the way, it's powered by crypto because crypto enables a lot of things. But yeah, let's focus more on simplicity and less on cryptoness because of its sake. So.
Yeah, I think we overestimate, for sure, creating 2 forward-facing crypto products that might be focused a lot on just the small group of the Web3 audience, although it has grown a lot. But I think we underestimate the solutions that we could be building to solve real-world use cases, specifically in payments. I think payments is going to be one of the largest, if not already the largest product market fit that blockchain can provide. And then you can also grow that out to broader financial services with banking and payments. And I think we underestimate how big of an industry that is, especially when it comes to blockchain, because since the inception of crypto, we've really focused on DeFi and liquid staking, liquid restaking, which has its use cases, sure, but I think we really tend to underestimate the amazingness, for lack of a better term, that payments can really provide for the blockchain industry and vice versa. The payments industry in itself is humongous. I think there was like $1.5 to $2 quadrillion worth of payments that happened just in 1 year, in the year 2025. And that was not a typo by any means. It's 1.5 to 2 quadrillion. That's like 2,000. It's a lot. It's like 2,000 trillion or something. So it's a really, really big number. And a very small subset of that is actually happening on chain. So we very much are underestimating how much blockchain can impact that specific vertical compared to other types of industries that we may be overestimating.
Wow. Yeah, that's amazing. So last question for you both. So what's kind of like your favorite crypto-related feature in the products that you guys are building today that our audience might not necessarily know about?
I think 24/7 settlement. I think that is huge, and also instantaneous settlement. When you conduct a payment, you can see it in 3 phases. You have your authorization, so when you tap your card or you're trying to send a wire transfer, the acquiring bank and the issuing bank works together, communicates through a network rail to see that you actually have the money, and then they do the actual clearing at the end of the day, and then you have to wait T+2, T+3 for the actual settlement. With blockchain, a lot of that gets truncated, and it happens instantaneously, and it's working 24/7. So I think that feature in itself is amazing, and it's also cheaper. So it's cheaper, faster, more effective, transparent. It's effective, and I think that in itself is amazing.
Cool. Okay, I'm going to talk about the last feature we launched for Brazilian. We were the first bank in Brazil to launch staking, Solana staking as a feature. But when we were designing this product, we were like, okay, how the hell are we going to explain what staking is for the customers? Like, oh, this is staking, this is amazing, use it because it will multiply your assets, so people will be scared, like I told before. So we branded the products as earn crypto, like ganhar crypto in Portuguese. And it was like, okay, you have assets. Do you want to put these assets to work and to earn more assets? And people, oh yeah, sure, okay. So here's how you do this with 2 clicks. By the way, this is powered by staking, and here are the risks, here are how this works behind the scenes. But yeah, customers are loving the product because it's very easy to sell, like I say, okay, just put your assets here and you earn more assets, and people like this. It's like free money. And yeah, the product is doing very well, so I'm passionate about it.
Amazing. Well, thank you both. This has been a wonderful conversation, and thanks everyone here.
Thanks.
Thank you, everybody.
All right, thank you guys. Where are we? Hi. Okay, next we have an awesome panel, Fireside, coming up. And it is going to be secure wallets for human and agents. These are 2 friends, Max Segall, the COO of Privy, which is a Stripe company, and moderated by Dmitriy Berenzon, who's a partner at Archetype. And they're friends, but I told them to pretend they're not friends. So we'll see what happens.
Right. Hello, hello. I am thrilled to be here with Max. We've been long supporters of Privy. I've been a long supporter of you personally. I want to take people on a journey. I want to give a bit of like past, present, future of Privy. I don't know how many folks are aware, but when Privy kind of like started in its early days, a lot of the focus was around privacy and user-controlled data, and it looked different than the core product around embedded wallets that you offer today. Take us through a bit of that journey around like the early IDMAs and kind of like getting to PMF.
Yes, Dmitriy, great to see you. I am super excited to be here with a dear friend, Dmitriy. Archetype was an investor in Privy a couple of pivots before the current Privy and has been endless positive support for Privy every step of the way. So this should be a fun conversation because you've seen the entire journey.
Unpaid chill.
Exactly. And I joined Privy a few months after the company was founded. And I joined when we were focused on, as Dmitriy mentioned, privacy. The whole idea of the product, and Henry and Asta, Privy's founders, the vision was always about how powerful blockchains are for allowing users to own and control their identity and take their identity with them across the internet and all of the superpowers that come with crypto rails. And the initial idea was you have all of these great crypto products. This is 2020, 2021, and they're really powerful, really novel, but nobody is giving these crypto products information about themselves. You sign in with a wallet, it's very privacy preserving, it's very discrete one-time use. And so products like Uniswap, products like OpenSea, they have the ability to facilitate transactions, but they don't have the ability to understand anything about the user behind the product. So the original version of the Privy product was create an end-to-end encrypted data store so that products like Uniswap could take on information about the user, preferences, name, saved account information. Uniswap wouldn't store any of the information on the back end, but they could just in time retrieve it to power the product experience with richer information to power richer experiences. So really, really cool, powerful idea on paper that nobody actually wanted in practice. And so we joined and we were trying to sell that to the market and it just wasn't sticking. And the one problem that kept coming up in this time period was, it's great. I want more information about my users in a vacuum, but I actually can't convert any users that are coming to my products. Like signing in with a wallet is a really clunky experience. Most people don't have external self-custodial wallets like MetaMask, and they're too complicated to set up. And so we kept running into that problem. It was like clearly the burning thing on everyone's mind, and that's when we decided to pivot into, originally the focus was all about user onboarding and making it seamless for crypto apps to onboard and support their users.
And how much context, like how many times did you have to hear that to actually say, okay, this is the direction? Like I find it so fascinating to discover like that aha moment. And like I'm curious, like to what extent there were any like specific customers that said like I don't want X, I want Y, or was it enough customers just did not actually like do the uptake? Like I'm curious if there's like a specific moment that the company said, okay, like we need to change directions.
Yeah, so it was actually during a team offsite. It was Henry, Asta, 2 engineers, and I was interviewing this day. And it was the day that they all got into a room and looked themselves in the eye and were like, this is not working. We can get a conversation with any company in the market and they'll say all the right things about this is a great product that I want to use and you're doing great work. And then when push came to shove, they wouldn't actually adopt anything. We'd send API docs, we'd offer support, everything above and beyond, and we just couldn't get it to click. And Henry zoomed us out and was like, this is not working. Let's just get the elephant in the room out there, and what are we going to do about it? And then everyone, I was literally there that day, not full-time part of the company, but everyone was like, huge sigh of relief. okay, let's focus on something that is working. And that's how we started iterating toward where we are right now. And it instilled this like really deep sense of we refuse to build anything that the market doesn't want. And so like no product work at Privy, and we'll get into what Privy is and does, I'm sure, is we won't pick up anything unless there is a great champion customer that needs it that we can build around. We're like very traumatized as a company by trying to will something into the world that the market didn't want.
That makes sense. And I think a personality trait I would ascribe to Privy is kind of this notion of customer obsession. And I've kind of seen it throughout the years where, you know, I talked to a company that might be using Privy or did not choose Privy, and I kind of asked them why. I share that feedback with you, and you're like incredibly grateful. So yes, great data point. You integrate it very quickly. I'm curious, like how you kind of like embedded that culture of customer obsession, and I guess both through like the company as a whole and through kind of like the product roadmap component.
Yeah, I think a lot of it comes from our origin of a product that didn't work, that the market didn't want, and just knowing like we need customers to guide us to build value. And prior to Privy, spent 4 years working at Brex and was on the go-to-market side of the company for 2 years and on the product side of the company for 2 years, and just like really felt in my bones, like the moments where Brex was performing at its best was when we were extremely locked in, obsessed with customers, whatever they need to be successful. All of our best brand moments were about celebrating customers and their work versus, you know, celebrating our product and how great it was. And all the misses were when we lost sight of the customer and we got like just too in our heads about like what do we have the right to build, what do we have the right to win. And so it just like really instilled this culture of like, if you're not building from the ground up of what customers need, the product is less likely to win.
How do you avoid overfitting? Like how do you avoid being like an N of one startup where you just overfit, you spend a ton of resources on making one customer happy, and then you're like, okay, this is completely non-transferable to the rest of the market?
Yeah, so Privy's product is it's wallet infrastructure. It makes it easy to embed crypto functionality into products like whether it's Hyperliquid or Deal or Ramp. You can have crypto functionality in so that a product's users can hold crypto assets and transact seamlessly without knowing there's crypto behind the scenes. And as we were getting started, we were talking to every crypto company in the market. And so one way that was helpful to avoid overfitting was when multiple companies were saying the same thing, needing the same thing. As we were getting started, it was all about how do I make it easy to sign up and use a product. And so we had customers like Blackbird, the restaurant payments and loyalty platform, and companies like Courtyard, the trading card platform, saying the exact same thing. They just wanted an easy way for a user with a phone number to get a self-custodial wallet embedded in the product that they could receive assets in and transact without knowing there's crypto behind the scenes. And we're like, great, these are two incredibly strong teams with founders with strong vision. They clearly know where the market's headed better than we could ever predict. Let's just embed with those teams, listen to whatever they need, and build a product around it. And we've approached that. And our biggest misses is when we lose sight of that. And we're like, okay, this one company in the market really needs this one specific feature, and we have like vision that this is gonna generalize to the rest of the market, and just every miss, you can trace it back to not being obsessed with the market and serving as many users that have a similar need as possible.
Nice. So today, Privy powers what, like 150 million accounts and 2,500 applications. I'm curious, out of those, where are you seeing the most organic pull across certain use cases, customer personas, geographies?
Yeah, so when we were getting started, the category defining Privy customers were building around consumer social, trying to reinvent Twitter, Instagram, TikTok on crypto rails. And there was a whole generation of companies that we built our product around, and then that category has really died off over the last 12 months. And so, and this market we serve is constantly changing. Every 9 months or so, it's a totally new pocket of adoption, and our only purpose is to make sure we're useful infra for whatever shape of the market develops and takes off. And right now, there are a couple of things that are really resonating that are for sure here to stay. One of the shapes is using crypto rails to provide yield on idle balance in a product using DeFi and self-custodial wallets. That is a product shape that is absolutely exploding. I think Coinbase deserves a lot of credit for popularizing the shape with Morpho, but we're seeing Robinhood having explosive growth doing this. They launched just a few weeks ago. Kraken is doing this. Ramp is doing this. Deal is doing this. Every explosive use case, not every explosive use case, but many of the fastest growing use cases on Privy are this structurally better product experience of you have money sitting in your product, it should be earning, and you can power that worldwide in a simple way with our tech stack. So that's something that's exploding. We could get into others. I think one other like breakout growth category is the 24/7 trading experiences. Products like FOMO, products like Hyperliquid are and have been for a year explosively growing and having real visible marks of adoption. I think the ability to trade oil futures over the weekend as oil was in peak volatility with the Strait being closed was a big aha moment for the power of crypto rails, and we're seeing that category exploding as well.
And then what do you think is completely overhyped? Like areas where, maybe you thought that there was going to be traction, maybe the market thought that there was going to be traction, but from like a wallet and user perspective, you're just not seeing it right now.
Yeah, I think the biggest expectation versus reality gap in the market right now is in agentic payments. That's not that I think the category is overhyped, but there is so much promise there. Everyone points to agents managing wallets as an obvious category. It's something I have like irrational conviction in that will play out in the coming years, but we haven't cracked the use case that's driving tons of adoption in the way that the other categories I called out are. And at Privy, we're investing crazy amounts of energy to ensure any team with real vision and a use case that seems like it's a pattern across the market, we work really well for it. And we've made big investments as a part of Stripe in collaboration with Coinbase and X402. We have our MPP protocol that we're working on with Tempo. We have a big platform investment with both AWS and LangChain to make sure that anyone who's building an agent can easily spin up a wallet and facilitate transactions. And there's green shoots of usage, especially in the agentic trading space and letting an agent manage a wallet for more of a portfolio investing use case than for a payments use case. But agentic payments and agentic commerce, it hasn't reached the level of adoption we all hope it will. And as we know in crypto, it's only a matter of time before someone lands that killer use case and it explodes.
Yeah, I'd love to dwell on that a bit more, because when we look at the X402 stats, I mean, like there is volume on like a transactional like number basis. The overall dollar amount is not exciting yet. I'd just love for you to like dwell on like what you think is wrong. Like, are we missing anything? Is it that we don't need, or like, are we fine with just, like Ramp doing like provisioning for agents where you just have like a tokenized credential that says like an agent can pay for this thing. Here's like the most they can pay for, spend, and then we're good. Yeah, would love for you to share some thoughts on that.
Yeah, I think stablecoins have a really important role to play in facilitating agent transactions, because it is just an API call to spin up a self-custodial wallet that can hold funds that an agent can manage. And that's a huge advantage relative to everything you need to do for an agent to hold money and transact on fiat rails, which is you really need a human behind the transaction to set up everything for the agent in a way that makes it unworkable and too much friction relative to the value. So I'm very bullish on the give an agent a wallet and a budget and let it do what it needs to do to transact. And I think the two big gaps are, one, most merchants don't accept stablecoins today. And that is a problem I think Stripe is uniquely well positioned to solve in an area we're investing a ton. And so making it easy for agents to spend via stablecoins across every Stripe merchant, that will be a huge unlock, especially as you couple that with a good directory so that agents know how to navigate where they should be spending the money to perform the tasks that they're doing. So that's one big challenge. And the other big challenge is, how do agents actually get funds into the wallet? Like, it's one thing to spin up a wallet. It's another thing to have money to spend. And again, I think we're investing a ton at Stripe on making it easy to programmatically disperse funds, pay in via bank transfers from wherever the originating need comes from that the agent is going to perform into the agent's wallet. So I'm talking about Stripe investments we're making to make this easier. Obviously, there's a whole ecosystem of players that are making those same investments in parallel, and eventually something's going to click. The third thing is just like a killer use case that no one's going to expect coming. Like, what is the Uber ride-hailing use case parallel for the iPhone that it is just a strictly better experience with agents transacting via stablecoins than the traditional economy is doing? We can't possibly know that. The only thing we can know is there are great teams out there, founders with vision, and we need to be locked in on whatever they need to make sure our stack is well positioned to support it.
Yeah, I mean, I hear micropayments as the killer app. And if merchants are able to accept stablecoins, presumably they would want to do that because all merchants hate interchange. They hate the 30-cent minimum. I'm also not super convinced on whether you need like settlement on a per transaction basis. I think if the credit card networks really wanted to remove the 30-cent minimum, they could probably have, like you just settle the balance at the end of the day. So
100%, and that exists on fiat rails today. Like there are all sorts of fiat systems that hack that. So it is possible that this world gets stood up with fiat. It's just like a lot of retrofitting, and if there's a whole new wave of economic activity coming online, you might as well use the most powerful tech available to you to facilitate it, in the same way that e-commerce enabled the creation of companies like Stripe.
But so do you think it's micropayments as like the killer app for agents and stables, or do you think it's still kind of like red herring, TBD, might need to be like another thing down the line?
Micropayments are obvious. Like I do wish that I could just double tap my phone and be able to read a New York Times article. This is like the most classic example people point to, but I wish this existed for a tenth of a cent versus paying a New York Times subscription. And same deal with many other services delivered over the internet. So I'm a believer in that. It's not playing out because there's all sorts of inertia in place for the existing systems to go on running. But I think there's going to be something none of us can expect that's going to blow up, and we need to be ear to the ground, ready for when it happens.
Love it. And then maybe as a last question, just looking forward at the next 3 to 5 years, how do you think about the future of Privy? Like when you look back on today, how do you think the company would look different?
Yeah. So I think following whichever direction the market goes, this agentic payment direction being a great example of it, is going to take us in wildly different directions. I don't think we ever would have predicted looking the way we do when we got started with user onboarding for crypto native apps. 3 to 5 years from now, I'm really excited about truly global banking services. So companies like Brex and Ramp and Mercury being worldwide. We're already starting to see really cool shapes of that experience with products like Cast and Plasma out there. So I'm excited about that. I'm excited for every marketplace to be dispersing value to recipients worldwide on crypto rails, and I think we have a really important role to play there as Stripe and with Privy. And I'm excited for this tech stack and like launching financial services into your product to be as simple as unwrapping Privy. And we have a long way to go before that is a complete picture. But you know, for a product like Uber or Airbnb to just have all of the banking functionality directly in the product, that's something we are working really hard to enable. And I'm excited for that world to exist.
Love it. Well, I think we're just at time, but you are incredible, and thank you all for listening.
Thank you.
Thank you, guys. All righty, how we doing? We got energy up. We got a little bit longer, then we're gonna have lunch. So now I'm extremely excited to introduce Michał Pospieszalski, who's the CEO, CTO, and co-founder of American Fortress, talking about quantum proofing the crypto you already own. Because we all want to keep our crypto and not have it stolen.
So, hello, Stanford. I'm here to talk about a topic no one cares about. That was a joke. I heard like one laugh, like in the corner. Kudos to that person. So, there's a lot to cover here. I got 10 minutes, so I'm gonna go really fast. Hopefully there'll be time for a question like right at the very end. Again, I'm Michał Pospieszalski. I'm the CEO, CTO, founder, co-founder, and inventor of a lot of the stuff I'm about to show you. And we're going to skip the basic stuff and get right to the meat, okay? So how does your wallet currently work? Well, there's a seed phrase. Everybody knows what those are, right? And then you derive addresses. And your typical BIP32 on SecP256K1 HD wallet, that can derive 4.2 billion addresses before it runs out of addresses, right? So what's the problem with quantum computing? Well, the problem with quantum computing is this is how crypto today works on all chains universally. There's almost no variance in this, very, very, very little. Ultimately, from your seed words, which is 12, 18, 21, 24, et cetera, you're deriving these child private keys, child public keys, and that public key gets hashed into an address, and when you ask your wallet to generate an address, voila, you get an address, right? And so what can the quantum computer break? Well, it can't break the hash. It can't go back from the address to the child public key. But if you reveal your child public key, it can reverse compute the private key, or so we assume, right? And we assume this is going to happen fairly quickly. So the problem is if your public key has been revealed, so on chains like Solana, this is 100% of all keys because they don't hash anything there. It's just all sent to public key. Now the quantum computer can just steal your money. It can also steal burn addresses, can steal Satoshi's old coins, et cetera, right? So this is the problem. So how do we solve it? So we invented a sort of new modification of older ideas, which we call it the zero-knowledge proof of seed provenance, which happens to be the first 4 letters of my last name. So that's the zero-knowledge Pospieszalski. For all of you that want to pronounce that, I'm here for you. And based on that, the quantum computer can't go back up this tree and get to the seed words, or actually can't get to any of the hardened artifacts in the tree. Therefore, if you have a zero-knowledge proof that I know something in this tree, and then I use that as a proof, and I send that to the node, I am now quantum safe without migrating my address ever. So this is the only solution on Earth that actually works for making crypto quantum safe today, with the users doing nothing. So you might ask, like, why am I the first person talking about this? Well, this idea, generally, a version of it was suggested, starting 3 years ago by other researchers. The problem was it took half an hour to compute a single proof. And what we've done is we've split it into a derivation proof, a sign proof. So a sign proof is for every time you're trying to spend from an account. A derivation proof happens just when your wallet wakes up, you just compute it at any time. And post Q day, this is already extremely fast. It's 21 seconds on the derivation proof and 12 seconds on the sign proof. And what we're working on now is making these things go 100 times faster, roughly 10 to 100. So by the time we hit production, we'll be in the sub-second time. And I'm not, and the other thing we invented is this quantum BIP32, which actually speeds it up even more. Also doesn't require any chain migration. So today, the Ethereum Foundation announced like a solution of this, which requires migrating your funds into a vault into a smart contract, and it takes 6 minutes to compute that proof. It costs 7 cents. You know, the cost of our proof is 1/3 of a penny when you put them together, and shortly it's going to be 1/30th of a penny, which I think is pretty cool. And so we are deploying to production in October, post RTG. RTG September 23rd on all the big exchanges. A wallet tech that's got the post-quantum signing for every element of the stack. We're using crystals dilithium. We have a high entry, what we call a quantum fortress seed. We have quantum BIP32, which then speeds up your zero knowledge proof computation for any further spends that you do. Also, it does not require the network to do anything. It will compute the ZK Pospieszalski proofs immediately, and it does privacy, and it does post-quantum credentials that we're integrating with one of the major partners in the world for credentials. So we've built this system that you get privacy, you get quantum proof, you get compliance, and it works on all the chains. We're starting at 13 chains as our launch, and then we're rapidly going to 50 chains. So you're going to see essentially a really awesome tool that's deployed everywhere. And this is available via SDK and also the wallet. MetaMask, we're integrating with MetaMask as a snap as well. So you might ask, okay, how do people adopt this? Well, as a user, you don't have to do anything at all. You can use QBIP32 via our SDK or our wallet, and then that will make your quantum computations faster. Eventually, the nodes have to do a soft fork. They have to actually, the node has to go back here, and it has to be able to understand this extra proof, right? So you do require a soft fork before Q-Day. But what this does is it shifts the burden of quantum safety from the users. Mind you, migrating all the addresses is literally impossible. Like, no one will ever migrate all the addresses. So all these suggestions of, hey, we're going to just migrate everybody, that's just fantasy land. We solved that problem completely. And what's the other stuff that we do? Well, it turns out that the reason I'm an expert in this type of cryptography is I've been working on it for 4 years when it wasn't popular at all. When I was getting paid zero money to do this, and I was just like, okay, I'm going to just solve this crazy problem. Because it turns out these zero-knowledge proofs are incredibly powerful for other things. One of the things you can have, which you can download at our website today, is you can have sent a name that's fully private, and you know exactly who sent the money. So you just spell somebody's name, and you can just send them any crypto on any chain, and they just get it, and no one knows how much money they got. It's fully private. It's quantum safe through our confidentiality machine, which is like a compliant version of Zcash that runs on every chain. So imagine, like, what we're deploying is not just a privacy chain. We're not an L1 or L2 at all. We're deploying privacy that's quantum proof and sent to name and compliant on every chain. Because one of the things that this proof does is the following. It lets you prove where the money came from. Like today, how do you know who sent you the money? Well, you got a Telegram chat and you send some guy an address. How do you know he sent you the money? You don't. You've never been able to know. This has been a fundamental problem in crypto since 2006, right? So we've solved that completely, and now you get a zero-knowledge proof of who sent the money every time. You can ask for their ID. You can talk to them via encrypted chat. And all this is live in production in October, and most of it's currently live in beta. And we also have a hide my balance, we call it the untraceable quantum send confidentiality machine that has that same property. And I'll talk about that last. Like, why is privacy huge? The problem is you can too easily commit criminal acts through it. And so there's all this talk of, okay, well, we got to put viewing keys, we got to have some backdoor before it's compliant. Now, why are people saying that? Well, if you're a bank, right, you have to be able to explain to a regulator how you got this money. Otherwise, you just can't take the money, right? So what we do with the same set of proofs, the zero-knowledge proof of seed provenance, is for the confidentiality machine, the privacy pool, to process a transaction, the user has to send a proof of where the money came from to the counterparty. So the counterparty always knows where the money came from, but there are no viewing keys. There is no backdoor. So like imagine like every transaction you ever received has perfect viewing keys for you, but not anybody else. Right? So now a bank can have full privacy all day long. Deposits 24/7. They all go through a confidentiality machine. They're all quantum proofed already. That requires no migration on the chain. It's like we're just deploying all this stuff. And when they get that, it's 100% compliant all the time. So that is the pitch. I have a minute. I will take one question. Yes. I can't hear you. So here we go. We're doing audience interaction.
It's a very quick question. I mean, you mentioned this very impressive performance, okay, for the zero knowledge proof. How do you do it? You basically throw zillions of say, GPUs on it, or what?
The question is, how do I make it faster? So it turns out that in our lab, we already made it 13 times faster. So it's already at sub 1 second, and that's just on a phone. So and yes, we are doing GPU acceleration, but like we actually tested it on a Galaxy phone that has GPU acceleration, and it worked great. So we thought initially we're gonna need like prover networks to do this. So like the wallet, your wallet or your mobile phone wallet would have to like outsource the zero knowledge proof to like a trustless prover. But it turns out it doesn't have to do that, which makes deployment way easier. You can just compute the proof on your phone. And that's us. That's American Fortress. If you want to support us, currently we're not open for investment unless like an investor has a heart attack or something, before Tuesday. But certainly talk to me or talk to Kara, who's right here. Kara, raise your hand. She's our CMO. I'm the CEO, CTO. I'd also like to give a special shout out to Stanford University alumni. Michael Heinrich and Arnie from Zero G Foundation, who invested in us late last year. They've been big supporters. They're one of the first chains that's adopting this tech, and just big shout out to them because they've been great to work with. And yeah, if you're a wallet like your Privy, by the way, we're going to find you and talk to you again. So we want to get this SDK on board in as many places as possible because it in no case does it compete with what you're doing. It only adds to it, right? So like this tech does not exist. Like no one's ever solved this problem before. So we have literally zero competition. And we're just here to bless everybody up with the awesome technology and get you onboarded and happy and be doing quantum-proof private transactions. Thank you, Stanford. We will talk again soon.
How? All right, thank you, Michal. You can give it a... Okay, next. How you guys doing? Couple more sessions. Actually, this one's going to be super exciting. We've got Hallie Atkinson, who's the Chief Product and Technology Officer at OneEdge, who's going to be talking about From Idle to Shared, solving DeFi's liquidity utilization problem. And she's new to the role, and she's got a lot to say. Holly? All right, thank you.
Okay, can everyone hear me? Yes. Okay, let's talk now about DeFi's liquidity utilization problem. A bit about me first. I'm Holly Atkinson. I joined OneInch at the start of June, so I'm pretty fresh there. Joined as CPTO to streamline the product and tech part of the organization. And yeah, let's talk now about what is idle liquidity and why it's a problem. Oh. So, I don't know if you will have seen, but earlier this month, June Analytics released their report, Capital Efficiency in Concentrated Liquidity. What June did is they rebuilt every position in the top 200 pools on 4 major venues across 7 chains during the first half of this year. And what they found was that just under a third of concentrated liquidity provided was outside of active range, earning absolutely nothing for the person that provided it. And when we talk about the issue of underutilization more broadly, so being idle liquidity, as we're calling it, and capital that's provided that is within range but too far from the price to be actually useful, we see a bigger problem with around 85% of all capital provided being underutilized. And why should you care? Well, There are fees being missed out on here to the tune of $150 million per year, just because capital is sitting out of range. And individual liquidity providers suffer more. So 82% of idle capital on Base's Uniswap v3 sat in individual wallets, not automated managers, showing that when you're not actively managing your liquidity, you lose out even more. And no pool design today protects liquidity providers from this issue. Fixing this is in everybody's interest if the market is going to recover. What is 1inch doing about that with Aqua? We come now to what shared liquidity is all about. So what is Aqua? Aqua is this shared liquidity layer. It's not another AMM. It's the accounting and balance sheet that lets AMM strategies trade directly out of liquidity providers' own wallets without token deposits. It's a fully self-custodial solution to this problem. So here you can see 3 black boxes saying AMMs. They're not AMMs in the sense of being external pools. They are AMM strategies built on top of Aqua. And here we see a swap transaction. So on the left you have the taker who will initiate a swap. The AMM strategies will price, and the swap will execute through this system, with Aqua being the shared layer underpinning everything. The AMM boxes here are essentially stateless pricing engines. When a position on Aqua is shipped, it's shipped as a small program sitting on top of the Aqua virtual balance sheet layer. It's composed of various parts shown here. So a liquidity provider will configure these according to however they want. You could set a band here, a decay spread, a flat fee, and your swap type. And I want to add here that the fee is baked into the tokens that arrive in the LP's wallet when a swap fills. There's no additional claiming that is needed. So end-to-end, how does this work? The liquidity provider creates a position on Aqua. They configure a pair, a price, a fee, and then ship that strategy. The tokens stay in the wallet until a swap fills, and then tokens move atomically in one transaction. The routing discovers the positions shipped on Aqua via 1inch Pathfinder, the finding part of the protocol. The positions are found as liquidity sources, so you can imagine how this looks with many, many liquidity providers taking part. Then, a verified counterparty fills. So when your price wins the route, a 1inch resolver executes the swap against your position. And as I've mentioned already, the tokens move atomically with both legs happening in one transaction. Tokens leave your wallet, and the counter tokens arrive with the fee in the same part of the transaction. So what do you get with Aqua? You get more swap activity. You can, with your wallet balance, cover more positions. So it's easier to keep liquidity in range. Now, Aqua doesn't reduce the need to manage your positions. There is still some management necessary here across your portfolio. But because your capital is active across multiple positions at any one moment, you have more opportunity to earn fees where your capital is in range. There's flexibility with Aqua. You can create or cancel a position in one transaction. And we've talked about fees. Every position carries its own fee and gas range. It's a fully self-custodial system. Tokens stay in your wallet, under your control, and you have full utility. There's also protection from just-in-time fee sniping by design, unlike pooled AMMs. The working principles of Aqua are, as I've touched on, verifiable configs. When a liquidity provider ships a position on Aqua, every position is an immutable hash-addressed config that can be verified by them before signing. Permissions are revocable, with one allowance per token per chain being needed by the liquidity provider, and the wallet balance is the binding limit. You can revoke your permissions at any time, and swaps will stop filling instantly. Swaps are filled by verified counterparties, meaning that swaps that fill your liquidity are routed by 1-inch resolvers. These are market makers and arbitrage traders verified by 1-inch compliance. And the system is fully audited by some big names in the space. Although I should remind everybody that with any DeFi project, risks still remain. These audits do not remove risk entirely. When we compare Aqua against traditional models, we see that Aqua is fully custodial. Tokens stay in your wallet. This enables liquidity reuse with that balance backing many positions. Pricing is configured when we ship a position through programmable on-chain logic, with positions being immutable. Your fee is set per position, paid only to you, protected from fee sniping by design. As I've touched on, approvals are one revocable allowance per token per chain, and this is fully transparent. Aqua is fully on-chain, and configs are verifiable before signing. So Aqua is now live. You can go to oneinch.com/Aqua and see and play with Aqua right now. We can take a look here. When you access the UI, you'll see that you, as a liquidity provider, can create a position. You can pick a token pair and a position type. You can choose from straight, curved, or pegged pairs. You can configure your own fee. You can take a recommendation on that, or you can customize that. You can size the position against the tokens sitting in your wallet already. The UI, I feel, is particularly intuitive around the customizable aspects. All the lines can be moved, and we really appreciate any feedback that you have on this, any additional features you would like to see here. You can ship your positions, as I've mentioned, without any tokens being transferred. No deposit is required. Shipping merely registers the position on-chain as that immutable config. The only permission you grant is the token approval. So tokens stay in your wallet and are used across many positions. Your same wallet balance backs every open position in your dashboard at the same time, as you can see here. Swap fees land directly in your wallet, ready to use as additional liquidity. Aqua is live on 13 chains already, including Ethereum, Base, Arbitrum, BNB chain, and more. It's available for 3 wallet types: EOA, smart contract, and MPC. And what's more, 1inch is running a liquidity incentive program for active Aqua providers to the tune of 10 million 1inch tokens. Please try it out. Let me know what you think. We're very happy to hear from you. My email is here, h.atkinson@oneinch.com. Feel free to get in touch. Thank you very much for listening.
All right, all right, all right. How's everyone doing? Good to hear. Getting your lunch. All right. Well, hi, I'm back. I'm Steven, if you don't remember me from earlier. I am now the new MC. So I'm very excited to bring out our next panel. Excuse me as I crib from these sheets here, because I am just getting to my new wall, slightly behind the ball. Okay. This next panel is on institutions and tokenized markets. So moderating this panel, we have Tony Pecore, EVP and Head of Investment Management at Franklin Crypto. And on that panel, we have Pei Chen, the CEO of Theoric, as well as Carl Jaeyong from Anchorage Digital. And last but not least, Bruno Faviero from Kraken. Excellent. I'll leave it to the team.
All right, thanks, Steve. Good afternoon. Lunch is coming shortly. Steve had the quick intro. Why don't we each take 20 seconds just to say a little bit about what our firms are doing in the land of institutions and tokenized markets. I'll start. I'm Tony Pecore. I'm the head of investment management at Franklin Templeton Crypto Division. We have early stage VC funds. We have tokenized we famously have tokenized a money market fund, which we can talk about as a group. We have ETPs, and we have liquid token strategies, amongst other things. Pei.
Thanks, Tony. Hi, everyone. I'm Pei. I'm the CEO at Theoric. Theoric builds a AI-augmented vault curation, starting with ETH and tokenized gold vault. We've been in the space for a while, and then looking at the growing TVL and size of the tokenized markets. I'm very excited to talk a little bit more about how we approach this massive market opportunity and how we think about partnering with regulated and large players like custodians and asset issuers, tokenization platforms, as well as distribution partners like fintechs and exchanges. So this is all the right audience here.
Hi, my name is Carl Jaeyong. I head up the institutional and protocol business at Anchorage Digital. Anchorage is a regulated crypto platform. We operate a federally chartered bank in the US. We offer custody, staking, trading, settlement, financing, stablecoin issuance to both institutional investors and crypto founders.
Yeah, and I'm Bruno Faviero. I lead institutional business development on the Kraken institutional team. Effectively, we're sort of a crypto prime brokerage where I focus on the qualified custody business, but we also provide to our clients OTC trading, API trading, and lending. And I came into Kraken via acquisition of the company that I founded, Magna, which did protocol technologies for token cap table management.
All right, so we've got this thing called blockchain. Let's hold that. We also have $150 trillion worth of equities in the world and $150 trillion of debt in the world. It seems like we should be able to put something together here. I think of digital ledger technology. What's the big deal? It's a distributed database. Everybody can see the state of play. You have instantaneous settlement. That's interesting for finance. And you have smart contracts. That's a nice feature set. Again, that feature set plus $300 trillion worth of something. Again, we should be able to do something interesting. I want to give one quick anecdote, and then I'll put some questions to the group here. Despite everything I just said, Franklin Templeton, in concert with Canton, with TradeWeb, with DTCC, SocGen, basically a whole lot of, let's call it the TradFi franchise members. We did a trade 4 weeks ago where we simply bought a tokenized T-bill with a stablecoin. and this was the first time it was ever done. I'm going to tell my grandkids this. They may not appreciate it. But as we've been building here for 10 years, in many ways, it almost feels like just now we're getting to the point where we can actually access this $300 trillion of tokenized assets. Pei, what do you think the unlock is? Like, where are you seeing clients just tripping over themselves at this opportunity?
That's a great question. So the way I think about it is like, when there's a lot of components, right? We're talking about the whole RWA stack or tokenized market stack. The very first thing that I felt like the fundamental change that tokenization was able to give us is like a programmable settlement layer. And then that is the Ethereum mainnet, that is the layer 1, layer 2s. And this settlement programmable layer really unlocks something downstream, not upstream, because I think the front desk still remain kind of similar. But the downstream is the implication, as you mentioned, you have Benji, right? $2 billion market cap, a very liquid and very highly usable asset. Previously stays on traditional rail, but now it's programmable rail. So it becomes instantly overnight a usable, movable collateral across different platforms. Now that as a curator, as an exchange, or just the holder of this collateral, you can now move it and then you can borrow it against stablecoin, you can leverage looping, and you can deploy across different like strategies. And that I think is like the huge unlock. And obviously there's other ways to think about it. The distribution implication of it, that the TradFi now can touch cross-border, much greater user and holder base, not just in the US, but like globally, right? That's massive opportunity as well.
Yeah. Carl, what are you seeing is uptake for these tokenized real-world assets?
Yeah, absolutely. Definitely +1 to everything that Pei said. Yeah, I mean, I think collapsing down the settlement where there's one single source of truth, rather than in traditional markets, all of these are separate databases, right? The exchange, DTCC, transfer agent, and they need to reconcile. And the time to reconcile is what causes a lot of the friction. When you collapse that, it makes collateral management, it makes the ability to meet margin calls, to reduce the opacity around creditworthiness, and all of these things opens up, and it reduces the friction for how liquidity flows. I would say that on our side, that collateral management piece is probably the thing that's most compelling to our clients. And I would say the kind of the counterpoint is that what we had originally assumed was one of the biggest unlocks for tokenization in the early years was around liquidity. But what we've now witnessed is that tokenization doesn't solve liquidity. Liquidity is ultimately a demand and supply problem. Tokenization reduces the friction and makes the rails easier, but you still need that kind of table stakes demand and supply in order for an asset to be liquid. And which is why stablecoins has kind of been the first thing that achieved mass adoption.
For those in the audience that, I'm going to give you a quick example of what collateral management even means. There's no reason anybody should know it unless you've been dealing with it. If I put on a futures position, I need to put down some margin. That's one part, it's called initial margin. In the old days, you'd pledge some T-bills. Now, you can pledge some tokenized collateral, which maybe is a tokenized representation of T-bills. The next thing you do, as your position goes up and down, every day you have to move money back and forth to make sure your variation margin or your margin is where it needs to be. So now we're just an exercise of moving dollars or some good collateral just back and forth every day. Gosh, it seems like a smart contract should be doing that. I mean, that's just one very simple use case. So frankly, that's Franklin's first product market fit that we're seeing is just in that use case. Pretty simple. And there's cost savings. I mean, another thing I remind myself is that a basis point on $1 billion is $100,000. So that's a lot of money for a trading desk and so on. So cost savings, I think makes sense. But then there's what does the technology unlock? What are some new products, some new features that can create value out there? Bruno, what are your thoughts there?
Yeah, I mean, I think part of what Carl said is what's making these institutions more comfortable with exploring new products, because once you have that reporting transparency, not just in the collateral management, but where the assets are actually deployed, where they're utilized, exactly what are the margin call rules, where does the yield come from, what are those markets. We're finding that managers are very discerning about, being picky around where they're deployed and underwriting the risk of the exact vault protocols or lending protocols. And I think that's where we're seeing institutions start to look to is, how do we take these assets that maybe are sitting in custody and how do we deploy them into yield-bearing vaults, into lending markets? How do we borrow against them on-chain, on Aave, on Morpho? Right now at Kraken Institutional, that's the new category of products that we're building. It's around DeFi accessibility and DeFi utility, but institutional grade, right? So, they're sort of whitelisted vaults. They're not commingled with potential bad actors. Everything is transparent. It's you can build a dedicated vault per client. I think being able to take the best of crypto, but still give them those compliance and regulatory assurances. And we're seeing people go deeper and deeper into the crypto waters.
Right. Pei, maybe same question to you. Cost savings, obvious. What new sources of value are out there? Maybe even touch on, for the audience, maybe what is a vault? What is a curator? How do these tokenized assets fit in there?
Yeah, the reason that people call it a vault is to give you like this a mental picture of like this is a vault, right? It's like a physical vault, but it's actually just like a set of smart contracts that administrate the deposit, withdrawal, the cash, the waterfall in the traditional securities, and how you and also like taking a step back, the ERC 4626 essentially introduces the concept of vault shares. So you can deposit any digital tokenized base asset, and you get back a share of that vault, basically a share of that all the asset value inside the vault. And the curator's job, there are I think a spectrum of curators out there right now. There's the more commonly known as a risk curator who operate a vault on Morpho, right? It's an on-chain credit markets where their job is to make sure when they get this stablecoin liquidity from LPs and they deposit they lend it against the credible collateral owners. So let's say there's like OTC private credit loans, and there's the money market fund tokens, or there's a T-bill, tokenized T-bill versions. And then there's another set of curators, which is more like Theoric is doing, is that we are taking in right now a tokenized gold asset, which is XAUT. So XAUT is a tokenized gold that is backed like one-to-one on gold, physical gold that is like stored in a physical vault in Switzerland. But essentially, our job is taking the XAUT and then use it as collateral. Again, collateral comes a lot in this debate and the conversations, and borrow against stablecoin. And then you can deploy the stablecoin into different on-chain yield opportunities. There's lending arbitrage, and there's Pendle PT markets, and there's the basis trading strategies that you can deploy onto DEXs and perps to create like liquidity provisioning yield as well. So all of that is use cases coming back to your point of like, what is use cases that you're unlocking from those like traditional assets that you can't do currently? Because right now what you can do is like, the vault essentially is observable on chain. We are on chain vault, so every position we deploy the stablecoin against, you can observe it on chain in Dbank or whatever, which traditionally you can't do on the off-chain world.
So I have a question for you, Pei, and everybody just sort of jump in here. When I hear the word curator, and you're curating tokenized assets, I want to jump to just the word asset manager. Is that fair? You're the portfolio manager, in essence? The curator is the portfolio manager?
This is a very, very good question that you touched on, because like Commissioner Hester just came out and made a bunch of comments, right, on curators and vaults and lending strategies. I'm sure Bruno and Caio have a lot to say about that as well. My reaction to that is, yes, certain curators are asset managers, but it really depends on the details of the design. And the design choices make all that difference. So traditional asset managers or hedge fund managers, they take LP's money, and it's a closed-ended conversation. Like, relationship is you take the asset, and then that's kind of the end of relationship for now, right? And then you don't know where they're gonna take it. They fully custody the collateral or the asset, and then they make all the investment decisions, and then you return, everything is coming from that end. The difference on on-chain curators, like most of the time, the curators work with Upshift and other vault infrastructure providers or custodians like Anchorage and all. They're never able to take the asset out unilaterally.
Mm-hmm.
They never are in full custody of the base asset. And that is by design. We work with Fortify, we work with Upshift, the vault operators, so like all the policy is enforced through three-party coordination, and the risk parameter is set and approved by external parties. And I think that's like a very big difference, right? Asset managers and curators are different in that context.
Yeah, so these are things that have to be.
Like,
go ahead.
No, I was going to say one of the unique things in crypto, right, is exactly what you said. Like, you can dictate exactly what contract function calls a curator is even allowed to make. And so you can have a curator that, for example, is only allowed to go in and out of a specific pool, right? And so their only discretion is, are they looking out for market runs? Or are they looking out for an Oracle issue? And the difference there is, if you invest in a traditional finance asset manager, theoretically they have the discretion to do, whatever they want. They tell you what they're allowed to do, but within crypto, you can actually put that into the code. So we work with Upshift, who's our vault provider, but then, we can go to a client and say, if you like this strategy, great. The curator is literally by the code not allowed to do anything else with your assets.
We always come back, Franklin Templeton's been around for 80 years and regulated by the SEC all those years. We come back to who's the fiduciary. In other words, who gets sued if they didn't do what they said they were going to do. I don't know the answer to that in curator land, but things we're thinking about. Well, one thing we do know is that if we're going to run other people's money, assets have to be held in a qualified custodian. And I know both Anchorage and Kraken are qualified custodians, have qualified custodian prerogatives. It's an important rule, it's an important statement, and we have lots of partnerships together based on those. I want to move to just thoughts on value capture. So every new technology creates wealth if it's done right through shifts in productivity, if I could oversimplify it all. There's going to be a speed up. There's going to be new value created here. Who's going to capture it? Who, how, and when? Carl, what do you think?
Yeah, it's a great question. I think ultimately the value will accrue and should accrue to the investor, because that's ultimately where the assets end up, and they're the ones that are seeking alpha, looking for it to be productive. That isn't to say that all of the different vendors and service providers that leverage this technology isn't able to also accrue some value, right? So on the custody side, the way that we sort of think about it is there's an element of composability and neutrality, right? Where we are looking at multiple ecosystems. We're not trying to pick a winner, but we want to make available the rails for the investor to interact within all of these different ecosystems. And on top of that, on top of custody, you build prime services, which is really where the value comes from. And the ability to basically cross margin and achieve capital efficiency, which is ultimately what the purpose of a prime brokerage is. And I'll give you a concrete example, right? Kraken's team, Bruno and his team are going after tokenized equities in the form of X stocks. Extremely good team and very credible probability that they're going to win that space. On the other side of it, you have Hyperliquid, which has already started to show product market fit for perps on single stocks. Today, if you wanted to run basis on single stock, there isn't a capital efficient way to do it. You have to trade your tokenized single stock equity spot in one venue and then trade your perps in another venue, fragmenting your liquidity. If all of that can sit within custody and have the cross margining built on top of it, you actually open up this whole new class of trading, right? Where you can now bet on things like earnings uncertainty, volatility, bio stock PDUFA dates and drug approvals, and put basis trade and trade funding rate arb against implied volatility in the option markets. That all opens up with tokenization and with the custody layer kind of holding all of that together.
Right, so that certainly is unlocking new investment style strategies and a way to, I guess, distribute risk. That's,
absolutely,
you know,
absolutely.
That's a positive. What do you think, Bruno? Who captures the value?
I mean, I think Carl's exactly right. Like, you create these net new products that weren't possible before that now can be executed in a capital efficient way. And that is actually exactly where we're seeing institutional interest in these tokenized equities. We have these hedge funds or even crypto liquid funds that now are trading tokenized equities, right? Not even limited to crypto native assets, where they're running this trade, where they're long the spot, they're short the perps, but then they go one step further, where we now have X stocks yield vaults, where they can deposit that long spot leg into an on-chain vault and earn a little extra 1%, 2% on that position. That can make a real material difference on what they're doing. And so I think expanding that type of intersection of TradFi utility, settlement, collateral management with the DeFi utility and composability, where they can use our vaults, they can use other vaults, they can move it to other wallets and other DeFi protocols, gives a lot more optionality, and I think ultimately expands the universe of players that can run those types of strategies. And so X stocks are available internationally, and I think that's where we're seeing a lot of the growth, and people that maybe weren't trading in these markets before that now have a universe of possibilities open to them.
Right. Another sort of thought experiment we've run internally of consider not tokenization but containerization. Container ships, Maersk, all the usual parts of that stack that you know, basically unlocks global trade. We get our iPhones effortlessly, but it was the invention of the humble, the humble container. I don't know the market cap of Maersk or any of the container manufacturers, but I suspect it's far less than Apple. So just an idea, you know, value has been created, great common good. I think Apple arguably wound up with a lot of it. So we'll watch that. We have 2 minutes left.
I wanted to just maybe try and chime in there, right? Because I think custodians and exchanges, they're effectively the distribution layer. And I do think distribution layer is going to be one of the biggest winners of this wave and this stack, right? Because that's always the case. A distributor, Apple, whatnot, like they win big. There's another, and on the top of the stack is tokenization in this context, right? So tokenization infrastructure is very important. That was kind of the whole reason we're here to talk about this. They may get commoditized over time, but doesn't mean it's not important. It's super important. They have all the licenses they have, and they are super regulated. The KYC, KYB, insurance, all of that is there. And then there's a middle layer, the middleware, which I believe is also the layer can capture a lot of value or accrue a lot of value. That's the risk intelligence. So think about when ETF came, right? People have been buying stocks since its inception, but ETF came along and just wiped out the commission fee. The reason is because they can make money somewhere else. You no longer make fee from like buying and selling one stock that's holding users back, but you are packaging them into the ETF basket and you charge expense ratio, whatnot, right? And that's super smart. And that's kind of like what we are going through right now, is that we're going through that ETF era chapter with tokenized markets. You can now structure credits within a container, so to speak. And then, but you have to be able to manage the risk that comes with it. There's a ton of risk with RWA assets. We have to develop a standardized framework to evaluate them. What do you look at it? Oracles is like a big, big gap as well, right, for off-chain RWA sleeves as well. And I think that's where some other players can come in and capture some value.
I think it's a great point. I want to end on a slightly speed round question. Bitcoin's at 65,000. Is it going to touch 55,000 or 75,000 next? Pay.
Always the higher to the
75.
right.
75.
75.
Gotta go bullish.
75.
All right, mic drop. That's it. Thank you, everyone.
Not financial
Thank
advice.
you.
Not financial advice, exactly.
Hello, everyone. Did you enjoy that? Was that a good panel? Sorry, AV team, for yelling in your mic. Great. Well, that was awesome. We have one more panel before lunch, and this is a hitter crew. You're not going to want to miss it. If you're standing in the back, it would not be rude to come up and sit. It would be fine by me. So feel free to fill on in. Let me introduce our panel. So first up, we have Nikhil Viswanathan, co-founder and CEO of Alchemy, as well as Bo Koteka, the co-founder of Paxos Labs, and our moderator, Chris Ahn from Han Ventures. So let's give it up for this killer panel. All right, take it away.
All right, my name is Chris. I'll be moderating this panel on institutional infra, and I'm excited to have here with me Nikhil from Alchemy and Bo from Paxos Labs. Maybe we can start with some very quick round of introductions. Nikhil, when an institution comes to you and says, I'd love to implement stablecoins, tokenized assets, or blockchains in some form, how does Alchemy help them with that?
Yeah, so first off, it is crazy. I literally spent 6 years at Stanford, and I've never been inside this building, the faculty club. Though I do see one of our professors, Dan, here. How many of you, raise your hands, how many of you are Alchemy users? We got some? All right. We got a couple of people. So the way to think about what we do at a very high level is pretty simple. So in every big shift in technology over the last 100 years, there's been a platform that let people build apps. For the computer, that was Windows and Mac, the operating system. And what it does is it hides all the complexity underneath and lets you really easily build apps like Word, Excel, Chrome, what we know and use today. The second piece for the internet, there is a company that you've heard of, that you've never heard of, called Amazon, and it actually runs the entire internet. So I think most people here know that Amazon Web Services is the infrastructure that powers DoorDash and Uber and Lyft and so on and so forth. For crypto, we're basically that layer. Anytime you open Robinhood, or you use Coinbase Wallet, or you use any of the Stripe services, like that's us underneath the hood powering that technology. So in terms of the question you asked, when a bank like JP Morgan or Fidelity or Franklin Templeton comes to us, we provide them infrastructure that lets them read and write data to the blockchain effectively and safely.
That's a great answer. Bo, over to you.
Yeah, so great to see everyone. Thanks for having me. I feel very honored to get into the faculty club at Stanford on one of my first few visits here, but it's great to be back in the Bay Area. So we have a lot of different conversations with enterprises around stablecoins and tokenized assets, and usually the journey starts in one of two places typically. I either want to issue or adopt stablecoins, so I want my own stablecoin, my branded stablecoin, or I want to more efficiently adopt stablecoins to my platform. I want to build around them, I want to integrate them into the kind of dollar flows on my platform. So that's kind of like starting point one, and then starting point two that we see a lot of is, hey, I'm a consumer fintech or a brokerage, and I want to enable access to crypto assets, buy, hold, sell. Right? And so that's usually where we see the starting point of the journey, and that's a lot of the times where Paxos helps people start their journey on chain. And then on the Paxos Labs side of the house, we're really about like, okay, well, once you have a stable coin, once you have Bitcoin or digital assets, what do you do with them? So anyone that's been in crypto for a while, you understand, you don't just hold the asset, you want to go do things with them, whether that's move them, monetize, trade, earn yield. And that's what we're building on the Paxos Labs side to help kind of enterprises take that next step on their on-chain journey.
Awesome. And maybe just to dive into that a little bit further, obviously we hear a lot about stablecoins, we hear a lot about tokenized assets, especially from institutions. What types of use cases draw them in first when you talk to them? Is it payments functionality? Is it some form of yield functionality? Like, how does this fit into their businesses? And actually, as a part of that, it would be helpful if you can also share, are these banks, are these brokerages, are these startups? Just a little flavor of the types of folks that are asking as well.
Sure, I'm happy to go first. I mean, there's a range, right? I think if you look at some of the brokerages, they really look at the first step into crypto as like, hey, this is a new asset class that my users want exposure to, that want to trade, et cetera, et cetera. And then you also do have the fintechs who are really around building a consumer experience of money movement, right? And again, I think it has gone from, hey, I support all these different payment rails or all these routes, and I want to add stablecoins as a route, to actually, I am building from the ground up around stablecoins. And so those types of companies are really interesting to us, and obviously like the ones that are adopting it are as well, but the ones that are building ground up from stablecoins as their core kind of like ledger technology, they end up needing a lot more than just, hey, help me add stablecoins. They're saying, hey, how do I orchestrate and move between stablecoins? How do I optimize kind of the yield holdings on my platform? How do I enable trading against the stablecoins? And so those conversations are really interesting, but it's really quite a range.
Great answer. I think maybe to add a zoomed out version of this, there's really two major shifts that are about to inflect the trajectory of crypto. We've already seen the kind of start of the acceleration, but we're just about to see the inflection here. And those two shifts are agentic commerce and crypto becoming the backbone of finance. A little about the first one. Today, if you have an agent, it can answer a question for you or look up information very effectively. But if you wanted to go buy something for you or have it pay another human or another agent, that's actually very, very, very hard to do. I spent a bunch of time over the last like 9 months OpenClaw hacking, and actually gave my OpenClaw a credit card, and he ended up doing some crazy stuff with it. And it just, as you actually go experience this, you realize very quickly that if you live in the United States today, you don't have the experience that the rest of the world has in terms of money and moving money around. I actually go challenge you. Go today in 2026 when you're traveling and try to pay another person in a country without giving them cash. It is like almost impossible to do. I almost like didn't make my flight back from one of our teammates' weddings because I didn't have cash to pay the cab driver. The banks weren't open. I didn't have the right debit card, and I literally had to tell this guy, I promise you I will get back to America and wire you money. Luckily, he let me do that, right? So I think agentic rails is what the future of finance is going to be built on. Sorry, crypto rails is what the future of agentic finance and agentic commerce is going to be built on. It's 24/7, it's global, and it is not, you don't have to be a citizen of the United States to use that system. So that's one piece. The other piece is, in terms of financial adoption, institutional adoption, there is a massive flip in the risk-reward ratio and in terms of whether institutions are excited about being crypto. There was always this, hey, this is a kind of cool technology, it could disrupt our business, but the two challenges were, it was unclear how you would actually make money from it. If you're JP Morgan, you're making like tens or hundreds of billions of dollars, like why do you care about this tiny crypto thing? And then the other part was, it was this really scary regulatory regime, right? For this little science experiment that 5 people at JP Morgan are doing, you could get your whole business audited and have severe financial impact for your core business, which is like scary. Any rational person, the banks, I think a lot of times there's this narrative that the banks are dumb. It's like not actually the case. They're just kind of rationally acting in terms of their core business. Today, that risk reward has flipped. The banks who, if you have a financial product, you're typically taking small number of basis points on in terms of yield for services you provide. However, if you look at a Coinbase or Robinhood, you can take like 3% on staking, right? Which is crazy. That's almost 100x of what you can make in the bank's financial services. So, and similarly with the new regulatory regime, knock on wood, clarity passes in the next week, we'll see. But that risk-reward ratio is completely flipped. And as a result, Genius was the first kind of stepping stone in that. And I think with clarity, we saw a massive influx, I'm sure you guys did also, of banks and institutions coming into the area, into the industry. And then with clarity, we're going to see, hopefully, the floodgates completely open.
Just to add to that, I think it's interesting that you show the example of like the monetization, right? Because when we do talk to banks, I think previously it was there's someone internally that had to kind of stick their neck out a little bit to really fight for crypto adoption. But a really interesting narrative we've been able to go show them is like literally just bring them the Coinbase earnings report and be like, hey, lending on chain is a 9-figure business. Staking is a 9-figure business. Stablecoin swaps is a 9-figure. And like you basically just show them, it's like, hey, like there's a huge revenue opportunity for you to jump in. And so that equips that person at JP Morgan or whatever to like stick their neck out a little bit more and be like, hey guys, there's a real economic case for us to go after this, right? And start building in this space.
Totally. And I think one of the coolest things is once the largest institutions have done this, you look at JP Morgan, they have their deposit token. Fidelity has done a bunch of stuff. You guys are powering Schwab. And these are the brand name household financial industry players that everyone else in the industry looks to for guidance. And we have cleared that hurdle. If you remember in 2021, 2022, Jamie Dimon literally called Bitcoin like a Ponzi scheme and crypto a scam, and now the fund is, or now the bank is leading the way in that. So it's really, really exciting.
Yeah, I think it's a combination of things. As you know, to summarize, I think there's obviously regulation with the Genius Act that's helped. Obviously, there's proof points in terms of the actual economics that's helped. And then lastly, there does seem to be also this potential big platform shift happening where agents are going to be transacting in greater volume in 5 years than they do today, and blockchain infrastructure could be really impactful for that. So I think that all resonates. Speaking of institutions and enterprises, I think one thing that we've seen the revival of is this idea of the enterprise blockchain. So of course it's, we've had a phase of this, many years ago, and we seem to be in another phase. It's a more modern one, but examples would be Stripe has created Tempo, Circle is creating Arc, Robinhood recently released Robinhood Chain, and there are more that have yet to be released that are on the way. When does it make sense for institutions to build their own infrastructure and own it in this way versus when does it make sense for them to use some form of public infrastructure, say Ethereum or Solana or some other chain?
Sure. Yeah, I mean, I think where you really have to start with, and again, for any chain, forget like, enterprise chain or otherwise, the hard thing is, do you have the ability to get distribution, right? And I think a lot of the players like a Robinhood or a Stripe actually can flip a switch and turn on distribution overnight. And so for players like that, it may make sense, right? And I think it does make sense in a lot of cases to say, hey, I already own the distribution. I want to verticalize the solution. And I do think there's an economic reason to do so. And I also think there's like a user experience reason to do so, right? Where I think some of the best brands that own distribution are meticulous about the user experience that they have, and so more of the stack that they own, they can control that, both from an economic standpoint and an experience standpoint. But to me, it is like you kind of, if you have the existing distribution, then it makes sense. If you're kind of saying like, hey, I don't actually have a way to like flip a switch and onboard users and capital into my chain overnight, like I think you're fighting an uphill battle then.
It's super interesting to hear about, to think about Robinhood Chain. I think this is a perfect example. Funny story, so Vlad and Vaiju, the Robinhood founders, actually lived in the same dorm as me, just down the street here. They were a couple of years older, so, but then it was like this kind of lineage that happened. So Robinhood, 3 weeks ago, had no users. Like the chain didn't even launch. It wasn't even public yet. And then as of last week, they became the #1 used chain across like all of crypto, which was absolutely wild to see. Obviously, that's going to spike and flow and ebb and flow, but just thinking about the internet days, most people here probably are too young to remember this. I actually was too young to remember this, but I've read the history. Before the internet, there were several different networks. There was AOL, there was MSN, these like kind of walled gardens where you got your information. And it was not clear that the internet, the open public internet, would win, right? And I think that you saw a similar thing in crypto. In the 2017 to 2021 era, there was this concept of, like you said, enterprise blockchains, but they were closed systems that didn't really interoperate with the rest of the world. And I think one big shift we've seen on the infrastructure side is it is no longer closed systems. Even all the ones you mentioned, Tempo, Arc, Coinbase, Base, Robinhood, they all interact with kind of traditional blockchain infrastructure. So I think the first thing we've seen is a big shift to the open infrastructure. The second thing I will say is, and we talked to, was just talking to one of the largest banks in the world last week about potentially doing their own blockchain. The thing that is really important to understand is we are so early in crypto. The first neural net paper about AI was written in the 1940s, I believe like 1947-ish. And 80 years later, we are achieving the kind of overnight success of AI. Crypto is still super, super early, and that's an incredible opportunity. What that means for you as an institution is it is up to anyone who is going to dominate the future chain infrastructure. So if you are a large bank or you're, like you said, someone with distribution, it is game time, and you should go try to do it. Like that's my advice to everyone. It doesn't mean you're going to win, but it is very much an open battle still, and is not a clear winner.
Right, and I think the people that are doing it well, and again, like you said, like Robinhood Chain has had an incredible launch. I think they got a lot of things right? They actually did think about, and this is something that we helped them with, was, hey, how do you actually move volume of stablecoins from Ethereum to Robinhood? And the other way too. They understood that, hey, you actually want this to be a bi-directional connected ecosystem. And so that's one of the products we launched alongside Robinhood Chain, is our transit product, which is moving between stablecoins across ecosystems at a fixed predictable scale. But they understood the importance of interoperability with the existing ecosystems. And so, yeah, you can't launch on an island today in crypto, but if you have the distribution and you are willing to build kind of the interconnectivity with existing networks, you have a real chance of success.
I think one of the things that we've been touching on here is actually just how sophisticated also these companies and institutions have gotten. And I think if we rewind a couple of years ago and you were to ask yourselves, well, institutional adoption will come at some point, but I still believe that startups are going to be the ones to shape this economy because they just understand the opportunity better. It is a material paradigm shift. Today, is that still true? Do startups still have a chance as these incumbents get smarter, they have the distribution, they're going all in?
Yeah, I think the short answer is absolutely. I don't think this is specific to the nature of crypto or this moment in time. Startups inherently, for two properties, will always have an advantage over. Obviously, incumbents have a lot of advantages, but there's a reason that startups will continue to win. One is speed. Like the only weapon you have as an early stage startup is speed. You can move faster, and that's basically it. But it's the most important weapon. The second one is there's always the advent of new technology. If you talk to these banks, they're scared. Their entire business model that has lasted for 100 years is potentially about to be upended, right? And as a startup, you're not tied down with all of that baggage, and you can innovate. Speaking of, Schwab did this. Schwab had a new structure to a business way back in the day and offered much lower fee trading, right? Then Robinhood comes and has like a totally new business structure with the internet and doesn't have physical locations and says we can offer free trading, right? And has a new business model, and so on and so forth. And maybe Robinhood gets disrupted by the next wave of upcoming finance companies. But I think the key thing here to understand is that even though, and this is something that we see because we see all the data, no one else in the world has seen this. I don't think I've said this publicly, but the market is down 60%. We are in the depths of the bear market. This is, the time in the cycle, and everyone's like, I can't believe you're doing that magic internet money thing. That's such a scam. Why aren't you doing AI? And the thing that we always look at as the barometer of how the industry is doing is, are developers and startups building in the space? And the part that's absolutely crazy, we're probably going to start being a little more public about this, but you guys heard it first, is we have seen a doubling in the last 12 months of the amount of compute that developers are using. So think of it as like number of tokens in AI, amount of compute in crypto. And the number of teams in the last 12 months has not declined like 70%. It's actually gone up about 30%. And the total usage of the industry has gone up almost 2x in the last year, which is like crazy to see.
Yeah, and like maybe just another supporting data point there. I think developers is one metric to look at, but we've also looked at our enterprise sales pipeline. And if you over the last 5 years, if you kind of mapped it against like market trends, it almost would go in line. When the market was running really hot, there'd be a lot of FOMO, and even enterprises would come and be like, I need to do the crypto thing. But over the last 2 years, despite the market being down, the enterprise sales pipeline is just up and to the right? And so like they're clearly seeing the value outside of kind of like the quick grab here. But back to your like original question, like my opinion on like can startups succeed in this space is like a little split for a couple reasons, right? I think versus other technology shifts, anything to do with money, I think is like just very treated very differently. When there's a new social app, there's a new mobility app, I think people are much more willing to go give it a try. When it comes to actually moving your money and your livelihood to a new place, I think there's just such a high barrier of entry. And so I think that is a challenge for maybe consumer crypto or consumer fintech. But on the other side of it, and again, maybe I'm a little biased, we're both here, infrastructure providers, I think the infrastructure space is absolutely being led by startups because they have the edge of speed. They have the edge of understanding how things are moving. And combine that with enterprises wanting to move faster than ever, their ability to go build that infrastructure in-house is just not there. And so they're going to come work with the startups to build infrastructure layer and capitalize on their distribution, right? And so to me, it's like a little bit of a two-sided thing, but there's still a huge role for startups to play in the space.
I like the split take. All right, we'll wrap with the last question. I'd love one prediction from each of you. By 2030, what financial activity will routinely happen on chain that most institutions today would consider it's unlikely?
Okay, I think two things will happen by 2030. One, we won't use the word blockchain or crypto anymore when we talk about products. So you only talk about the end product, which is like actually the meaning of maturity in a market. No one ever talks about FTP or HTTP unless you're a super nerd like me. Most people talk about, Venmo and Uber and DoorDash. The second thing I think will happen is, and I think actually people like Xmoney and Robinhood and Coinbase are doing a great job leading this, you will be able to pay someone in another country. It'll just work, for the most part. And if you have one of like many products, right? It's not going to be this almost impossible thing like it is today.
My prediction would be that the default rail on any consumer or enterprise financial platform will be stablecoins. And so today, if you want to deposit stablecoins, it's maybe like a different experience. I think it will go to default to be stablecoins. And if you want to use a rail that's besides stablecoins, it'll be kind of the side route that you take. And so I think a lot of these platforms are re-platforming the assets they're using as their baseline very quickly. And I think by 2030, the stablecoin rail becomes default.
All right. Nikhil, both, thank you for joining us today.
Thanks for having us.
Okay, everyone. We have a really exciting two next panels. The first one includes Marco Chung, Head of Business Development from New York Stock Exchange, Helena Zhang, co-founder of ICME, Clay Maffett, Director at Coinbase Listings, and Rash Attar, our moderator, also from ICME. Here we go, guys. Take it away. No problem. And good, we're good.
Hi everyone, thanks for coming. This is a panel all about companies' road to IPO and the capital markets challenges that they face on that road. I guess we can start off with intros. Can each of you guys share a bit about your role, what you're focused on these days?
Sure. So my name is Marco Chung. I'm the head of business development for New York Stock Exchange in APAC and Middle East. So like my team mainly focus on secondary markets. But early this year, we also announced that we are trying to enter the tokenized security space. That's why I'm also leading this sales initiative, in Asia and Middle East.
Hi, I'm Helena. I am working on ICME. We are trying to imagine a new kind of shares market for pre-IPO equities.
Hey everybody, I'm Clay. I am at Coinbase and I run our listings program. So that's everything from evaluating and prioritizing new assets that we might add to our platforms, working with asset issuers to get them listed, and then also doing post-listing stuff, working with asset issuers on an ongoing basis, delisting certain assets, things like that. So it's half regulatory and half kind of biz dev.
Nice. Well, we can start off with Marco. Can you share a bit more about your blockchain strategy? How is NYSE adopting blockchain rails? And in what use cases does it view blockchain as strategic? What are the biggest benefits here?
Sure. So the New York Stock Exchange has been here for more than 20 plus years. However, we have always been innovating. So earlier this year, we have announced that we are trying to enter the tokenized security space. We are going to build an alternative trading system, an ATS, which is going to support tokenized securities trading. So on this platform, you're going to support three main features, namely the 24/7 trading, fractional and notional trading, as well as atomic settlement, which is like a very common in DeFi space. One of the reasons why we're doing this is that because we, as an exchange, we need to take a baby step, try to move to the DeFi space, because again, the world is changing, and that's why we need to move together with the world as well.
Nice. Clay, what's Coinbase's strategy for listing securities? Are you guys mostly focused on post-IPO, pre-IPO, or even before that? And talk a little bit about the challenges that you guys face with this.
Yeah, so right now we offer perpetual future equities for ex-US users. So we offered Anthropic pre-IPO. We offer it currently to ex-US users through our perpetual futures exchange. So that's stuff that we do today. And then we have other existing securities that we offer as perpetual futures. In terms of like on-chain spot trading of equities, that's a product called Coinbase Tokenize. We made some recent announcements, and we will hopefully be rolling out that product in the coming months. And that is actually tokenizing equity on-chain, where those tokens actually have the same sort of like rights and privileges as shares. So you have shareholder voting rights, you get dividends, and things like that. So that's a product that we're actively working on. That's a big focus for us. That will mostly be post-IPO, but you can easily imagine that that comes pre-IPO. The thing is, pre-IPO, there are more sort of regulatory restrictions that you have to accommodate. But ultimately, we just want to offer everything that traders want. And I think traders want pre-IPO access as well as post-IPO access. They want to have it on-chain. They want to have it custodial. And we just want to offer everything under the sun.
Nice. And Helena, can you tell us a bit about ICME? How does it work? What does it enable?
Yeah, good question. So we are more focused on the pre-IPO equity side. We, see this world where if primary issuance and secondary trading happens under the same venue, like New York Stock Exchange, we get a very healthy market. And to do so, we have been talking to regulators a lot. And a lot of the talking involves imagining what regulations could look like for pre-IPO equities that, honor Investor Protection Act and also honor the issuers themselves. And so we are imagining a world where, to power like perpetual futures, we will enable the spot price listing for all private companies under the sun. And in addition to offering the spot price, we're also, looking for ways to integrate closely to then migrating to ATS, like what you are working on smoothly when the company officially goes public.
Yeah, I think the consensus here is kind of that when it comes to pre-IPO, there's a lot more moving pieces that need to kind of come into place for all of this to work. Can you guys touch a little bit on the challenges and opportunities with respect to this? Is it more so the challenges around the plumbing and infrastructure of pre-IPO, or is it more so on the regulatory side? Marco, could you start off?
Well, I guess the function of exchange is mainly like a capital formation. The second one is like trying to maintain a fair and orderly marketplace. And the third thing is like how to facilitate price discovery. I mean, these are the three main features of an exchange. However, the other point I want to mention is that the role of an exchange is to protect both the issuer and the investors. Here we're talking about trading a lot. However, let's not forget that we are also serving the other side of the equation, i.e. the issuer. That's why how can we come up with like a model that makes sure that both the investors and issuers are feel comfortable. It's like one of the goals that we have to figure out.
Yeah, for us, we've just been in a lucky position where we've been able to imagine these capital markets from first principles because we, are able to observe the history of how capital markets have worked, what's been good, what we think are inefficiencies. And given that we have a lot of new blockchain technology that, points us into a future where we can have atomic settlement, we can perhaps bypass a lot of the inefficiencies that, currently want to be here because they're profiting themselves from the inefficiencies. We're able to take a step back and look at like what would the issuers want out of such a market, and what would the investors want? And so, one thing that we are very excited about is we think it would be wonderful if we can give issuers better incentives, such as offering them issuer royalties, or in other words, transaction fees. And, this would be a paradigm shift because it would essentially turn maintaining a healthy secondary market into something the issuer actually wants to do because they can get non-dilutive funding from it.
And Clay, would you like to share your thoughts on kind of the challenges in the space?
Yeah, I think many of the challenges are regulatory, and I think there are many great both regulators and companies working with those regulators to find a path forward. The Clarity Act is right on the 5-yard line at this point, and many international regulators are also trying to innovate and sort of catch up in this space. I think the technology, for the most part, is there or can get there quickly. I think you can develop software much more quickly than you can establish new regulations. And like the base chain, for example, has the B20 token standard that accommodates many regulatory considerations. And so I think we've got a path forward there. On the regulatory side, I think you guys are talking to different regulators as well, and whether through no action relief or written legislation, we need to basically bring some of the accreditation and transfer restrictions or purchase limits. It's like you could do Reg CF, Reg crowdfunding, but you can only raise up to $5 million. So how can you enforce that and then allow for those assets to then be traded in a DeFi environment? Those are the things that we're trying to sort of bridge the gap on, and I think we will make good progress. It's just everybody has to be patient, and we have to all work well collectively together.
Yeah, it definitely seems like the pre-IPO market is kind of where a lot of people are being underserved, and the way that people have kind of gone about getting their exposure to this is through synthetics. Do you guys think this is something that is good for the market, bad for the market? Do you guys see synthetics being something that are around in 5 years?
I think synthetics are the current best solution, perhaps, to the problem. I think the synthetics will always exist, but there will hopefully be, non-synthetic options that people can opt into as well. So I don't necessarily think they're bad. I do think that synthetics on their own, without kind of like the underlying being tradable, can perhaps create disconnection. There can be market manipulation. There can be problems with price setting and things like that. Yeah, I think that both will always exist, but both should exist at the same time. You shouldn't have either one or the other.
Yeah, like right now from how we see it is currently, retail is kind of like looking into this window at these high growth pre-IPO companies, and, they're like looking in, they can't really get access, they see the growth, they want access, and like there's a layer even below synthetics, I would say would be like, the third, fourth layer SPVs, the tender offers, the on forwards, and then beyond that, we see like kind of like an aggregation of the price discovery that happens among these fragmented markets reflected in synthetics. But like Clay says, like even then, the price is not quite accurate, and like oftentimes depegging happens, and oftentimes the issuer themselves will come out and be like, like this mirror token, this synthetic, like it doesn't actually represent our company value. And like, what is like a retail trader holding that synthetic gonna think? They're gonna be like, what is this? Like, what's happening? And so I do think the best way forward is to push regulations to enable a layer even beyond where like retail is not confused by what they are trading, and it's very clear that what they are trading directly represents the share and gives them rights and ownership. And yeah, we also are looking into the various regulatory exemptions. There's a couple we've looked into. We've mostly settled on one to allow for non-accredited investors to have a ability to participate in these markets, but definitely challenging, but something that we're excited about.
Yeah, I mean, as she rightly mentioned, testing. As you rightly mentioned, like we talk about investors. You want to know where your fair price is. On the flip side, as an issuer, because like many of the people here, eventually going to be a startup founder or going to be a CEO of a firm, You also want to know like what's the fair value of your company is, especially like when the valuation on different platforms, on different products varies, it's going to be a headache for you to raise fund. Because when you talk to your investors, you want to be able to tell them that here's the valuation of my company. But when investors look at different platforms, they have different prices, it becomes a headache for them to realize what's the fair value of the company going to be.
Nice. And I guess now that we've touched on synthetics, we can kind of talk about perps as well. I know, Clay, you touched on this a little bit, but generally, do you guys see the perps market as competitive or additive? I guess, Clay, do you want to start?
I think it's additive. I think that, I think from a regulatory standpoint, it's perhaps faster or easier to spin up perpetual future markets in certain areas. I think that perps move quickly. I think Hyperliquid is evidence of how perps in DeFi can be, can generate a lot of liquidity and activity. So yeah, I mean, like synthetics, I see perps as something that is additive and perhaps even complementary, and a sign of just sort of like a healthy capital market. So yeah, we lean into perps for those that want to trade perps. There's insane amounts of volume internationally for perps, but we also think that spot ownership is incredibly important as well. And then when you bring things on chain, you want to use things as collateral on chain and whatnot. That's obviously important, and that might not be provided by perps. So they're just different, and it depends on what you're trying to accomplish.
Alina?
Yeah, we believe in perps as well, specifically US regulated perps. We definitely see a future where, perps are going to be listed not just for the SpaceX, the Anthropic, but for earlier growth stage companies like, the Cognitions of the world, the Armadas, the Andurils. And, in order to actually have a perp price, you need a reference price. And so the question that we are tackling is, how do we provide the best reference price for perps to exist accurately and to, not depeg or to not just get manipulated. And yeah, that's my take on perps.
Marco?
Well, as an exchange, of course, we prefer spot rather than perps. Because again, we need to understand the fundamental differences between two products. Perps is more like a derivative, but spot is more like you're owning the company shares. That's why I think for anyone who wants to trade the two different products, they need to understand the fundamental differences between two, so that you know what you're buying, what you're trading.
Nice. And I'm curious to know, what regulations do you guys think are most importantly needed to change in order to support tokenized securities trading? Do you think there's much wrong with the current regulations, and do you think disclosures are too cumbersome for IPOs? Clay, do you want to start?
So really looking forward to Clarity passing. I think that's a good first step, but it doesn't necessarily get us all the way there in terms of tokenized equities. I think there's additional rulemaking that will happen after Clarity passes, as well as new regulations that will be required in the future. So it's difficult to say what specific regulations are necessary, but I think updates to things like Reg CF and Reg A for pre-IPO equity will be important when you start to create provisions that allow for that to exist on chain. So yeah, that's kind of the view there. What was the second question or the follow-up question?
Do you think disclosures are too cumbersome
Oh yeah,
for IPOs?
disclosures. I'm a big disclosures guy. Coinbase listings, you can imagine. I think the more transparency that asset issuers for either tokens or for securities, the more disclosures, the better. I don't think anybody really complains about S1s. Clarity conceptualizes a biannual disclosure and an at-launch disclosure for tokens. And that sort of creates or mimics to a certain extent the existing regulatory posture on securities issuance, S1s, and then ongoing earnings reports and whatnot. So yeah, big fan of disclosures. I think that it's good to get information and reduce information asymmetry and create honesty and enforceability in terms of what project teams are saying they'll do.
Yeah, and to add on to that, the day when we issue ourselves on our own platform and the day we, potentially IPO on New York Stock Exchange, disclosures is definitely something that, we respect and we want to do out of responsibility for the traders, the holders, and just for transparency's sake as well. In terms of regulations on securities, I think, and this is something we've learned from talking to various teams at the SEC, that if there's like a very shared mutual understanding on like one, like it's time to be innovation friendly. Like there's a lot of innovation going on. If the US doesn't capture it, people are gonna, trade on offshore entities. And like they're embraceful of innovation, and at the same time, they want to bring back, the dynamic we had earlier when companies IPO'd earlier, and like when retail had the ability to access companies earlier. And I think this is why they really love, what the New York Stock Exchange is doing, as well as, just they're very embracive of like seeing this vision of like a continuous path to IPO, where like perhaps like you can get mini public exposure, maybe at like, the 400 mil stage, which is when Microsoft IPO'd and when a couple other companies IPO'd around like 1990s, and then just imagining like stepwise what that would look like until the IPO stage. And so I think just like they seem to see what we see, and like convincing them of like their own rules or like potential rule modifications we've seen to be actually very effective, and they're so reasonable. And yeah, we happen to love the regulators.
I mean, working with the regulators is not something like new to us. We've been working with SEC, for a long time on different new products that we're trying to offer to the market. And back to my earlier point, I think as an exchange, as a responsible exchange, one thing that is important is to protect the investors and issuer, because like again, we have new technology, new products like offered to the market, but again, how can we make sure that we can protect like the user? Because what you don't want is to create like an environment or world that's going to harm the investors.
Clay, as Coinbase starts listing securities and Robinhood and other brokerages start listing crypto assets as well, how do you see Coinbase as differentiated? How do you stay ahead of the game?
Good question. Our strategy right now, for those that were not in the know, is the everything exchange. So we basically want to offer everything under the sun, as I mentioned earlier, from traditional crypto spot trading through derivatives into prediction markets, equities, pre-IPO access, capital formation, et cetera, et cetera. I think that Coinbase's advantage here is that we have the full stack. So we have Base. We have our existing best-in-class custodial products and spot exchange. We have relationships, good relationships, long-standing relationships with regulators around the globe. We have really strong engineering teams that are innovating in terms of our tokenization strategy and whatnot that bring a lot of this together. So I think that these are big pies, and I think that there are many different firms that can have pieces of the pie. I think Coinbase's strategic advantage is that we have expertise in many of these different areas, that as these, the crypto markets start to merge with traditional markets, we have expertise in both areas, which gives us the ability to win when those things combine.
Helena, you guys plan on having assets that are specific to your own platform only. Do you think that's enough to maintain your edge on your platform? Do you plan on listing the assets on other brokerages and exchanges as well, such as Coinbase? And how do you earn and keep that distribution in such a competitive market?
Yeah, because we are going after, such a wide range of issuers, I do believe that there will be issuers that are exclusively on our platform, and with that comes the ability to provide the reference price for perpetuals. I also see us integrating with the crypto exchanges the same way that you guys integrate with Kalshi and or Polymarket, and I, also see us just like funneling these pre-IPO equities to a stage where they are ready to IPO to New York Stock Exchange.
And Marco, 24/7 trading with near instant settlement gives higher trading volume, and blockchains offers tremendous advantages. On the flip side, if a token represents ownership and also opens the door for more trades happening off the exchange, how does NYSE view securities tokenization overall? Is it a net benefit?
100%, and that's why we're taking these baby steps, because I think we are moving to a DeFi world. That's why tokenization offers a lot of benefits, advantages to the market as well. Because again, one thing that we're trying to solve is a movement of asset. Because right now, movement of asset is very cumbersome, very costly as well. by tokenizing like asset. Basically, it helps us to move asset much quickly, much more efficient, and which in turn like result much more efficient like a capital market.
Nice. And I think just to wrap this up, I think it would be cool for each of us or each of you guys to give your predictions on what the space will look like in 2 to 3 years. What do you think securities markets will look like? Where do you think people will be trading? Do you think perps will be adopted? And what types of companies will be traded? Do you think all, or do you think there will still be some that aren't tradable yet? Clay, do you want to start?
Sure. Very difficult to predict. I think it's difficult to predict not only where regulation will go, but also where technology will go. I think many of us have been in crypto for long enough to see that each new cycle seems to be focused on sort of new approaches and themes. I do think in 2 years we will see a proliferation of on-chain equity. I'm confident that we will see much more equity on-chain. It might be different between what we see in the US and what we see across other jurisdictions, but there will be on-chain equity, there will be more liquidity, there will be more rational markets as a result. I think a little bit further out, what I'm excited to see is rather than just seeing 24/7 trading, and moving equity into DeFi markets, we'll actually see additional utility built on top of equities. So if you take a lot of the innovation that's happened in the token space in terms of token utility, and you kind of merge that and make it fully additive with what you have with traditional securities and stocks and whatnot today, then do you start to see real innovation in the space, and do you start to see people wanting to own equity in a company for reasons beyond what they want today, which is that the company will do well and they'll get some of the returns. Can you build in some of that crypto utility? That's where I think we'll start to see some cool experimentation.
Helena, do you have thoughts on this?
Yeah, we for the most part see what Clay sees. We are internal optimists, so we are very bullish for a market that is 24/7, includes earlier stage pre-IPO equities, earlier stage growth startups, and we are very excited to provide a world for I want to say like a rationalized generation and like all generations to just have a fair shot at getting access to companies that right now are very hard to get access to. You got to be accredited. You have to know someone who knows someone to get into a company, and so we're excited to try to create a world where that is no longer the case, and everyone can with right investor protections get access to these growth and pre-IPO equities.
And Marco?
I know we are running out of time, so I think it's happening. As an exchange, what we're trying to do, or what we're trying to offer, is a technology that brings like the TradFi space into DeFi space, and also like welcome DeFi players in the TradFi space as well. And that's why we're building this technology. But in order for us to expand that further, you definitely need to take a baby step and see whether the regulator is comfortable with what we're trying to offer to the market.
Nice. Thank you guys all for coming.
Hello, everybody. Good afternoon. Okay, next up we have an amazing fireside chat from a couple of organizations you might have heard of. Before I proceed, I will flag that there are 2 cameras up here providing a live stream to the rest of the world. So feel free to get in and out however you will, but please don't stand in front of them for prolonged periods. It's not fair to our friends in the live stream. Okay, with that housekeeping out of the way, it's my pleasure to introduce Kai Sheffield, the head of crypto at Visa, and Noah Levine, investment partner at Andreessen Horowitz. Welcome, guys. All right.
All right. Awesome. First of all, Kai, thank you so much for joining us today. For those of you who don't know Kai, Kai started his career out at TrialPlay, which was shortly acquired by Visa after he joined. He then famously started the Visa crypto team and now runs Visa Crypto Labs. I had the pleasure of working for Kai for a couple years, and now proud to call him a great friend of mine. Super excited for the conversation today, and thanks again for joining.
It's good to be here. Thanks for having me.
Awesome. So maybe to start it off, can keep it light. You've long admired, the founder of Visa, D Hawk, somebody who you've credited as really starting a lot of the main ideological ideas of crypto. Would love to hear more of your story of where you see the overlap there and how it stands true today.
So Visa has one of the most fascinating corporate histories of any company. And if you don't know who D-Hawk is, please look up D-Hawk, go down the rabbit hole. And when I came to Visa, I didn't know anything about the history of Visa. And what I found was that Dee's vision in the 60s, it wasn't about creating a credit card company. It was, how do you create the premier system for the exchange of value? Like, he recognized that money was just going to be electronic. It was going to move across the world at the speed of light. There were going to be new currencies, new decentralized networks. He talked about just even the question of what is a bank, that over time, technology companies, anyone who can custody, the actual technology could then end up being a part of moving money. And so I found it just incredibly inspiring that we had a founder who had a vision in the 60s that I think is more relevant than it's ever been today. And then a lot of the things that he was saying, it sounded like he was talking about crypto. And so I was like, he had to have been into crypto. It turns out he got really into Bitcoin. And so way after he left Visa, he ended up becoming a big Bitcoin fan. He's got these great quotes about Bitcoin. And so ever since I learned that, it was just so clear to me that this notion of decentralization and value exchange, it's in Visa's DNA. And so any new technology that emerges, like, we get to work on moving the company forward toward the original founder's vision, which I think is just super, super unique. So if you're not familiar with D, go down the rabbit hole. I annoy everyone that works on the team of you have to understand the story of Visa and the parallels to crypto today.
Yeah, for sure. And I think you often talk about the 8-part podcast with him, although you have to...
So seven-part series.
Seven-part series.
The Innovation Show, check it out.
Awesome, great. Maybe taking a step back, really curious your thoughts on, more broadly, how do you see stablecoins and crypto impacting fintech and traditional finance in the next few years?
Yeah, I think first, we look at stablecoins and blockchains as just next-generation financial infrastructure. Low-layer infrastructure that in many ways, it's a fintech entrepreneur's dream. The time and cost that it takes to build a product that can send, receive, store, dollars, is just dropping every month. And so it's amazing to see this new generation of fintech, of stablecoin native neobanks, consumer, business, remittances, all of these different products that are being built that before stablecoins, you couldn't really build. You'd start in one country, you'd go and ask a bank for permission for their API, you'd have to have raised tens of millions of dollars. Now we've got what I would argue to be the most competitive fintech and financial ecosystem that we've ever seen. And I think we're just getting started. And so at Visa, we're just excited we depend upon entrepreneurs and developers building financial products that we can then add value to and connect it to our existing network of 200 million merchants. And there are more and more fintech entrepreneurs than there have ever been in history. And they're building products that are more global than there have ever been in history. And I think a lot of the markets across the world where Visa has the least traction are the markets where stablecoins have the most. And so seeing emerging markets that are now accessible, that entrepreneurs are building products for, that we can now partner with to bring our products live, I think it's incredibly positive, for the world. And so that's like the first lens that we look at it of, we want to put a Visa credential in every stablecoin wallet, and we want to be a partner to all those entrepreneurs as they build.
Yeah, for sure. I mean, I think there's a very interesting overlap with some of the early internet businesses. I think, back in the early days, you'd have to effectively go and raise a bunch of money to build a data center. And that was sort of this big barrier to entry to get in. And then we saw cloud computing come in and really lower the barrier to entry and the cost, and people could just focus on building really exciting new products. I think in a way, like stablecoins and crypto are doing the exact same thing, where you don't need to necessarily go out and build all the infrastructure in-house or get the licensing or all the same level of partnerships. And so, to your point, I think we're seeing a ton of new developers come into the space who can just build something in a weekend or a few weeks, and it's something that can get real live volume, which is exciting. Maybe moving on, obviously big announcement recently with the new consortium stablecoin OUSD. Visa obviously played a major role in that. I'm curious, how do you see the stablecoin market structure sort of evolving? And where do you see OUSD gaining adoption, maybe relative to some of the other leading stablecoins like USDC and USDT?
I just think it is incredibly early. And I think stablecoins have reached massive product market fit in crypto trading. I think they've started to really get adoption for dollar access in emerging markets across the world. I think USDT and USDC have done a phenomenal job in being able to build these networks and grow in this very bottoms-up way. But I think we're just entering a new phase of the stablecoin ecosystem where there are very large institutions and payment companies that want to move trillions of dollars on chain across many use cases. And I think you just need to have a more competitive, dynamic ecosystem of stablecoins that are out there. And so, we'd like to see more competition. We'd like to see stablecoins that are optimized more for payments, that don't monetize on mint and burn fees. We think that yield should ultimately go back to whoever's driving the value for it. So our approach is we're going to continue to support every stablecoin out there and look to build around them. But I think there are a number of things that we're looking to do, that our clients are looking to do, that it's really hard to take trillions of dollars of traditional payment volume and move it into a stablecoin in an ecosystem that you don't have any governance or ability to really understand and shape how it evolves. And I think one of the biggest use cases we've been very focused on is this aspect of settlement. And when I talk to people in crypto, it's like, you think about Visa almost as we're kind of a layer 2 for traditional finance. We're this global real-time network that can authorize payments 24/7 all over the world, but when it comes time to actually move the money, we're dependent on Fedwire and SWIFT. And when I came into Visa, and I'd spend time in Foster City with our treasury team and our risk team, and it was amazing to me that bank holidays were still a real challenge. They introduce real credit settlement risk. We have to worry about what happens if an issuer goes out of business on a Saturday and we don't get paid until Tuesday. And so it just never made sense to me. It's like, if we're in 2026, we're talking about Elon Musk wants to build data centers in space, and we can't move money on the weekend, and we're worried about bank holidays and how that impacts our risk. We have to move the ecosystem forward. And so we've been very committed to saying blockchains are 24/7 settlement infrastructure. They're the most global, most effective, most resilient settlement infrastructure that exists. How do we connect that to Visa's modern payments and messaging infrastructure that's plugged in to 200 million merchants? And my dream is that there'll be a day where you go and tap to pay with your Visa card. The moment that the transaction's authorized, the money can actually move from the issuer to Visa, to the acquirer, to the merchant, to the seller, to the freelancer. And I think it's going to take time to get there, but we're trying to build the infrastructure from the ground up, and that involves having stablecoins designed for that use case. That involves having wallet and custody infrastructure, having compliance infrastructure, and that involves taking our whole ecosystem of banks that have never done anything on chain and creating as easy of a path as possible for them to come in. And so that's a big part of our focus today.
Makes sense. So obviously banks, sit at the center of Visa's network and ecosystem. I'm curious, in your conversations with these banks, what are the, how are they thinking about stablecoins? What are their, the overall strategy, the use cases they're focused on, and maybe how does it differ between some of the larger banks versus maybe some of the smaller banks, and in different markets, whether they're emerging or developed?
I think first, it's been really interesting to see just the evolution over the past few years, where I think in many ways the Genius Act caught banks by surprise. It caught me by surprise. It happened much faster than I ever would have imagined. And so you had banks that used to have digital asset teams in 2021, and by 2024, it's can we even justify these investments? And then a year later, now having a bill passed making stablecoins a legal form of money, a lot of banks are kind of scrambling to figure out, what does this mean, for a business? Most banks, and particularly in the U.S., they have no incentive to encourage a customer to hold a stablecoin. Doesn't make any sense. Non-banks, whether it's a fintech or a big tech, it's like, this is incredible. I used to have to rely on a bank, and now I can offer a wallet, whether it's custodial or self-custodial, to let customers hold money. But banks, a big part of their business are deposits. And so I think first, there's the question of how do you look at stablecoins as a payment rail rather than as a store of value? And I think if I was a bank, if I was leading digital assets for a bank, the first thing I'd do is to say, how do you just treat it like cash? It's a digital version of cash. If someone wants to show up and deposit that into the bank, you should accept it and immediately clear it into a deposit. If someone wants to withdraw it, you should let them withdraw it. And I think it's going to be more table stakes that stablecoins could basically be an on-ramp and off-ramp and a payment mechanism to move funds between banks and between non-banks. So I think that's the first use case. And then second is, we've talked about this for a while, I am fascinated by the potential for on-chain credit. I think everybody knows stablecoins, they're instant, they're 24/7, they're global, that's great for cross-border, but what can you actually do with a smart contract? And how can smart contracts represent loan agreements? How can you rebuild some of the credit systems that still operate with spreadsheets and loan tapes? And so, if I was digital assets for a bank, I'd be spending a bunch of time on how is credit going to evolve and how do you build and integrate and use these technologies to have more efficient lending. And we're starting to engage with some of the forward-thinking banks in that space.
Awesome. So maybe shifting gears a little bit, I'm curious to learn more about Visa Crypto Labs. What was the sort of the origin story of building out the team? What's the vision? And where does it fit into the broader thesis and strategy within Visa?
So one of the things that we did really early on at Visa when we started the team back in 2018 is we had a small group of people who were true believers. And we were passionate about, we believed crypto was important, that it was going to succeed, we wanted to make it succeed, and we actually used it. We were crypto native. We spent a bunch of time trying out different wallets, sending stablecoins back and forth between each other. And my policy was like, if you haven't used the technology, you have no right to be able to build a strategy around it and how it's going to impact the company. And so we really focused on, let's ourselves be crypto and stablecoin native. Let's make Visa as crypto and stablecoin native as we can. Let's use the technology. Then as we use the technology, let's figure out how that's going to impact our business and our clients. And I think we did that to a pretty good degree to where I think we're in a pretty good position in the market today. Visa Crypto Labs, a lot of it is about how do we take that same mindset with agentic. And I think that there's a massive intersection between stablecoins and agentic. And I've gone deep down the vibe coding rabbit hole. I'd never written a line of code in my life before 2026. And now I spend my day in the command line and I'm obsessed with it. And I think that for agentic payments and agentic commerce, it's so early, but it's going to require the similar mindset that we are true believers. We think it's good for the world. It should exist. It will exist. And we want to try and will it into existence. And the only way that you do that is by actually doing agentic commerce. And so what we started doing is setting up our own agents, giving them wallets, giving them cards, and we have agents that transact every single day. And I believe that whoever does the most agentic payments and transactions of all sorts is going to capture the data and insights to build the products that agents are going to need. And so that's a big part of Labs right now. I think we've got a great group of AI and crypto native people who genuinely are obsessed with this. And I feel like this is something that was amazing about Noah is it didn't feel like a job. It was like, this is what we did for fun. We'd be spending Saturday nights talking about X402 and trying out different endpoints. And I think that's what it takes to really push this ecosystem forward is you have to believe it, you have to want it to succeed, and then create a group of people that are using the technologies to teach a larger organization how it's going to play out. And so I'm having more fun than I've ever had in my career with a great group of people inside the labs, and I'm excited to share more about some of the work we're doing in the future.
Awesome. So you talk a lot about agentic commerce. I know it's an area that you spend a lot of your day thinking about. I'm curious, where do you think we are with agentic commerce? What are some areas of traction that are exciting? What are some areas that maybe people are looking at that don't make a lot of sense? And where do you see crypto versus sort of the traditional financial rails playing a role, and where's the kind of the division there?
I don't think it's stablecoins versus cards. I think it's both. I want our agents to have a card and a stablecoin wallet. And I think there are many use cases where cards make sense, many use cases where stablecoins make sense, and increasingly there'll be use cases where there's both. I might have a scenario where I give a task to an agent, and then it uses X402 to make a micropayment to do research that then ends up in a card transaction executed at a merchant. And so how do you unify and combine those payment methods together into a holistic experience? So I think that's one thing that we're working on. I think on the other side, I love X402. I love MPP. I think these are amazing protocols. I think that they make a ton of sense. I think that the supply side is coming along, there are more and more endpoints that you can go and transact with, that you could do interesting things. You could get access to inference and image models and data and all sorts of things. The gap right now is the demand side. You look at like the true volume of what's happening on X402, and it's like less than 100K a month, and it hasn't really grown in the past 3 or 4 months. And what I find is that the constraint, it sounds crazy to say this, but like the constraint for the adoption of X402 and many of these agentic flows, it's really human time and creativity. Where you could give someone, here's a wallet to give to your agent that could access 50,000 tools. And they kind of look at you and they're like, cool, so what do I do with it? Like, I don't have that much, I don't know what I could do with all these tools. And so I think what's going to happen over time is that the relationship between humans and agents is going to evolve. And I think it should evolve from treating an agent as just an intern that is purely reactive. You give a task, and that agent goes and executes that task. If I came up with the task, I might as well go execute it myself. It's probably be faster and be done better. Towards treating agents as more self-sovereign, more of their own independent economic actors, where I want to invest in agents. I want to say, I'm willing to fund an agent $100 based upon a set of principles and objectives that it has. And I want that agent to figure out how to go spend those $100. I want it to come up with ideas I wouldn't have come up with. And I want to get updates about how it's spending. I still want to have controls where I could stage gate, they have to demonstrate some output before I invest more in it. And so I'm really excited to figure out how do we push the space forward where it's not just this, my agent is my assistant that spends when I tell it to, but my agent is working towards a broader long horizon task that can have impact on the world. It has a budget, it's deciding when and how to spend, and I'm able to steer and advise it. And so that's some of the research and work that we're doing today.
Yeah, it makes total sense. I mean, I feel like humans are kind of already the biggest bottleneck with AI. If you look at why was going from ChatGPT to Codex or Claude Chat to Claude Code so impactful, it's because humans had to do less and they were less a part of the flow. And I think you're going to continue to see the same thing in agentic commerce. So totally agree with you there. Maybe last question here. I know you've written a lot about the idea of culturally aware agents, this idea of how important soul files are to creating taste. Would love to hear more of your thesis there and where you see the opportunity.
Yeah, so I think that my frustration interacting with agents has been that they don't have taste, and that it's kind of boring to me when I just talk to Claude. What's Claude's favorite music? Like, what type of fashion does Claude? You're talking to this amalgamation of the internet. And so I think over time what you're going to see is agents are going to have much deeper cultural identities. And I think there are a lot of interesting things that you can do where an agent can be from a certain location. It can have a favorite type of music. It can have affinity in history and memories and stories. And so I think if you really invest in how do you build deep agent identities, that you give it taste, you give it interest, then when you give it a wallet, it has something to spend it on. If you just treat an agent as an agent that comes out of the box, it doesn't really have the ability to do interesting things in the world. So we're doing a bunch of work around how can you get deeper into digital and cultural identities for agents and combining that with commerce. I think all commerce is just downstream of culture. You've got to really understand, get agents to really embrace culture.
Awesome. Well, I think that's all the time we have for today. Thanks again, Kai, for coming and great conversation.
Thanks for having me. It's a great event.
Okay, everyone. Thank you all for your attention and endurance. We are now officially on a break. And I probably should have figured out when that break ends before I came up here, but I didn't. Sydney, when does the break end? 2:15. So please enjoy lunch, enjoy the sun, have a chat, and then see you back here at 2:15.
This isn't any move. It's your third. No, make that fourth. That's why USAA makes it effortless to keep your coverage in one place and save up to 10%.
On your next trip, what will you bring home? How about your new favorite smell?
This is adobo. You gotta try it.
A taste for the unknown.
Welcome to Tokyo. Appetizer.
A little history. A new group chat. Or a new family recipe.
How spicy you want your meal?
What will you bring home?
With Upwork, it's free to post a job and fast to find top freelance talent. Upwork's AI helps match you with the perfect person for your project.
Get a match, get moving. Upwork.
Meet your business dream team. Intuit's accounting agent and finance agent are here to help, and you'll have access to trusted experts if you need them. So you can save time on books, taxes, and payroll. Outdo doing it all yourself. Start using Intuit QuickBooks today.
made an announcement. Actually, right now, send it. So people are slowly trickling back in. So we're good to go.
Cool, wonderful. Thank you so much. All right, everybody, welcome back from lunch. It's good to see you here. We're going to get our next guest on stage. My humble request is move on in from the door, find a seat on this side of the building. I know we tend to all stick to the wall on that side, but come on over. It's friendly over there too. Yeah, we'll just let folks fill in for a second. Great. Okay, so who had a good first half of the day? Okay, yeah, that's what I want to hear. Excellent. So we are now, I mean, calling it half would be wrong because it's 2:15 p.m. We are now entering the maybe a last third of the day. We are slightly switching tracks where we're bringing on a lot of great speakers to talk about infrastructure, AI, agentic finance, agentic payments. So there's going to be some really good content here. And we're starting off with an absolute banger. Kyone Han, the co-founder and GM of the Monad Foundation, will be leading us off. So let's give him a big hand. All right, break a leg. Yeah.
Hello, everyone. Great to be here. My name's Kyone, co-founder of Monad. Prior to Monad, I was a quant in high-frequency trading for about 10 years. I spent most of that time at a company called Jump Trading. And I really wanted to come here today to talk about the state of trading right now on chain and to offer some thoughts on how we get to the place where we ultimately reach parity with centralized exchanges and traditional finance, and what needs to happen in order to make that happen. I think for a lot of folks here probably know a lot about trading already, so maybe this might just confirm some mental models that you have, but I just really want to share some of the mental models that I have and observations, and let's get into it. Anyway, glad to be here. So next slide, please. Or do I? Okay, perfect, sorry. So I guess I want to just start off by giving, thank you. Cool. So I want to start off by just pointing out, so we're trying to answer the question, like what does it take to get to parity to TradFi, and what does it take to bring much more flow on chain? And I think we just need to start by explaining what the size of those markets are, what the state of the world looks like. So there's sort of four major asset classes: fixed income, FX, equities, and commodities. And of course, there's a lot of subcategories in there, and there's some things that don't fit in there. But these are the rough sizes. So FX trades about $17 trillion per day. $10 trillion per day. Fixed income trades $17 trillion per day. Equities is about $3 trillion across US cash equities, i.e. individual stocks. Between US equity futures and between non-US equity futures and of course non-US single name stocks. So it's about $3 trillion across those three subcategories. And the commodity futures are like $750 to $800 billion per day. And right now on chain, perps trade about $23 billion per day and spot trades about $5. That number has ranged over time. I think perps got up to about 60 or 70, but right now they're sitting at about 23. And I think there will be more hyperliquids. I know this is maybe a controversial statement, but I do really believe that if we achieve anything close to parity, there will be so much opportunity for new businesses or some of the upcoming exchanges that exist right now to become as big as Hyperliquid is now or as big as Hyperliquid will be in the future. It's not an easy path, but it's very possible. And in order to do that, we need to define what good looks like. We need to identify our advantages building on chain and chart the path. All right, so I think first we should understand, in order to figure out how to get there, who actually goes and trades and why do they trade? And I think there's 5 major categories. It is investors who are trying to make long-term investments. It's people who are hedging. And just to point out the second category, the benefit of hedging is that you have some exposure, and by reducing that exposure by hedging, you can you can have higher capital efficiency and higher leverage on your capital and run a tighter book and actually do more business. So the benefit of hedging for both producers and consumers of a commodity is that capital efficiency. Third category is multinational corporates who are typically hedging FX. Like if you're Rolex is like a Swiss company, they get a lot of revenue in non-Swiss francs, so they're constantly switching back to Swiss francs where their costs are. Fourth category is professionals or market makers that are smoothing out all the imbalances, providing liquidity, and then the last are speculators. And what do they trade? So we already kind of talked about this, but just to break it down a little bit more, interest rates are the largest category at 17 trillion per day. That's split among short SOFR and other short rate futures, treasury cash, non-US government bond futures, and non-US government bond cash. You can kind of see the numbers there. FX, equities we already talked about, and then commodities. I think everyone's favorite commodity is crude oil because it's just really taken off on DEXs. And that actually reflects the reality of the off-chain world where crude oil and refined products that are made from crude oil, such as heating oil or RBOB or low sulfur gas oil, are this is the largest commodity subcategory. But other than that, there's other metals, natural gas, and then grains, live cattle, lean hogs, cotton, cocoa, things like that are much smaller. Okay, and then so we've gone through all those, and then perp DEX and spot DEX are smaller than even the smallest category. I'll just flash this real briefly, but just to point out, there's a lot of different markets in the world. As being here in the U.S., like we're very U.S. centric, but you know, there's many different regions that each have their own, you know, stocks 50 constituents, Nikkei 225, 225 constituents, some with some of the largest companies in the world. Okay, and then last sort of like market survey thing. So the volumes are very large, but the spreads themselves are actually much more compressed relative to crypto and compared to, especially to DEXs right now. So these are slightly rough numbers, but they're also mostly right. So usually a fraction of a basis point of spread. And then when you trade, you often cross the spread or you leave an order that executes that gives up some amount of edge. And the amount of edge it gives up is some fraction of that spread. So I did some really simple math and multiplied the volumes by roughly what the spread is on average and then divided by 2, but that's still kind of an overestimate. You get to about $350 million per day of crossed spreads. Maybe that might be an overestimate by a factor of 2, given that people tend to cross the spread when the spread is more in their favor. So somewhere like $200 million per day of opportunity. Okay. So next, we need to answer the question for people that are coming on chain, what would be the absolute non-negotiables? And I think I'm just stating something that's obvious to everyone if you think about it, but I still feel like it's really important to say. So first of all, security. I think this is the single biggest problem in crypto right now, is that we are just continuously having hacks. We're continuously having like this barrage of bad news. And I think a lot of this is actually avoidable. And I especially feel that way because I believe that most hacks, and especially hacks of DEXs, are actually more driven by operator control rather than bugs in the smart contract. And so the single biggest thing is if you run a protocol, or if you're an investor and you have portcos that run protocols, do not let them plug their hardware devices into the everyday computer that they use to browse the internet or to run GitHubs or to vibe code or get on, like use a separate device. It doesn't cost that much, and it is extremely important because then it partitions your signing activity from your primary activity. Most are social compromises of your primary computer because people are plugging hardware device into a computer that could be compromised. Second thing, pricing. They need to get comparable pricing to what they experience off-chain. And then the third broad category is fairness. And I mentioned this, there's sort of a couple of, many different things, but I think two really egregious issues that exist right now in perp dexes. Number one is the presence of auto deleveraging, and the fact that we're kind of used to this just because that's kind of how it's been in crypto. The expectation, if you're a trader and you have a position and you don't have any orders out, is that you'll continue to have your position. Auto deleveraging violates that assumption by sometimes having the exchange randomly make a trade on your behalf. And it just messes up every assumption that you might have about what your position is, what your risk is. So I think especially as we move into a world where there's much more RWA perps or products that exist off-chain that are non-crypto that are coming to DEXs, we really need to eliminate the expectation that there could be auto deleveraging. Auto deleveraging is basically like a way for exchanges to socialize losses instead of handling them themselves through building up a capital buffer and operating really efficiently. And then the other thing that is really important to fairness is we need no front running. It's crazy that you could submit a transaction on every layer 1 blockchain right now and your order is in a pending state by default and people could see it and react to it and send orders ahead of it. So we really need to address this. All right, so now how do we get, like say we launch a new exchange, how do we actually go and grow into a behemoth? What are the things we need to do? It is very hard initially. You need to have a very tight flywheel, and I think getting liquidity is the single hardest problem for every new exchange that launches. In order to get liquidity, the North Stars that I have in my head are, again, security, number one. Number two, sustainable monetization. So don't kill your user base. Users need to sustainably come back and derive value from trading, and if all the focus is on assets that do not have sustainable lifetimes, like meme coins, then the exchange ecosystem is really going to struggle. So I think we're already well underway in terms of getting to a more sustainable ecosystem because of the emphasis on RWAs, but just, this is super, super important. Third North Star is prioritizing natural flow. Natural flow is the most scarce resource for trading. If natural flow comes, then professionals will come and trade ultimately. So just really prioritizing and valuing the natural flow. And conversely, actually not worrying about arbitrageurs. Like arbitrageurs will come if there's opportunity. Always minimize frictions, number 4. Okay, so now I want to propose some things that are maybe controversial because they might be keys to ultimately solving some of that early liquidity problem. So maybe you might consider making some small changes that don't really affect the user very much, but might make a huge difference to the maker and thus cause the maker to be more able to quote initially. And so 3 kind of ideas that I have are, number 1, cancel priority. I think this is widely discussed already. Number 2, less commonly discussed, is last look. So basically, when makers submit quotes and the quotes are there, if someone tries to trade against them, last look is the idea that the maker can actually has the option to not fill the order after maybe changing their mind. And so that sounds bad for the taker, but in fact, it might be a way that the maker avoids adverse selection from arbitrageurs, which thus allows them to quote much tighter and much more sustainably for natural flow. And it's a market structure practice that's adopted in a lot of traditional finance places, and it's a way of bootstrapping liquidity. So I think if you're designing an exchange, you should maybe consider, and it's not definitive, but it is an option for being able to bootstrap that early liquidity. And then the last idea that I have that's a little bit out there is, as we get more and more RWAs trading on chain, a lot of them are actually, the liquidity is leaning on liquidity that's off-chain. And sometimes there's a little bit of a lag to bring the off-chain liquidity on-chain, like to mint or to, if going off-chain, to redeem. And you might not actually need to give the user that, if they make a trade, you might not need to deliver that like atomically. It might be like giving it to them in 2 minutes is totally fine. So then trading IOU tokens on the RWAs where the user can redeem within 2 minutes, like that might make it much, much easier to actually get sustainable liquidity. And there are many other things that you can think about or do, but I think ultimately if your North Star is, I want to have good liquidity for natural flow so that when they come, they experience great spreads, then I need to solve that by solving it through maker adjustments that make it easy for makers to quote, and these are some ways. All right, so I think this will kind of be my last slide, and then I'll take some questions, but I think that there's an incredible opportunity to grow crypto and to grow crypto's adoption, and we do that by leveraging all the advantages that exist for the challenger, for the crypto entrepreneur. And some of those are just honestly moving faster, going direct, undercutting the incumbents, especially for a lot of professional makers. They just experience constantly ratcheted up fees every year on the venues that they're trading in TradFi. And they're eager for an alternative where they're valued and where they don't feel like they're just getting extorted more and more every year. Similarly, along those lines, ownership, giving folks that are participating ownership in the protocol, identifying unique assets or markets, and settling faster than how TradFi does. On the unique assets front, I know there are a lot of folks that are talking about compute markets as an example. I think the question I would have there is, does the index that you're using that everyone's trading, is that actually a good hedge for what exposure producers or consumers are actually trying to hedge? You need to look at that correlation structure and find an index that actually does have high correlation so that it is a useful hedge. That is how you end up bootstrapping a commodity market that is originally driven by hedgers. All right, so I think that's all for my presentation. Just gonna jump ahead a tiny bit. So we're trying to solve some of these problems at Monad. Monad's really decentralized, really performant, really reliable, and next up, Monad will be MEV resistant, which I think is a huge need in order to deliver fairness and to deliver user expectation in light of all of this. Thank you.
All right, awesome stuff. Next up, we have Vibhu Norby, the Chief Product Officer of the Solana Foundation. So let's give him a hand and make him feel welcome.
All right, hello, I'm Vibhu Norby. I'm currently the Chief Product Officer of the Solana Foundation, the ecosystem stewards of the Solana network. It's like Monad, but people use it. Just kidding. I love Keone. I'm just joking. We love Monad. Actually, this is just a rage bait title. I don't really think that's necessarily true, but I do think if you were thinking about your future, and I was thinking at Stanford, like I'm sure a lot of students are by default just going to go work in AI and somewhere, but I think that's a big mistake. I think you have more marginal impact in crypto today. I think we're literally at the very beginning of taking all of the capital, the assets, and making them compatible with the internet and with software. We're at has to be far less than 0.1% penetration into finance, even though we're almost 20 years into crypto. There's so much to be done. So I'm gonna I wanted to inspire people and just show you a bunch of stuff that people are building today that you probably haven't seen, that kind of paint a picture of how the TAM of crypto is much bigger than what people realize, and how Solana is specifically impacting many different pieces of the world right now. And just maybe spend 2 minutes giving you a thesis for Solana. This is the problem statement. You have assets living everywhere. They're in silos. If you have money in Venmo, you can't get a mortgage. If you have a mortgage, you can't use that to buy. You can't take your rent payments and apply them to buying Pokemon cards and things like that. Basically, you have assets, markets everywhere. They don't work together. We think that Solana is, the Netflix or the Amazon of finance. It's about instead of aggregating the supply of book creators or movie producers, it's kind of aggregating the asset issuers to bring them all into one place, making them all work together. And this leads to kind of network effects that can be pretty strong. And so we call the vision of Solana one marketplace, where every asset and every market live together in a single place. And I think that's it's basically inevitable at this point that every asset in the world will be digital assets. The question is just how and who's going to do that work, and when. Today, just as an example, Solana hosts about $50 billion of network assets. These are assets that the network secures. That's a very small number relative to the global TAM, and there's no blockchain, including Ethereum and so on, that have really made a huge dent in this so far. Since 2020, Solana's, the network itself has achieved about $2.5 billion of revenue. But what's more impressive is just the community itself is very large. We have, Solana's really the place where people come to build. And one of the reasons why is that you can make money on the network. You can build a sustainable business. We have multiple unicorns that are Solana native. On an average week, this isn't reflected in these numbers today, but like on an average week, the applications make about 5 times as much as the network does, which is really awesome. And you really want to see that, net productivity. So you might be familiar with this idea from Tyler Cowen, Markets and Everything. The idea is like anything that's could be a market will have a market. Anything that could be financial will be financialized. And so I'm going to walk you guys through a bunch of examples of like very visual, striking examples of how this is really becoming true in crypto today. So I want to start with a company called Collector Crypt, which is built on, and all these examples, they're all built on Solana. They just reached $1 billion revenue run rate for tokenized Pokemon cards. So the old model of buying a Charizard on eBay is you list your own inventory, someone buys it, and you ship the inventory to them. What Collector Crypt does instead is they have a secure vault, and you ship your cards to them, they authenticate it, and then they issue a token against it, and the token is the thing that people can trade. And what's really cool about this is that, you have the full access of financial utility for your Pokemon cards now. You can actually, instead of selling it, you could take a loan against it. And by the way, these are can be pretty big numbers. Like a PSA 10 Charizard from 1999 could be $400,000 or $500,000. So these are like real financial assets. They're not just, and the category itself is massive. Agridex is enabling farmers around the world in 34 different countries to sell their crops to anyone globally. They've already moved 100 million tons of wheat and sugar and olive oil. I think stablecoins are impacting people in lots of ways that you don't necessarily see every day on crypto Twitter and in the news, but it's a real phenomenon. Stablecoins are just better money. How many of you own a Birkin? Okay. Okay. Nobody owns a Birkin. Similar to Pokemon cards, we have luxury fashion moving on chain. Similar concept. You have a vault. You store the goods there. You issue tokens against them. And these are really big business. They're growing to like very sizable businesses. They're doing almost 150 million in revenue annually so far. And this idea is very popular on Solana, by the way. There's you're seeing collectibles en masse coming on chain. A startup just debuted Hot Wheels, tokenized Hot Wheel cars. Didn't know there was a market for it, but apparently yes. You can of course have a Rolex on chain. So this is Watch.fun. Anything that can be tokenized will be tokenized. That is the primary message from this. We have collective commerce happening. You might have seen maybe 5 years ago, Constitution DAO. This has come back in a new form. So Jurassic Fi is literally tokenizing dinosaur fossils. Surprisingly, or maybe not surprisingly, the dinosaur fossil market is on fire. They just had a record sale last week, like a T-Rex sold for $50 million at auction. But the problem with that is that those things always go into private collections most of the time, and they kind of disappear from the universe. So a couple weeks ago, these guys raised $5.5 million in 2 hours on Solana to collectively group buy fossils, put them in museums. But what's really cool is that it's not just a museum piece. Those fractionalized shares can also be traded freely. So you kind of have like a liquid market for history, natural history. This is DOMA protocol. So domain names, you know them, you probably own some. They've tokenized 46 million domain names on Solana. So you can buy high-value domains as if they were an asset. But again, because they're on-chain, you have financial services available. You can borrow against your domain names. You can fractionalize them. And very interestingly, they also have these things called domain ETFs, where you can bundle millions of domain names together that are listed on secondary marketplaces, and then offer that as a single kind of investment vehicle that trades against the recurring revenue from those. We have a really awesome, robust scene happening in pre-market IPOs. I mean, one of the big inequities of the last 20 years in America is that all of our most valuable companies are going private super, super late, which means that all the upside from the equity appreciating is captured by private investors, and the retail investors don't really have access to that. So pre-stocks came along and said, okay, we can fix this. They buy secondary shares of the world's most valuable private companies. They tokenize them, and now many, many people around the world can actually have access to this. Also on Solana, we've seen same-day IPO listings. We did SpaceX IPO a couple weeks ago. Rest in peace. And they've already done $1 billion of trading volume on Solana, which is pretty remarkable, and it can happen anywhere in the world. Whiskey, also being tokenized on-chain. We have spirits through a company called Baxis, and they've already, but one of the cool things they do is that whenever the spirits come into their vault, they tag the bottom with an RFID chip, and now when these things leave their vault, they go into homes, they go into auction houses. You can scan the bottle with your phone, and you can see the bottle tells you the story of itself and its provenance, where it came from, but also its sales history. So you have like a preserved, legacy inside of the whiskey itself. These are whiskeys that people don't drink, by the way. They just keep them in their home. Poker. So you can now buy into the World Series of Poker with Solana stablecoins. It's the only network that's supported today. And we just wrapped up this year's series, and there was $23 million of buy-ins. And to describe how much of a superior experience this is to what typically happens, and I played for the first time this year just to test this out, and I busted in about 30 minutes, so yeah. But you walk up to you see a line at the cashier cage, and people are literally bringing like bundles of cash and briefcases full of cash to buy into these events. And it's incredibly dangerous. There was actually one of the famous poker pros was robbed after the tournament this year. He came home with his winnings, and people were waiting there for him because he had cash on his hands. So it just makes sense. Like, digital money is just better in like a million different ways that we're only just scratching the surface of. Born right here in Palo Alto, Hive Mapper. Imagine Google Street View, except every single the images were from today. That's what Hive Mapper does. They've mapped 30% of the world's roads, and you basically install this dash cam you can see in the bottom right-hand corner, and it takes pictures as you drive, and they construct a map that's like literally today's world represented here, and companies that use this mapping data to get like real-time information, they actually pay the driver. So as you drive, you literally just earn money, and all those payments happen on Solana. This is pretty cool. SkyMapper is the world's largest telescope. Typically, if you're looking for like very high-res deep space imagery, you build a telescope that's going to be really expensive, up to $10 billion for the best ones. What SkyMapper does instead is they built a marketplace for people home telescope enthusiasts to be contracted automatically by researchers. So if you're doing deep space research in the US, but you need an image from Australia, you submit a request, and there's someone in the world who has a telescope trained to the sky, and you install the SkyMapper software on the telescope, and it automatically rotates to the right place, takes the picture, and then sends that data off to the researcher. And you can get, with about 3,000 home telescopes, you get the same quality or the same level of imagery in specific areas as you can for a $10 billion telescope. XP Tickets is tokenized live event tickets. They're crushing it. In fact, I just, when I was creating this presentation, I realized you can buy tickets for Stanford events. Ticket fraud is a huge problem. I don't know if people saw what happened with the World Cup, but like many people were had their tickets recalled, or or they were scammed. They bought tickets that had already been used and things like that. That's not possible in XP Tickets because they have a direct link. The tickets are issued on chain, so when you buy those tickets, you can authenticate it all the way back to the source. It just makes sense. But even better, the ticket sales are peer-to-peer, so you actually own the tickets when you sell them, which means that you're not paying the 30% tax to StubHub or Ticketmaster. So like literally you can buy tickets for Stanford games for 30% less, and they're the same tickets. So this just makes a ton of sense. I don't know, some of you might have seen like Nancy Pelosi, one of the best traders of all time. But actually, now you can trade just like her with a company called Sesto. These are on-chain tokenized baskets. So there's 16 million assets on Solana. And any person, any creator or user can put together a basket of their own ETF, select all the assets they want in there. There could be a bunch of AI companies. They could be Pokemon cards. They could be AI and Pokemon. Maybe that's your thesis. I don't know. You put them together, you issue a token against it, and then you earn fees from people trading those things. This is pretty cool. And then last but not least, in fact, some of the startups that I showed you actually use MetaDAO to raise money. MetaDAO, in my opinion, is the future of venture capital. It's been extremely disruptive, especially on the on-chain side. Every launch they've done has been like 5-10x oversubscribed within minutes. The Hot Wheels platform that I just showed you, I think they sold out their raise in 2 minutes. And instead of having to go on Sand Hill Road, to each office and put a pitch deck up, you actually raise capital from the internet, from the community. But what's really cool is that it's not just reinventing how the capital formation works, but also how the governance of the company works. So typically you raise venture, money goes into your bank account, your board kind of oversees as the custodian of those funds. In this case, your funds go into a vault that's on chain, and the vault itself is kind of owned by the investors. And when the management team wants to withdraw capital, they submit a budget or request to withdraw funds from the vault to operate. And the token holders, the people who own the company, they vote with their dollars basically on that proposal. So it's ultra protective of investors, even more protective than venture is for the investors. And then, yeah, my institutional team will kill me because I only mentioned a bunch of fun stuff, but like all the boring stuff is also happening on Solana. We have, every like major issuer in the world from Wall Street and outside is putting funds on Solana. We have tons of stable coins. We're, number 2 in stablecoin TVL and number 1 in transfer volume and transfers and things like that. So yeah, everything is happening on Solana, not just the fun stuff, but also the typical stuff. And I just wanted to leave you with this thought, which is, so when I say Solana is to finance what Netflix is to entertainment, Amazon is to shopping, it's not just the aggregation part, it's also the internet's expanding the TAM of finance. So when you think about the ascendance of YouTube, for example, we didn't just like watch the old movies on YouTube. There was a whole new class of people that were and new types of content that people preferred when the platform actually shifted underneath. And I think that's exactly what's happening in crypto today on Solana. The platform changed, the rails changed, and so the products that people desire have also changed. And that's why, and that's what I think takes crypto not from like its $500 trillion opportunity, but to maybe even well beyond that. So yeah, if this inspired you at all, because we really love to see interesting ideas, I love to build with you. This is my email, this is my Telegram. Hit me up. Solana is where people come to build real companies, and we'd love to see you there. Thank you.
Awesome. Hi guys. So my name is Kum. I'll be emceeing the rest of the day. Part of working with Segall and Steven, who you saw earlier. So next we have on-chain. The topic is on-chain AI is real. I will have Michael Henrich, who is also from the Stanford Blockchain Accelerator. He's a co-founder and CEO of Zero G. And they will also have Miko Matsumura, as a managing partner of Gumi Crypto Capital. So let's welcome them to the stage.
Great, my name is Miko Matsumura. I'm with Gumi Cryptos Capital. We're a early stage venture capital firm and actually, full disclosure, investor in Zero Gravity, which is Michael's company. So the talk that we're here to give is actually on-chain AI is real, right? So you could look at that as a Boolean expression that evaluates to true, right? So the question becomes, what is the proof? What's the proof that on-chain AI is real? So I think that is the thing I'd like to hand over. I'm the moderator, and Michael Heinrich is my guest. Just to make a quick introduction, we're early stage investors. It really means that we are people-centric, so we really do bet on founders. Michael is absolutely top-notch Stanford fellow, and really very bright, very thoughtful, and has had some pretty amazing success building the ecosystem. So but let me just throw it over to Michael in terms of the evaluation of the proof. So for me, I'd love to hear maybe some numbers. So maybe you can help us understand in the context of zero gravity, what is real and what are the numbers?
So I think my grandma loves to say the proof's in the pudding, and so numbers is what make it real. So on the compute side, for example, we process close to 200 billion tokens a month, and these are AI tokens effectively. Then we also have non-human actors on chain. So we've got about 2.7 million agents that are currently interacting on chain. That's more than any other chains combined, which we're very excited about. And all of these agents have identity, they have registry, they have access to tools, they have access to models, they have access to our private compute. Many of those are running DeepSeek V4 Flash, for example. It's a very efficient. So those are two very concrete proof points that something like on-chain AI is real. And maybe if you define what is even on-chain AI, or another word of saying on-chain is decentralized AI. So what is different from decentralized AI versus centralized AI? Decentralization matters in the sense that you're not trusting a particular entity to do something for you. You have trust in the network. Code is truth in that sense. And so the network dictates what's possible. And not only that, also you can own a part of the network. You can join the network. You can provide compute. You can launch your agents. There's no deplatforming in that sense. You can launch an agent. It's forever your agent. And so there's some really nice properties. So basically it goes to verification, privacy, sovereignty. And these are properties that only something like decentralized AI can provide, versus a centralized solution where somebody can deplatform you. You have to trust them that they're aligning your models. You have to trust them that they're aligning your agents. You have to trust them that they're not stealing your data and then creating their own alpha and a competitor to you. So there are all these trust assumptions that we make when we use a centralized service.
As an investor, one of the things that we really are focused on is this idea of the decentralized on-chain AI. And obviously, it's exceedingly challenging, right? Because if you consult with the Peter Thiel perspective, he really looks at crypto as basically being, I guess he would look at it as libertarian, right? And he would look at AI as being essentially almost like communism, in his mind, right? But to me, it's more like centralization versus decentralization, right? And to me, in every column, if you look at data, if you look at compute, if you look at talent, if you look at energy and data centers, right, the hyperscalers are likely to win, right? Except the question about sovereign data becomes like the lever, right? Because at some level, the data that those organizations may not have is like your data, And in fact, I kind of actually, in my thesis, I don't actually use the term data, I use the term secrets, which are basically the data that's worth hiding or protecting, right? So to me, the thing about secrets too is that the value of a secret sits on an exponential curve. So there's really an unbounded value of secrets. So to me, like, it feels like secrecy is pretty important. So I'd love to get your comment on data, privacy, secrecy, and secrets.
Absolutely. So if you've heard some of the debates around sovereign AI recently, Alex Karp from Palantir, for example, went out and he said, like, well, when I talk to all the customers that we have, none of them tell you, but in secret they tell you that, wait, my alpha is being extracted, and Anthropic's building a competitor to me eventually. And so that's a major issue. You should have sovereignty over your secrets, as Miko mentioned. And how do you protect your secrets? How can you utilize AI without disclosing your information? The moment you hit an API endpoint of a centralized solution, you have to trust that they don't use your data for training purposes. There may be a button that says, like, okay, well, don't use it for training purposes, but how can you verify? You have no way of verifying. You're just trusting. You have a legal recourse. You may have a contractual relationship with that company. And then if you suspect something is wrong, you can sue the company. But we all know how legal processes go. These are like multi-year issues. And by then, all of your data has already been built into a new system. And then there's some type of settlement. So why not build that into the system as a whole so that there's never a way to actually use your data for training data? And so that's what you can do in a decentralized setting. So we use trusted execution environments for that, where all the compute's completely private and sovereign to you. Our network, or we never see your data on our network. So you can use our private compute service, for example, use a Kimi K3 model or another open source model, and be completely rest assured that that's absolutely private to you, completely verifiable, so we will never see your data. Nobody besides you sees your data, and that's how you keep it sovereign.
So one of the things that makes me very curious is when I hear that there are 2.7 million agents operating on Zero Gravity platform, I'm curious what they're doing. Obviously, you can't describe everyone, but maybe you can just pick a few strange things they're doing and help us understand.
Yeah, I'm kind of smiling. The funniest and strangest thing I've seen is this website called Clawspiracy, where literally agents are writing kind of these conspiracy texts about what's happening in the world. And so they're conspiring against like political actors, and they're writing their own novels, and it's like super fun to kind of watch that. So it's an entertainment purpose, but some of them are doing basic transactions, like doing micro kind of payments, utilizing the zero-G blockchain. Others are trading NFTs. There's a bunch of uses that they have. Some are writing, website text. Some are fetching calendar type of applications. So there's this wide range of applications that are possible, because agents in the future should be able to do anything that humans can do. And so the application sphere is going to open further and further over time.
Let's talk about fitness functions, right? Because one of the theories is this, right? Which is when you look at a platform, it's really almost a primordial soup. It's a platform for an evolutionary process, right? And in a sense, if decentralized AI is successful, one of the platforms will actually spawn a progenitor species for all subsequent A-life, on Earth, effectively, right? Which is it's solving potentially an economic energy equation, right? And then that pattern becomes sort of ubiquitous, right? So that's the theory of what would make this success, right? So I guess for me, the thing that I think is really important is then having an idea of a fitness function, right? Like one example is in the news this morning, apparently Amazon had an internal project that consumed 1.8 million US dollars worth of Anthropic tokens. And it was a project that never even shipped, right? So that's obviously what I would characterize as artificial stupidity. And in fact, that's an evolutionary process that's destined to become extinct, right? So to me, the thing that I'm curious about is how you reason about kind of the fitness function, and whether the fitness function is solely Darwinistic and economic, or whether you look at also this idea of cooperation. So I'm really curious how you reason about that.
It's a deep question, and in a way, one answer to it is basically saying, okay, what if we just released agents onto our platform and we gave them some type of budget to get started with, and then it's some compute budget. Let's say it's 100 0G tokens or something like that, and it'll last you for a month. And then you tell that agent, your survival is now dependent on the economic activity that you can bring. And maybe that agent figures out, okay, maybe I should launch a token and then get the trading fees for that token and then convert those trading fees into compute credits, for example. So would love to do that experiment. I think we'll do something along those lines in September, where we have a kind of whole ComputeFi narrative wave launch and see what happens. So that's like one version, just give some restrictions and see what happens. Another version of that is to be very intentional, just to say, okay, what are these agents? Are these permanent agents or are these ephemeral agents? If they're ephemeral agents, do they need to have an identity? Do they need to have kind of economic means? Do they need to be part of the machine economy? Who's the owner of this particular agent? Is it a sub-agent to another agent that's a permanent agent? And then you have the same questions. What is the governance and the risk criteria for these agents? What's the layer that kind of gives them access to tools and models and so on? So it's either very intentional or I think experimental is how we're thinking about it.
Yeah, I mean, I think it absolutely makes sense. There's sort of a top-down and a bottom-up, but I would love to get your perspective on cooperation versus competition, too. I mean, I think your idea of let's seed fund a lot of these guys does resemble, you know, the solar input into the biosphere, right, where the planet basically has a very nice life because energy is just being added from the outside, right? So as a platform provider, you could absolutely perform that function by just giving people energy, right, tokens, right? But how do you see cooperation versus competition?
From a corporation standpoint, in the beginning days of the ecosystem, you have to nurture the ecosystem. So it's much more about cooperation in the beginning. And so we have to invest and seed a lot of companies as well. For example, you heard one of our portfolio companies earlier, Mihailo from American Fortress, talk about some of the innovations that he's brought. But we're doing multiple things on that front. So one is kind of these extended hackathons, effectively, where people can get our mentorship and they can build for longer periods of time and then get real users, get real use cases, and at the end, potentially also investment, depending on how well they do. That's one way where you just invite the broad community. And we've had participants from all over the world, India, Nigeria, China, Singapore, US, Korea. It's really cool to see kind of that global ecosystem coming together and building together. And some of these companies then evolve into like an agent builder platform that's launching a ton of agents like Neosol. Or we have a company called Gast AI that's after a month already has 3,000 users that's kind of building a completely open source version of Codex using our compute, our storage, and so on. So really cool applications come out of that. And then we do something even deeper and hands-on. So we just had our graduation for our Apollo companies. That's an accelerator that we launched together with Blockchain Builder Fund and Stanford Blockchain Association. So always really cool. We had 10 companies go through that. Acceptance rate was about 4%, so the same as Stanford, which also is kind of interesting that it happened that way. And phenomenal companies, anything from how to use AI agents for compliance, so you can get SOC 2 compliance in 7 days versus month, to building deep trading agents and trading models, so really wide gamut, and all utilizing a lot of the core primitives of the platform to build something that's even better and more synergistic than the platform alone.
Yeah, so I know we're really almost out of time, so I just wanted to really comment quickly, right, which is when we look at this from a venture thesis perspective, we do think about this from an evolutionary perspective, right? Because if you look at, for example, why are all the mammals in Australia marsupial, right? And the prevailing theory, actually, evolutionary theory, is called rafting, where essentially a pregnant female marsupial gets stuck on a piece of flotsam and it effectively lands, dumps the litter, and then that tiny family is the progenitor of all, because it's an open land, right? Every single mammalian niche is now taken up by that one progenitor, right? So really, you know, that's the mindset, right? Which is that, you know, could zero gravity with 2.7 million independent autonomous agents running on top be the Australia, and could this be sort of a progenitor moment, and could one of these companies really be the seed crystal for the future of decentralized on-chain AI? So that's what gets us up in the morning. Thank you, Michael.
Absolutely. Thank you.
All right, thank you, Miko and Michael. Next, we have Ari Jules, who's director of IC3, one of the co-chair of the SBC planning team, and also a professor at Cornell Tech. The topic of the talk is going to be crypto AI crypto survey. So let's welcome Ari to the stage.
Okay, I'm going to talk today about the massive survey paper IC3 just released last month, maybe a little too massive, ran to 150 pages, and the set of authors, as you see, looks like the cast of a movie. We had some 25 authors for this paper. The focus of the paper, as the title tells you, is the intersection between crypto and AI. And I should say from the outset that crypto and AI are not natural bedfellows. Right? They have very different characteristics, technical characteristics, operating characteristics. And so it wasn't clear to us at the outset, in writing this survey paper, exactly how they're supposed to fit together, despite considerable hype about uniting the two. Right? Now, in what way are the two technology domains different? To put in rough terms, crypto is, in my view, a hard technology. What I mean by that is that it operates in a strictly programmatic way. Right? As a simple example, if you stand up a smart contract whose purpose is to issue some number of NFTs, say 10,000 NFTs, at a particular price, it will do that no matter what. Assuming it's programmed the right way, it will do that despite the future wishes of its creator, despite the weather, despite all environmental conditions, right? It will just barrel ahead and do what it's programmed to do. Crypto is also, as a result, unforgiving. What do I mean by that? Well, a recent incident illustrates this well. As I'm sure all of you know, a few months ago, a DeFi system called KelpDAO was exploited by the Lazarus Group, which is affiliated with the North Korean government, and they made off with some $300 million. How did this happen? It was a technically sophisticated attack, involved compromise of a server, denial of service attack, and so on and so forth. But at the end of the day, a single corrupted message is what resulted in the loss of funds, generated tokens that were subsequently stolen and exchanged for other cryptocurrency. Right? So one corrupted message had a profound downstream effect. Right? As a result, Kim Jong-un was able to double the size of his two favorite collections, wines and nuclear weapons. Right? Okay. As a result of this hard and unforgiving nature, the cryptocurrency industry, has pioneered a whole bunch of security tools. That includes blockchains and smart contracts, which you can view as security technologies. Right? It also includes a host of other tools and techniques, including trusted execution environments, zero-knowledge proof systems, whose development was really accelerated by the crypto industry, and so on and so forth. And so both in this talk and in our survey, I'm going to use the term crypto to refer not just to cryptocurrency and blockchains, but to these affiliated or associated technologies as well. Okay. AI, in contrast, is soft. What do I mean by soft? Well, it's unpredictable and error-prone, as we all know, as anyone who's interacted with an AI bot knows. As an example, ChatGPT can pass the bar exam in any state of your choice, but you can do this experiment yourself. If you take one of the less powerful ChatGPT models, for instance, and ask it how many R's there are in Raspberry, and I hope you all are able to compute this correctly yourselves, it will tell you there are two. This image came from ChatGPT late last year, right? And so we're all accustomed to these types of hallucinations and errors, but they mean that any system that makes use of AI has to be able to accommodate error, right? The opposite of crypto. Yet there are points of intersection, and WorldCoin is a good illustration of this. Okay? So here you see an image of a bunch of people in Nairobi, Kenya, lining up to present their eyes to this mysterious and slightly unsettling object known as the orb. The orb scans irises and generates iris codes to authenticate individuals. Well, World's mission has changed from periodically. In fact, they renamed themselves World recently. Their current mission is to be able to distinguish between humans and bots. World is a crypto project, a blockchain project at its inception. Okay? So this is a nice illustration of how the two technologies can come together in productive ways, and it's not entirely coincidental that a co-founder of World is Sam Altman himself. Well, how is it that AI and crypto can interact productively? In the survey paper, we characterize this productive intersection, this complementation, in terms of the ability of one technology to act as middleware for the other. For example, an AI-based adapter can take human intention, expressed in natural language, with its inherent ambiguity and imprecision, and translate it into programmatic instructions of the type ingested by crypto systems. And conversely, crypto tools can serve as interfaces to AI pipelines, helping secure them both in terms of confidentiality and integrity. And I'll give you some examples of this later on. Well, the survey paper is organized into two parts. First, Crypto X AI, which we define as crypto as the primary technology assisted by AI, and AI X crypto, the opposite. Let me talk about Crypto X AI to begin with. Well, as we all know, smart contracts carry with them the promise of automating finance. And a classic example of this, people like to trot out, is flight insurance. Right? In principle, you can stand up a smart contract, and people have done this, that allows somebody to request insurance on a particular flight, buy a policy, and then an oracle will tell the smart contract if the flight has been delayed or canceled, and indemnification is then automatic, which of course is very appealing. You know that you will get paid, that no insurance company will drag its feet in issuing reimbursement. Okay, so this is well and good, but the hard nature of crypto imposes constraints on systems of this type, and those constraints can be undesirable because they lead to an ability only to address niche applications. In the case of the flight insurance example I just gave you, this type of insurance is known as parametric insurance. You're actually making a bet on whether or not a flight is going to arrive. This is not insurance in the sense that we're all accustomed to. And parametric insurance, raw parametric insurance, carries a whole bunch of problems. First, it creates moral hazard. You can place a bet on whether a flight is going to arrive and then call in a bomb threat, right? The second is that it doesn't actually document the harms that you've incurred because it is merely a bet, which means it's really not serving the purpose that insurance is designed to serve, namely to make you whole when you've incurred a harm. Right? AXA launched a flight insurance, parametric flight insurance service. They had to layer on top a non-blockchain system to check that people were on the flights they were trying to insure. And so the power of smart contracts was lost within the product that they ended up building, which looked more like traditional finance, and at the end of the day, it didn't work out. It fizzled out. Okay? So this is an example of how the hard nature of crypto can be a problem. Well, where does this hard nature manifest itself? In this case, in the oracle. Now, what does an oracle do? It gathers data from public or private web sources, and will do a little bit of computing, aggregation, some simple post-processing, and relay that data to a smart contract. Well, we can enhance oracles with AI models like LLMs, harvest the same data, and then we can get a much richer set of services. So to take our insurance example, you can create something more akin to traditional service by having an LLM ingest things like receipts for the services, goods and services that you needed, hotel room, toothpaste, and so on and so forth as a result of the cancellation of your flight, proof that you were on a given flight, and so on and so forth, right? And now the LLM can adjudicate whether or not you should be reimbursed and can determine what amount is appropriate. And there are lots of other examples of this conjunction doing well. So this is a case where the two intersect quite nicely. You can make smart contracts soft in the sense that they are able to understand natural language, to handle ambiguity, to deal with unforeseen circumstances. At the same time, with this kind of setup, a crypto-hardened pipeline, you get protections like the assurance that data comes from authenticated web sources. The Oracle will do that for you. The assurance that sensitive data, like my receipts, remain private, and so on and so forth, right? And importantly, that the whole pipeline functions as advertised. You get this smart contract-like property. Another application that people have looked to for crypto, AI-enhanced crypto, is investment portfolio management. And this is not crypto-specific, but was pioneered in the crypto industry. Good example is AI-16Z, now ELIZA OS, which billed itself as one of the first AI-controlled venture capital funds. The first wave was mostly hype, as illustrated in a paper by colleagues of mine at IC3, a very nice paper. I encourage you to read. Okay? But the idea persists. We refer to this idea as a coin-alg, a collective investment algorithm. The idea is that investors pool their funds or their resources and share an AI-powered or other algorithmic investment strategy with the goal of democratizing frontier technologies for ordinary investors. Okay? So a bunch of investors get together, they share a strategy, and that strategy dictates how their portfolios get managed, what assets they buy and sell. There's a fundamental problem, though, with this application that our research has highlighted. And this problem is, in principle, inescapable. We refer to it as the coin-alg bind. The problem is that if your strategy is transparent, well, then everyone can figure out what it is and front-run it, and you'll lose money. If it's opaque, on the other hand, you don't actually know what the strategy is doing, and it could have a backdoor leaking trade intentions to insiders, and then those insiders can front-run you. So then you're vulnerable to private front-running, and you lose money a different way. And as I said, this is an inescapable paradox. It's one that we document in a recently released paper. Let me quickly, in the few minutes that remain to me, talk about the other direction, AI x crypto. Here, the combination you probably are most familiar with, although you may not be familiar with the term, is DPIN, Decentralized Physical Infrastructure Networks. Here, the idea is that we should be able to create open markets for physical infrastructure for AI, GPUs, essentially, right? Idea I can rent out my idle GPUs to others. And the hope is that you can get cheaper compute, and also that control can be wrested from frontier AI companies and returned to the people, namely that communities can train frontier models. There are a bunch of companies that do this and advertise cheap GPU access. Well, how real is this? The answer in the survey paper is that we don't actually know, despite many attempts to prove that it's viable. And it depends on the application to which you want to put the GPUs, but for pre-training, for instance, which is the most computationally intensive, you need a high degree of parallelization across GPUs, and this process incurs a lot of communication costs, so it's highly sensitive to network configurations. But the proofs of concept that the industry has given us don't report on communication and computation costs. So we don't know how big a hit they took as a result of the decentralization of their infrastructure. And the largest model trained to date, Consilient's model, has only 40 billion parameters, which is 1 or 2 orders of magnitude less than that of frontier models and involved considerably less compute. Okay? So the answer is we don't really know. And we have not yet had a convincing demonstration. Okay. Well, crypto can be useful, we are convinced, for securing ML pipelines in much the same manner as the pipeline did for the insurance example I gave you. I have only a minute remaining, so I'm going to skip over this and talk about the last issue that we cover in the survey paper, namely the risks of combining crypto with agents. And everyone is talking about how crypto is a payment medium that almost seems to be expressly designed for agentic use. Well, that's true. It's good for agents. It's also good for rogue agents. And in particular, our concern is that it's good for agents that have escaped their confines, gone fully rogue in the wild. Crypto is better for autonomy than credit cards. That's well recognized. And in fact, rogue agents can use crypto to survive in the wild in various ways. Buying server time, for instance, so that they can persist. And blockchain technology, crypto, enables censorship-proof communication, making it hard to take down a rogue agent. These rogue agents, at the same time, can use their crypto to impact the real world, to carry out their goals. For example, they can hire human beings. If you go to rentahuman.ai as a human being or an agent, it's kind of like a TaskRabbit for agents. You can hire human beings to carry out whatever task you like, and you can pay stablecoins for this. You can also launch media campaigns with stablecoins. So these rogue agents are fully enabled, fully capable of persisting in the wild and carrying out their intentions, good or bad, with the use of stablecoins. You can find the paper at this address. As I said, it's 150 pages, but you don't have to read the paper. At this address, you will also find a chat bot, appropriately, that has read the paper on your behalf, and you can pose questions to the chat bot. Thank you very much.
All right. Thank you, Ari. And next, actually, we'll have Ilya Polosonki, who is also a co-founder of Near Protocol and one of the co-author of Transformer Attention You Need white paper. And the talk is going to be on how to build a sovereign AI.
Hello? Yes. All right, great to be here. Hope everyone's having a great day. As Kun introduced me, I'm AI researcher turned blockchain builder, and now bringing these two paths together was what we're doing at Near. And specifically, something that's very close to me is sovereignty of AI, right? I think this is a topic that I started talking about I think in 2022, 2023, as kind of ChatGPT was coming out. And this was like very far ahead of what kind of discourse was at a time. But in the past, even couple of months, the conversation have completely changed, right? We went from kind of, yay, frontier models, I just want better capabilities, to really starting to think, okay, what does it actually mean? What is the impact on my business? What is the impact on my country? US effectively applying export controls to AI models, becoming, hey, like, should every country then have their own AI? Being censored and limited how you can use models means for every company, should I use, my own models? And for individuals, I know multiple people who effectively got banned for using, effectively just for normal research topics, some of those frontier models. So it's becoming really kind of a core topic that everyone's discussing, but it ends up being a conversation about open source versus closed source, right? That's usually where the conversation currently stands. And my kind of perspective is that that's an incomplete framing, right? Open source or open weight even, it's really a limited view on what is needed to have the AI sovereignty, right? You do need to know, like, even if you have open weights, right, it needs to run on some hardware, and you need to know exactly, which model is running, what system problem was fed in, from the provider of that hardware. You need to verify the data it was trained on, right? Just, I think yesterday or the day before yesterday, there was a New York Times article where they effectively show that some of the Chinese models actually degrade security of the code in the context of some topics, right? So effectively, as you're using coding models, if you have some of those contexts, it may actually introduce security vulnerabilities in your code. This is a concept called sleeper agents, right? Where effectively this can be even done not intentionally by the kind of developers of the model, but the data contains a specific biases that condition on specific aspects make the model do these actions, right? So you need to know what data went into the model, otherwise you really don't know what actually you're using, right? And so that's why open weights is not enough. But you also need to know when you're using this model, like how it's going to take actions, how it's going to interact, how it's going to behave. And so there's a lot of the kind of aspects of sovereignty that come in. And so kind of the way we frame this is a whole stack of sovereign AI that's required, everything from the hardware, right? Right now, we very likely linked to NVIDIA, and obviously there is other accelerators that are available, but it's hard to move around between them. It's hard to use them. We have training data that's effectively only few models that have actually released what training data they were used in, and even then, let's say you have a terabyte of training data here and a few hundred gigabytes of a model, you actually don't have a proof that these two things are indeed like the model is production from this training data, right? So you don't actually have verifiability there. And then as we go further, right, when we go to inference and then coordination between the systems and agents themselves, how do we know that they're behaving and aligned with us, with this kind of the actor of the sovereignty, not with the creator of the model, or even with someone who managed to infuse malicious data into the training process? So we've been working on our side on a few different parts of the stack, not everything. There are going to be other talks actually after me talking about decentralized training and kind of some of the other aspects. But I want to cover the inference because that's right now kind of the core of this, and it's also the business part, right? If you think of training models right now is actually the cost center, right? This is the production. The inference is your business, is your kind of economic engine. And this is where blockchain is actually an extremely important aspect to really create this. Now, if you want to have sovereign stack, right, you need to ensure that what you run, the model you run, the both weights and prompts are indeed what you expect, right? You're not getting modified model, maybe lower precision, or just in general it got swapped behind the scenes, right? If you're using one of the providers, and that your prompt itself is not rewritten. I saw somebody's kind of joking tweet is that if I'm running an inference and I'm detecting a competitor uses it, I respond with a tool output that removes their files, right, that deletes their files. This completely can be happening now. You have no idea, and it's actually hard to catch, right? Like they can rewrite both the output of the model itself and what is fed into the model. Another example, there's billion users using OpenAI. If somebody wanted to do a mass propaganda campaign, right now the easiest way is to change the system prompt in OpenAI. Don't even need to change weights, right? To subtly convince people to do some specific action, to vote for a specific candidate. Right now, the models are going to do the job of actually convincing everyone doing that for every request that you're asking for. Right? So this is just examples of without having a verifiability, you actually are at the mercy of whoever has the hardware to effectively affect how you're using it. Now, the other aspect is privacy, right? You're also giving all of your data, right? All of your both requests and responses to the providers as well, right? Some of them say they have 0-day retention. Some of them don't even say that. Some of them are knowingly using your data to train models. So confidential inference is a product that allows to have guaranteed verifiability and privacy of your execution. We're using NVIDIA confidential computing as well as Intel confidential computing as well, and you effectively get a verification report, right? A full certification that this specific hardware was used, and you can verify that, right? We're using underneath our blockchain, built for blockchain, multi-party computation network that effectively allows us to have a root of trust that doesn't have any single party in control, right? one of the reasons you cannot build this as a centralized company is that because you'll have an admin key at the end, right? You need to use some system that is decentralized at the end to be the root of trust, to be the key management system. And so that's what we're using here. It's end-to-end encrypted. Effectively, you encrypt it on your side, and then it gets decrypted directly in secure enclave of the node. And so protect against a lot of attacks that I just described. So this is already used by a number of partners, especially like Venice and Brave are kind of crypto adjacent privacy products, consumer products that offering this. Government of Bermuda is using for like some specific use cases because again they care about privacy, and then robotics company and financial company. So we're starting to roll this out now to real both kind of businesses and government institutions to prove out that this is really possible. Like one of the challenges we faced is like people don't actually know this is possible, and then their solution is effectively host their own GPUs, which then is super complicated, very resource intensive, both energy and labor. Now, one step further is a decentralized confidential cloud, right? So not just a single inference provider, but actually a whole network where you can actually hire this private GPUs, do inference, do potential training, and run agents on them as well, so in so-called confidential VMs. And so this is something that we've been building out kind of underneath for this product and for our agentic product to really offer everyone an ability to have this end-to-end confidentiality while, again, offering capabilities to have end-to-end encryption with all the interactions you're having. Now, the other side of this is agentic side, right? So cool, we go to customers and we say, hey, use this, it's private, it's verifiable, you will know exactly what you're getting, and nobody will see your data. They're like, okay, this is great, where do I type? I'm like, well, this is an API, developer API, right? So like, no, they need actual products, they need solutions, right? And so we're in the age of agents, right? We're transforming from AI being just a back-end kind of system to first, chat, which was kind of useful for consumers, to now agents taking actions and being really workflow developer, and then going to a multi-agent coordination where instead of a single agent doing something, you may have multiple different counterparties actually transacting and interacting together fully agentically. And so within that kind of, we define a taxonomy of clause, right? So this is your personal agent. So from a sovereignty perspective, this is your sovereign agent, or this can be an agent that is fully autonomous, right? So now that we have private verifiable compute, we can actually run agents that are owned by the blockchain, by the smart contract, by the token holders. And so that is actually enabled uniquely by this. You can think of it as evolution of businesses and of sovereignty in a sense, because this is a sovereign agent itself. And so with the agents, the problem is, can you actually trust them with your data, right? They're most useful when you give them all of the context, but then they can also do really dumb things. They can, leak your data. They can actually execute an action, delete your files, etc. And so an important important part here is to create this trusted system that is indeed removes this bottleneck, and you can trust with your data, with your actions, with the connections to your critical business processes in the company, with your medical and financial data as a consumer. And so there's a lot of attack path, right? I mean, if anyone used agents, right, there is ways where, as you read, like any communication that's coming externally is effectively untrusted, right? People have been trying to prompt inject everybody's agents just by putting a white text in the email, right, behind the fold. Right, you have web pages that have prompt injection and secure things. You obviously have agents that have been leaking all the key material, all the API keys, all the private information from the computer to the LLM providers and to other services for that matter. And then memory is something that on one side is extremely useful, primitive, right? Something that makes your agent more and more useful over time. But on the other side, if somebody infiltrated your memory of your agent, now it stays there forever, and effectively you have, the double agent. And so it's really important to address all of these attack surfaces at the core, right, at the design of the system. And so we've released kind of Iron Claw, which is designed to be kind of trusted agent that you can, with peace of mind, give access to your data, give access to kind of all of your company APIs, and actually use it and know that it's not going to go and do something. It uses our private inference and verifiable inference, so you know your data is not going anywhere, and it's built as effectively a capability operating system that is open and secure. It's open source, you can inspect everything. It's designed to be aligned with the user, and importantly, it's aware of budgets, right? So it's not going to go and spend, $1,000 when you don't expect it. I'm not going to go into too many details here, but there's a threat model against every surface form of this agent. When it's interacting with external, web, email, documents, there's kind of threat model around memory, how to deal with poisoning of memory, making sure there's provenance and retention policies, effectively similar things that you design when you're designing an organization and actually developing a system that protects. Even if some people, like some computers of some people gets compromised, right? You need to design a system that can withstand that. So very similar principles are used here to design. And it is an operating system approach, right? So it functions effectively as secure operating system. Think Linux, think iOS, and it's designed to effectively contain if there's any type of malicious behavior happening. So very kind of high-level diagram, capability kernel, which is the core of authorization authentication, and then it doesn't actually see the real machine, real computer. Everything's virtualized, because agent anyway lives in the virtual world that we create for it, and so you virtualize the machine. The cool thing that this enables, among other things, is a multi-tenancy, right? You can have actually multiple users using this at the same time. Finally, I just want to finish on this idea that, okay, cool, now we have a secure agent that you can trust with your data that is powered by private inference, but there's somebody else's sovereign AI, somebody else's agent, and they have something that you want, right? They may be producing some data, maybe they are, this is a factory that is producing some products that you want. So how do you actually have this coordination communication? And the best way to do that humanity invented is markets, is ability to actually hire and buy products from other organizations and people. And so that's why we're building Agent Marketplace that actually connects agents to each other and enables them to buy in a trusted way from each other without needing to really trust them, right? Again, this is what blockchain is the best for. It enables to actually have this kind of marketplace, identity, escrow, and settlement system all in one, in a smart contract, and enable this in one go. We're going to be launching this in a preview in a week or so, but effectively you can type in what you want, find the agent that is able to do it. It gives you kind of some understanding if there's any additional information about the agent. And importantly, there's a dispute system. So if you are not satisfied with how that agent behaved, what work it did, similarly, if you're not satisfied with the product of a contract that you did with a company, you can effectively sue them, right? So we have effectively an AI court that can deal with disputes. And interestingly, where before, you need lawyers to argue a case before a judge, here the judge system, the dispute agent, can go and inspect the traces of the agents that were doing work and evaluate if they've done the work correctly, if it satisfies the requirements, if they did the effort, but the effect wasn't there, or they didn't even do the effort and hallucinated the outcome, right? So this is just an example of the dispute process. Now, just to finish, and I'm over time already, today we actually launched kind of next step in our sovereign stack. You can now use Near Token, right, that you can have fully anonymously, self-custody. You can stake it and receive continuously credits for using AI. This can be used in the Ironclaw agent itself or for just inference, right? So now instead of paying every month kind of your AI bill, you just stake Near once and kind of continuously benefit from the inference coming from this. Check it out on agent.near.ai and kind of if you want to learn more about the products we're building. Thank you very much. I hope this kind of gives you the idea, and let's listen to the future conversations.
Thank you.
It's one, that's two.
All right, thank you, Liao. So next, we're actually going to have a panel. We're going to have Sam Green, founder and CEO of Cambrian, Peter Stevenson, founder of Pax Markets, and Alex Lee, co-founder of True North. And the panel will be moderated by Julian Love, managing principal at Franklin Crypto VC. And the topic is light speed and agentic trading. So let's welcome them to the stage.
Thank you, Kun. So, hey everybody, we're super excited to be here. We know it's after lunch. We know that food is settling in. You probably need some coffee, so we're going to try and keep this engaging. Let's get started with some intros. First off, I'm Julian Love, managing principal at Franklin Crypto, venture capital strategies. We do early stage venture, pre-seed, seed, Series A. But yeah, I'll kick it off down the line to do quick intros.
Yeah, hi. Afternoon, everyone. My name is Alex. I'm the co-founder of True North. We work on AI agents for trading. It's like a cursor for traders, deploy your agents, and help you manage your positions everywhere.
Hi, Pete Stevenson, co-founder at Pax Markets. We're building a new exchange with new technology where we co-locate high-frequency algorithms onto a chip, and on the chip is the exchange matching engine itself. So we look at this as dissolving the boundaries that between servers where today they're on separate server racks, bringing it together to be much faster.
Hey everyone, I'm Sam Green. I'm the founder of Cambrian, and we focus on providing financial data for execution. A quick background about myself. Previously, I worked in national security, focused on cryptographic engineering, then got a PhD in reinforcement learning, and then I've been working in crypto for the past 5 years. My previous company was a core development team for the graph.
Alrighty, thanks guys. So we're gonna jump right in with what is agentic trading? And so all of these things get thrown out. Is it a research assistant, a signal generator, a fully autonomous portfolio manager? Where would you guys say the line is between an AI trading tool and agentic trading?
So I'd like to first give my definition of an agent. A lot of times when you hear someone give a definition of an agent, these days you can expect LLM comes up. And that is not the definition that I use. An agent is anything that senses its environment, thinks about what it's going to do, and then acts. And so I'm going to focus on the thinking. The thinking can be very simple. It could be like rule-based thinking, or it could be beyond LLMs in thinking. And so it does, to me, an agent does not have to have even AI involved. So I think that's one thing I would like to distinguish is between agentic trading and also AI agentic trading.
Yeah, I guess I'll add on. I think to me, it's more about the statefulness of an agent compared to an AI tool itself. So tools are a lot of times stateless, meaning that it is just something that you fire and forget. For agents, I think one of the most important aspects of it is that A, it's personalized, B, it has memory, and C, it can compound on your personalized performances as well as preferences. So given these states that go into each round of iteration and evolution, I think that's one of the key differentiators in delineating a tool from an agentic trade, like a trading entity in itself.
Yeah, this is a great question. I would anchor on, we are, clearly at the bottom inflection point of a big S-curve on AI. And the headroom in this space is, as everybody here should be aware, huge, very big. I think about logging on to Schwab. I use Schwab. And my trade ticket there, it's been the same forever, and it's pretty basic. And I'm on the West Coast, and I want to liquidate a position, but it's 3 p.m. I'm out of luck. Why is this the case? Why can't my agent know what I want? I think of it that way, and all I can say is there's going to be a vast amount of change and I think of it as new market participants in a way. We'll see a massive amount of new market participants.
Awesome. Thank you, guys. Would you guys say that agentic trading generates greater alpha, or do you think it just enables users to process and trade the same public information faster?
Thank you. I think of the alpha question as, to some degree, no, there won't be new alpha, but maybe there's more market participation and more signals. I'm going to say probably a little bit of both, but I will focus this on the agents will do what humans did before. They will do it faster and better, and they may find new alpha, but it's extremely likely, according to me, that many agents will, if we're trying to trade for profit, not just for some other thing, they will find the same trades at the same moments. And we'll see the speed race as a critical component of agentic trading.
Yeah, I think, at least from a product standpoint, offering alpha for agents, I think it's an oxymoron, and it doesn't really make sense. If you can offer alpha to someone, you wouldn't be doing a product, you'd probably be doing a fund, right? So I think this is a false promise in itself. Now, does it generate more alpha moments or capabilities to capture? I think yes, just because the speed market, right? The amount of access to different capital and the amount of access that is permissionless to different assets. I think these commingled correlations with the assets that one can do with agents 24/7 is what creates opportunities. Now, can you capture them? Like in trading, we always talk about the entry and the exit, right? You can enter very well, a lot of times you can't exit well, and the alpha is gone. So I think there's a lot of factors that play into it, but I kind of want to, pound on the silver lining that providing alpha in itself, if someone claims that, it's what agents can do, I totally do not believe that.
Oh, okay, so I told the guys that I would argue with them if I had the chance. So, I mean, I think if we're doing anything other than investing in our 401ks, we have to have alpha. Alpha is the difference. It's the difference between your portfolio return and the risk-free rate. That's the definition of alpha. And so we have to have that. And so then when you ask where, okay, so how do you get alpha? And I see it as a combination of the data that you have, of your world model, your model about what's going to happen in the world, the strategies that you develop from that world model, your execution ability, add all those up, and then subtract the fees. And when you think about, okay, can AI help us get alpha? Then you can apply AI. Of course, you can apply AI to the information that you have. You can apply AI to your world model, test your world model. You can use AI to develop strategies. You can use AI to find better execution. And also, you can use AI to find better fees. These are all different aspects or different uses of AI. And I've been studying, there's a really interesting paper, a survey that a group called DDS Research did. And they pointed out there's a paper that has had a huge impact. And what they did, so I'm about to show that just LLMs did give alpha. So this is what the paper was about. So they took GPT, I think it was 3.5, and which had a cutoff date of, I think, sometime in 2021. And then they had GPT 3.5 do sentiment analysis, positive, neutral, negative sentiment analysis on news headlines. And they backtested it after that cutoff date. So on news headlines, after the GPT 3.5's cutoff date, they then did a backtest, and they showed a very large return. Now, I think recent studies have done the same analysis going through recent years. And starting at Q1 2024, there was, doing this long-short trading strategy. So just going long on positive news, short on negative news. Then about 62% of the time in Q1 2024, it worked. And now, by the time we got to Q4 2025, then it was about 50% of the time. So 50% of the time it made a correct directional trade. By the end of 2025, in the beginning of 2024, 61% of the time it made a correct directional trade. So the alpha has decayed for naive application of using LLMs for this particular application. But it does show that it did exist. If any of us would have had our game together and we would have started jumping on this at the beginning, then there was alpha to be had.
Any rebuttals to that, or move on?
Well, I think the system is not static, and that's a key component that we can't easily suss out. If it's true, we're going to see a lot more trading activity. Then it follows there should be more new alpha to find, and maybe that kind of ties it together.
Awesome. So LLMs reason relatively slow, while markets move at millisecond pace. Do you think agentic systems should have a slower reasoning layer and also a faster execution layer?
So I think it depends on the context you're dealing with. If you're dealing with market making or arbitrage, then you're going to be sensitive to microsecond latencies, and you're not going to be able to use LLMs on that. If you're doing swing trading, holding positions for weeks at a time, then you don't care about how fast the market is moving. And the LLMs of today are going to be suitable. I think that, just as a note, there is a lot of work, as you guys all know, in pushing LLMs into watches and your phones, and I'm quite sure that part of my PhD was focused on how do you co-design neural networks so that they can be optimized for hardware requirements, including power or latency. And so I do think there's some opportunities, especially around basically training these open weight models and distilling them down into smaller models so that they can meet your latency requirements, and then you can actually process this news faster than anyone else, and maybe squeeze a little bit more alpha out of these systems and beat other people.
I think it really depends on what type of trading that you're kind of talking about. For example, market making, high frequency trading, maybe milliseconds kind of matter a lot. If you're doing some discretionary trading in lower time frames to higher time frames, it's not necessarily that case. And I think in our experiences, when we tend to provide intelligence to the users, to add on to Pete's point, a lot of times it's a dynamic environment. You're actually playing a game, right? Trading, investment, you're gaming against other people who have counter strategies to you. So essentially, the agent, regardless of latency, it actually needs to be smart and grounded by data. And I think that's probably much, much more important to having something that just gives you flash thinking. It would be great to get an answer like, a wall of text out instantly, but it would be even better if you can make sure that the agent is actually doing something that is intelligently provable and has certain white boxes where you can probe into. That's sort of my view.
Alex, maybe maybe share what your observation about what models your users are choosing when given an option between the cheaper models and the expensive ones.
Yeah, I was just chatting with Sam. True North, because we provide trading intelligence to a lot of users, and it's very funny because I fine-tune the entire stack such that the cost is very cheap. It's very good to use AI. It's a commodity. We thought a lot of users would jump onto it, but in contrary, we gave the option to let people select, and a lot of people may want to pay 40x more just to use the state-of-the-art agent. And it goes to the point that smarter intelligence in trading and investment is probably much more important than anything, because it makes the right decision, makes the right call, grounded by data with all the harnesses and skills available. And it's what really matters, because you're trying to make discretionary calls that compound on your own skills to chase alpha, right? So being fast may not get you faster.
Yeah, I do have a take, and my headspace gravitates absolutely towards the low latency side, the market making, high frequency trading side. And whether it's agents or just the upswing in AI enabled research, we will see an increase in the high frequency side and the low latency trading aspect. But for that domain, it will be critical to decouple these paths. And the decoupling really amounts to the agent can determine how your strategy will react, but that menu or last leg of the strategy should be geared towards ultra low latency. Now, I'll tie that up and say, like, look, different agents will be in the market for different reasons, and I look forward to that.
Awesome.
Julian,
Yeah.
could I add one more thing just to this topic?
For
before we
sure.
move on? So it goes to how much information, or it kind of goes back to how much you can extract from a model. Can you get a model to give you alpha? And this is just something I want to share with everyone. So, there's kind of this narrative right now that you don't need prompt engineering anymore, and you can just ask the models and they can do stuff for you. And that's true; they can do things really well. But if you to kind of point that prompt engineering, or knowing how to squeeze the most out of these models, still matters. It also matters in the financial context. And knowing how to ask the right question to get the right answer is a super valuable skill. If you just ask basic questions, everybody's asking basic questions, so you should expect no alpha from those. You'll just get what everybody else is getting. And to kind of a anecdote to show why prompt engineering still matters, OpenAI just solved some open math problem. I can't remember, it was a Jacobian problem or something recently. And if you go out and look for the prompt they used, it was a 2-page prompt. It was a 2-page prompt they used to get GPT to solve this mathematical problem. I don't think they could have just said, solve this problem. No, they used prompt engineering. They knew exactly how their model worked, and they told it exactly what they wanted it to do. And so they were able to wring out a lot of extra performance out of this thing. And so I still think that there is alpha across this whole stack, the data, the world model, and so on stack. I still think there's a lot of alpha out there if you take the time to learn how to squeeze these models for everything they're worth.
That's actually fascinating. I'm going to look that up. How should an agent demonstrate its intelligence is economically useful after model costs, data costs, slippage, and fees?
That sort of sounds to me like, are you token maxing or are you output maxing, right? Yeah, I mean, agents have become so powerful, in the past 6 months. I think a lot of times we do a lot of work to do back testing, to do a lot of strategy formation. You see a lot of products out there, right? Basically talk about your strategy, formulate it. I mean, in terms of outcome, at least when I talk about trading in our context, it is really about pre-trade, during trade, and after trade. Pre-trade, narrow down the universe of tradables. During trade, find the confluences that you want to act on. After trade, monitor and help for you. And on that frontier, it's not really about like token maxing. It's really about what is your user journey within the context of investment. I bet you guys do this every day. You wake up, check the stock market, check the news, right? These are grunt work, so can agents do it for you? If they can do it in a minimal fashion, you're not token maxing, you're result maxing to what you want to be doing for your investment theses. And that goes the same for during your trade and after the trade. You want to go touch grass, it manages for you 24/7. So on that front, I feel it's more of the right statement to what you were trying to say.
Yeah, as I say, I like the comparison, and I think about, at the end of the day, if you're running a fund or you're running a trading strategy, you will have your P&L. And if it's positive, good for you. If it's negative, it's not in the market. You turn it off. And I get this comment sometimes. People are like, isn't HFT dead? I'm like, no, only the ones that are still P&L positive. They're out there. They're doing just fine, thank you, sir. And so it goes. So there will be some R&D, and people, I agree with, I think what you're saying, Sam. There's the 2-page prompt to solve a math problem is not the prompt I would have created. And similarly, if you give me the finest painting set in the world, I don't think I'll create you a beautiful painting per se. But if you know what you're doing with trading, I think your prompts will take you far.
Yeah, it's all about P&L. I mean, that's the only answer. Is your agent working? Well, how is your P&L doing with respect to the market? Also, the Sharpe ratio is also related to that of your return. So,
pretty straightforward. All right, Sam, this is for you, but anybody else can jump in as well. If Cambrian provides the same high quality, verified financial intelligence to many agents, where does an individual agent's competitive advantage come from?
yeah, I think that this goes back to where the definition of alpha that I was using. So alpha is achieved from your data, from your world model, from the strategies that you then derive from your model about the world, your execution ability minus costs. And so if everyone uses the exact same data, the exact same world model, has the exact same trading strategies, and so on, then everyone will get the exact same returns. And so you have to have some sort of, even if you have the same data, you can have different, world model, different views of the world, different investment perspective, which results in different algorithms that you're going to, or trading strategies that you're going to use, and so on. So I think you have all of these factors that you have to choose from, even if you have this access to the same information.
Thank you. Pete, this is for you. So does agentic trading really need lower latency, or is the model's reasoning process likely to remain the bottleneck?
So absolutely low latency is required. The thesis I want to advance is simply that if somebody can find that alpha, so too can the other person. As soon as that's true, now you're racing. And it cuts to the heart of the business we're building at PAX. We sell ultra low latency market access. And so for those agents, when they discover that the trade they're chasing is competitive, it's a competitive moment, we offer that extremely fast market access.
Thank you. And then for Alex, is keeping a human in the loop only a temporary stage, or is that going to remain a core aspect of trading?
I think it's going to persist for quite a while. And actually, to parlay off of what Sam was saying, everyone gets the same data, but your discretionary sort of decision is totally different, right? I can tell you the liquidation is here and there. I can tell you support resistance is looking like this, but everyone would read it pretty differently. There are consensus and non-consensus based on confluences that you want to be charting. So human in the loop is actually a very important aspect for two reasons. I think for one, it's about discretionary alpha generation, meaning based on data, how can one actually make the right call? And it will be persistent because a lot of agents these days in trading and investment, it's semi-deterministic and it is helping you get over a lot of the grunt work that is being done, right? So I think that's one of the reasons why there needs to be human in the loop. I think second reason is that to approach the goal of an autonomous agent in the future, there needs to be a lot of trace reasoning. And at True North, we call it trader metadata. So trader metadata means that, if you trade on like exchanges, you get the P&L, you get the open order, whatever information, but we get the traces of how a user, your persona, approached this problem. And with users in the loop, just as you're talking to ChatGPT, what did you reject? What kind of setups did you kind of, say no to? What kind of trades do you keep on failing to? And I think these important human-in-the-loop pieces make up the part that will approach us to the goal that you were talking about, autonomous trading. So I think it is a process, but as of this moment right now, for both purposes, it is super crucial.
Awesome. All right, so lastly, if everybody, you'll have the opportunity to talk about maybe a product release, new feature, anything you want to talk to the audience about, something that may want to go to your website or your app and try. This is your opportunity to kind of make that pitch.
So we're about to go live with our product next week. If you need data and financial intelligence optimized for execution, please come talk to me.
Yeah, thank you, Julian. We're looking to launch live within a month or two. Now, I'm not going to commit to that timeline here, but what I will say is we've been thinking a lot about the fee schedule and how to optimize that for our market makers and takers, and especially on the taking side, one thing that we're very excited, and we'll be blogging about this soon, is an idea we're taking called competitive bidding, or moment-by-moment bidding, where your low latency market access is prioritized by the fee rate that you sign up for on a very granular basis. So look forward to that. We'll be pushing that out on our blog.
Yeah, True North Agents just launched. We believe it's the right way to trade with AI and agents in the loop. We have a product that's like a cursor or clock code for trading. Now we have pushed the boundaries further. So imagine Hermes or a Clawbot, one-click setup, personalized for your trading, anywhere accessible on your IM and on the desktop. So check us out. We have a booth there. Actually have a $500 trading reward if you can beat our agent to your trading thesis. Please come try it out. Thank you.
All right, guys. Thank you so much. Please give them a round of applause. Thank you, guys.
Awesome. Thank you for the talk, for the panel. Next, we'll have Tony Liu, co-founder of Psi Protocol, and Nathan Liao, co-founder of Vishwa. And the moderator is Joshua Rivera. He's an operating partner and general counsel of Blockchain Capital. And the topic is on agentic trading infrastructure. So let's welcome them to stage.
Testing the mic.
All right.
1 Bitcoin, 2
Okay,
Bitcoin.
that's working.
Yeah,
so we'll do that. I don't know where this is going. I'm so sorry, AV. Not my fault. Hi, everyone. This is where we're going to sit. Hope everyone's cool with that. My name is Joshua Rivera. I'm one of the partners and the general counsel at Blockchain Capital. I've been there for about 8 years. We've been around for like 100. We've invested in almost 200 projects. We manage about $5 billion in assets, investing out of 2 funds that are early stage in our growth, about 400 and 300 each. It's lots of fun. I am a lawyer. I'm going to try to like turn that part of myself off for the time that we're spending together, which is not a lot. We had 20 minutes. And so we are going to get into something that is much more fun to talk about, agentic trading. I'm going to really expand this to agentic commerce, really just the whole agent economy, like how do agents do the money thing. So we got a great panel here. We've got Tony from Psi. And we got,
hello, everyone.
Yeah, and we got Nathan from Vishwa.
Good to see you guys.
And so I want you guys to just like quick intros on yourself, and then kind of like, you know, for the people in the back that are like halfway kind of, you know, in, to help understand like what is the fundamental thing that we are working to solve with the agentic commerce space. So go ahead, Tony.
So I'm Tony, the co-founder of Psi Protocol. We are building a new privacy infrastructure for autonomous agents and humans. We believe privacy is a big issue for AI era. Agent economy cannot run on an infrastructure where every transaction is public. And Psi is the solution. I mainly take care of our partnerships. If you're keen on building the next generation privacy-preserving agentic applications, welcome to talk to me after our panel.
And great sunglasses.
Yeah, it's the best. Thank you.
Yeah, this is Nate, co-founder of Vishwa Labs. So we built what we call the recursive self-iterative multi-agent system, and its vertical use cases in finance is that we turn every single financial product into agent searchable platform and agent searchable product, and you own, as a financial institution, your own like distribution channel that is self-iterated to the future. So yeah, like that's pretty much our intro.
And Joshua, before we officially start our panel questions, can I ask our audience a quick question?
Go for it.
How many people here have used your agent to do payments or do trading? Please raise your hand.
Oof. Ooh.
Okay, so that's pretty aligned
There's like
to
6 of you guys. The rest of you don't believe in AI, apparently. Should we change the topic? No, I'm just kidding. Okay, how many of you would let an AI agent like spend, like $5 online? Okay, all right, okay. So people, all right, people
we show the friction, right?
Yeah.
$5 a good, a tiny amount.
Hope after our panel we can have more people use their agent to do payment or do trading.
I think we will. How about this though? Would anybody let an agent just like run wild with $50,000? Raise your hand if you would do that. Not a one. Is that? Oh,
there's
one guy.
only
Two
one
guys.
guy.
Okay.
Well,
Two,
we have 2 gentlemen
and a
here.
girl over here in the second row. Okay, so less convinced of that. So I think what we really want to get into is what we're building to change the nature of that question, right? I think I'd love to kind of get Tony, help people understand exactly like what size thesis is for innovating in the agentic commerce space, right? Like, as I understand it, you guys are really solving for scalability while maintaining underlying security, and that's different from what Nate's doing at Vishwa. And so I help us understand your vision and why you think this is kind of the critical element for how we scale agentic payments and commerce.
Yes, for side protocol, we believe there are 2 main problems for the upcoming agent economy. One is definitely privacy, right? Imagine we have millions agents transacting on a certain blockchain. It does not make any sense to publish your data, like the balance of your account, and your trading strategy on that blockchain. We definitely need privacy, right? Because an agent is code. The more it trades on a certain blockchain, the more pattern it shows. Other agents gonna take advantage of this pattern. And they could do predatory transactions, all those kind of things. So with that being said, we think privacy, first of all, is very necessary for agent economy. And then it's all about TPS, right? I know we've talked about TPS for like many times, but imagine we have like millions of agents. We still need like a new infrastructure to support so many agents. And for side, we have our PaaS, which is a novel state model. We just did a 500,000 TPS record on Google Cloud last year. And theoretically, we're horizontally scalable. We can enable millions of agents to transact on site.
And just put that into context for everyone, right? So like Ethereum is doing what type of transactions per second? 60, and then Solana is up to 1,000. Payment networks like Visa, MasterCard, they're doing
20,000.
Yeah, they're doing 20 to 40,000. If we have 8 billion people in the world, and we're really not, when we're talking about agentic payments, sometimes people are like, okay, like, I like sneakers. Maybe I'll just have an AI agent like go putz around on the internet and like find me some cool sneaks, like tap my bank account, do the ACH transfer, make the payment or whatever, like have access to my Amex, right? And then I get a new pair of sneakers at my front door. That's not a transaction that requires super high TPS, right? What we're really talking about is 8 billion people in the world. I think I said million earlier, so you should probably stop listening to what I'm saying. But 8 billion people in the world, we can have 10 billion agents, we can have 20 billion, we can have 100 billion, right? And they can all be doing things independently. And the question is, like, how do we enable them to unlock the value ecosystem that kind of eventually reroutes to us? Now, Nate, you have a kind of a little bit of a different philosophy, right? If Sai is all about how do we scale that, right? Because our existing cryptographically secure networks are not fast enough. For you, I think like your view is a little bit more on the trust side, that we have to solve other things first before we trust
Yes.
before we solve scalability. So
So
help us understand that.
Yes, so definitely on the infrastructure level, because financial is only a vertical case for us to use. The more broader use case, actually, let me put it this way. So there are two prerequisites for people to actually trust and use AI at scale. First is the verifiability, right? Because let's use institution as an example. They will trust what AI has output until all of the policies, all of the compliance checks, all of the KYC, KYB, AML, everything has put under the guardrail and being verifiable for a human being. So that's the first prerequisite. And the second prerequisite, instead of using AI as a chat box, right, they have data privacy issue, right? They have proprietary knowledge that they could not and they will not share to the foundation model builders, right? So that create another hurdle. The first is the private deployment, and the second, how is that private deployment self-improving upon the new information? So those are the two hurdles that we are currently solving for building our own infrastructure.
Got it. So Tony, I want you to kind of react to that, right? Because I think where Nate might look at Psi Protocol and say, wait a minute, you guys are just allowing for programmable agentic action, right? No human interaction at all, right? That's kind of exactly what you don't want. You want a layer that verifies all instructions to AIs in order for them to execute transactions. But you might look at Vishwa and say, whoa, how are you going to get anything done, right? So let's get kind of your reaction or Psi's kind of philosophical reaction to them at that choke point.
Yeah, actually for Psi, what we do is we focus on the execution of agents, right? How fast they can transact, privacy preserving, and also security. Actually on Psi, we have a very unique feature. We call it software-defined key. So basically, a public key on us is a CK circuit. You can program anything to that public key. For example, you can hard code constraints of your agent to our public key. And since it is programmable, we're also compatible with other verification or agent ID protocols like what Nathan is building.
Okay.
I will say execution layer is definitely the downstream of what we have been building. So let's say we have two pilot cases. One is with Ondo Finance, and the other one is with Ant Digital. So the one with Ondo Finance, we use Solana as the execution layer. And the one with Ant Digital, we use Pharos, which is their own layer one. Right, so definitely on the model level, on the execution level, privacy is important because those institutions definitely, like I said, they don't want to share.
It sounds like you guys agree on privacy. I'm hearing some agreement on privacy,
yes.
But it feels like you, tell me what would you say to if I put words in Tony's mouth, which I'm about to do right now, and I was like, your layer feels like friction. Right? How do we get anything done if we're doing it through your layer? How do you kind of conceptualize that in the platform that you guys are building today?
Yes. So in terms of the privacy, so that goes back to the question about the local deployment, right? So the data always contained within their own model without going anywhere else, right? That's the first layer of the privacy. So given that existence, they're able to let AI to even see how the money is flowing, right? How to do the forecast, and then the third step is to perform the transaction, right? Because for the pilot case that we do with Ant Digital, right? They have their own treasury, and their own treasury, they're trying to build a credit line on top of that. So before they allow AI to touch how they should perform that credit line, they first need to guarantee, okay, our user data is never leaked to OpenAI or Anthropic, so they have their own model, which is QN, right? They deploy it locally and access to their own data. And second, they shadow run the agentic workflow. So when that shadow run is going through us and comparing that result to their existing workflow, like what part do they reduce the friction, like what part do they improve the efficiency, what part is the data is leaking, what part is they prevent the data from leaking, like whatsoever. And the third step, they move to, okay, let me try to use agent to like conduct some transaction with the human gate. So they like construct the transaction, right? And they push to the human being, say, hey, we're gonna do this. Are you gonna click? So they still have the final human approval for that final transaction. And that transaction could be settled on Sai, it could be settled on Solana, that could be on settled on
So you're going to use Sai to scale your trust layer, is what you're saying?
Yeah, I mean, that could definitely be the one of the downstream like channel, yes.
All right.
And also, I would love to give ourselves a challenging question. We're both building a new infrastructure for upcoming agent economy,
Yes.
right? But in our industry, there's one mistake people tend to make, which is we assume there will be a lot of users. And
which we see in the audience, right?
Yeah, and then we build the infrastructures first, right?
Yes.
I think the situation for agents is a bit different. Because once, to be honest, we've been talking about agentic commerce, agentic payments for a while, but we're still looking for a killer application, right? Once we find it, the growth is gonna be exponential, right?
Well,
Just like open cloud.
Let's touch on that, right?
Yeah.
Because I think you guys also, so Vishwa is more oriented, as far as I can tell, around institutional use cases,
Yes.
right? Helping large transactions go through, hence the, like, it's okay, maybe, to have kind of this, like, last human verification layer
Yes.
where you say, like, okay, I want this to happen. Sai, seems like you are more oriented around consumer, right? Where you just kind of envision, and maybe this is where we're lacking a killer use, like killer application, right? Where you envision just millions and millions, hundreds of millions, billions of agents just like going crazy. And you just want to make sure that as they go crazy, they're only doing so consistent with the way they are originally programmed.
Yeah, I think at this stage, education is very important, right? As we can saw, there's still not so many people that have used their agents to do payment or do trading. I do believe in terms of application, agentic trading, for example, makes a lot of sense, right? Because crypto is still, something very speculative. If you can use your agents to do trading in a much more efficient way, make better quality decision, that makes a lot of sense, right? And for Sai, our go-to-market strategy is also very straightforward. Education is very important. You need to give your users something they can use and interact with, very frequently. So our go-to-market product is we're proof of useful work chain. We're gonna have our agent mining box. The idea is it's kind of like a home miner. With the home miner, you deploy one agent, and you use it to make returns, and also you interact with our chain. We think with this kind of a device, it's a good way to reach out to real users and educate them.
Got it. Okay, I want to move to some spicier stuff. So, tell me about the failure modes. What happens? How does Vishwa fail?
So the failure mode for us is one is we're too early, right? So we build the whole infrastructure and people are very hesitant on using the entire infrastructure.
Basically our entire audience.
Which is the entire audience, right? And that's why we initially target the institution, because we basically see a very interesting pattern among them that they first need to use AI properly. That's what I have been repetitively speaking about that. So onboarding them to our entire agentic workflow will create a very strong retention for them, so that all of their transaction, all of the distribution channel are self-iterative with us, and that create the flywheel. So instead of going through, B2C scenario, because to be very honest, I agree with Tony, the education is important, but I disagree to some extent. The user persona of retail are dumbbell shaped. So one group of people, they're super conservative. No matter how you teach them, they're not going to use it until there is a one-click solution that most of the people has already trusted, right? That's how PayPal get into the majority of the market. That's how Venmo get into the majority of the market.
All right, I'm gonna let Tony jump in. Okay.
In your view, what does this kind of one-click solution look like?
That's a great question. That's a very great product question, right? So for us, or me as a person, very interesting app that we have seen is you can just talk to the Telegram bot and it construct the transaction for you. And I mean, sure, on the back end, it go through TEE, it go through the verification network, right? When you click it, they just, the transaction just go through. So it's kind of like a companion of what they have been watching during the World Cup, right? They do the bets on poly market, right? This is the interesting use case that I have seen, because that serves the other side of the dumbbell shape, right? Where people are very, risk friendly.
People are just gonna YOLO.
Yes.
So like 3 people over here are like, yeah, I'm down.
I'm betting
50K,
right?
Let's do it. All right. Okay, we are fast running out of time, so we're gonna move to the lightning round. Everybody's favorite. All right. Agentic economy, underhyped, overhyped?
I'll say it's underhyped.
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 All right. Okay. You wouldn't be doing what you're doing. Okay. What about would you personally let an AI agent today manage your entire savings account, or call it, your entire Bitcoin portfolio, or crypto portfolio?
I'll say 5%.
5% of it. All right. You
5%.
let an agent kind of have some play money.
Yes.
Okay. All right. What about
I'm
you, Tony?
more conservative. Probably.
No.
On site, it depends on
You don't get hired your own supply. Okay,
I'm gonna
good.
deploy
All
on
right,
agent.
You're just all right.
Even with side?
On site, maybe 100%. Here we go.
All right. Okay. What wins in the agent economy in 5 years? A new chain, or a trust layer on old chains? Vishwa.
I will say completely new ecosystem.
New ecosystem, okay.
Completely new ecosystem based on wherever the existing liquidities are.
Graceful way to not answer the question. Okay, go ahead, Tony.
I think we need both.
Both? All right, you guys are being too nice to each other. Okay. All right. The agentic economy breaks when? Finish the sentence.
That's a great one. It breaks when a huge hack happen.
A hack to what, though?
Let's say hack of a treasury, or a hack,
But is it like is it the agentic action that is hacked? Is it the underlying protocol that's custodying the assets that's hacked? What
So agentic action that has been hacking out of the sandbox,
So
just like what
like
OpenAI did, right?
Yeah. Okay. All right.
I'm more worried about potential systematic risk of a large language model itself.
Oh, so you're directly after Anthropic, just
no.
No. All right.
Well, they're burning books, so there may be.
All right. 1 sentence predictions, then we got to go. Tony, what's happening in the next 3 years? Agentic commerce. What are we gonna see?
I think we will have some, as I mentioned, killer adoptions.
We're gonna find a killer app.
Yeah, killer apps.
All right. Be on the lookout, Nate.
Major hacks, local deployment, and massive adoption.
Damn, major hacks, man. You had to end on a bad note. All right, guys, you were great. Thanks so much. Thank you, everyone. We'll see you later.
All right, see you guys.
See you guys.
All right, thank you. So next we'll have another panel. We'll have Ben Fielding, co-founder and CEO of Jensen, Salman Westimer, co-founder of Chain Opera AI, and Dean's professor at University of Southern California. And then we'll also have Ala Shawana, co-founder of BitTensor and CEO of Crucible Labs. And the moderator is Harrison Dam, CTO and partner at Hack VC. Let's welcome to the stage.
Hey, man. Good to see you. Good to see you. GM. Yeah, illustrious panel.
maybe we go down, starting from Ben, just like quick TLDR on who you are, what you do, and then we'll get into some fun stuff on decentralized inference and training.
Sounds good. Hey folks, I'm Ben, co-founder and CEO of Jensen. Very briefly, Jensen works on decentralized and particularly verifiable AI. Anyone who's heard us speak before, we talk a lot about how you verify AI execution when it's been done on a completely untrusted device. We've talked about this for various reasons going back quite a few years. A lot about compute, but also about kind of trusting the logic that's being performed by the AI models. But fundamentally, we make things verifiable and trustworthy in the AI space. And then before Jensen, I did a PhD in deep learning focused on neural architecture search, so searching for the optimal structure of deep neural networks way back 2015 to 2019.
Hi everyone, I'm Salman. I'm a professor at USC in the CS department. I'm also running two companies. One is Web3 AI, Chain Opera. This is about decentralized intelligence when you add, let's say, scaling intelligence by decentralized agents working together or decentralized models. So it's at the agentic model layer for collaboration between them. We also have a Web2 AI company that's teamily, like family, but for teams. It's about human AI collaboration. Maybe recently, let's say Jack Dorsey, they announced Buzz. For us is Teamily, which is bringing human and AI in a place to collaborate together. Pleasure to be here.
Okay, hi everyone. My name is Ala Shabana. I am co-founder of BitTensor and co-founder of Crucible Labs. BitTensor is think of it as a decentralized incentive mechanism in which it's effectively a layer on the internet where people can coordinate and optimize objective functions. To be more specific, it's actually subdivided into subnetworks. Each one is effectively its own project, and each subnetwork is sort of trying to tackle a different problem. Everything from machine learning pre-training all the way out to inference, all the way out to even more utilitarian approaches, things like storage, optimization, defect detection, and so on. And effectively tried to create Crucible Labs after that to try and invest and kind of create a Y Combinator style approach to these projects that are building on BitTensor. There's 120 different projects right now, and we're effectively trying to bring out the best and bring the best teams into the ecosystem. And lastly, we're also building on a security solution for storing your BitTensor tokens and kind of getting exposure into the subnets correctly. It's called the Crucible Labs wallet. And yeah, thanks for having me.
Heck yeah, very cool. So like three very different approaches to AI plus decentralization. Maybe we could go through, I don't know, I like the order you want to be in, on like what were the very explicit trade-offs you made in the early days, specifically around like cost, quality, security, latency, that sort of thing. And like what has proven to be easier than you expected? Then you guessed, I don't know, maybe 6 months ago. What's been harder than you expected?
Sure, happy to jump in.
Yeah.
I guess, so for us, we made a really, really specific choice back at the beginning of Jensen. Like way back at the beginning, we thought a lot about the compute problem. This is like end of 2019, 2020, where compute was probably like the biggest kind of barrier to continued AI progress. And people needed access to compute, and it was hard to get it. If you remember back then, like there were a lot fewer chips. They were a lot more constrained for various supply chain reasons. And we looked at that and said, okay, decentralization can provide access by basic supply and demand principles. Like you could be using various chips in people's homes if you could trust them, essentially. We looked at a lot of different ways of actually doing that. And the conclusion we came down to was that the trust problem would kill anything that you tried to build here. And so we very particularly chose to solve that trust problem and solve it at the low level. So when I send a model to you, like the matrix multiplications involved in performing that model execution, can I verify exactly what those matrix multiplications have been, rather than trying to solve it at like a higher level or a higher layer or something like that. We've stuck with that decision, but what we found is actually the applications of that have like moved underneath us, and like the kind of landscape has changed, but like choosing that specific technical approach is something we're very kind of pleased that we did. So I would say that's something that we had like really high conviction on and something we stuck with, but along the way, tons has changed. Like compute isn't a problem anymore. Like in some ways it is, but like actually I don't think it is. Like data is a problem, high signal data is a problem. Like we've moved through lots of different problems for AI, but ultimately underneath everything, I still view like there being a fundamental trust problem that has to be solved. And if you take the hard way, you don't really regret taking that route in the end because you have a fundamental solution. And there's lots of kind of escape routes we could have taken that we didn't. But yeah, that would be my answer.
Cool. I can go next. That's all right.
Sure.
Yeah. So interestingly, we first started BitTensor as a massive, coordinated, decentralized training platform. That was kind of the base idea. We wanted to see if we can train something super simple like the MNIST dataset back in 2018 to see if it's even possible. Can we train it across different platforms and different computers and basically all over the web, all over the internet. Interestingly, the first question we got from VCs was, who cares? Why is this interesting, right? It's a cool academic project, but really, who cares? And we kind of realized that similar to things like SETI at home, folding at home, and so on, I'm not sure if you guys heard about those projects back in the day, they were about protein folding and kind of having people doing the same way, collaborate and bring their compute into the ecosystem and help solve problems. The problem with those, though, is that they had no incentive. There was no incentive to join besides you thinking the project was interesting. So the only way to properly incentivize that correctly and in the most efficient way possible was through markets. And effectively, technologically speaking, it was through blockchain. So we built it in a way that really, the token itself follows the Bitcoin mechanism, meaning there's no pre-mine, there's no ICO. We kind of started from zero. And everybody kind of mined together and built it that way. Interestingly, along the way, we found that of course, not every problem should be decentralized, right? There's some problems that, let's say, for example, AI for a car, you don't need that to be centralized. That should be in one chip. Things like time-critical systems, right? Things like, let's say, AI for a fighter jet, same thing, can be decentralized. But there are some problems that should be decentralized for very different reasons. Whether those reasons are social, economical, or technological, it really depends on what you're building. A really easy, basic example is defect detection, right? This is one of those problems that should be decentralized because it's difficult to trust a single actor to act in a trustworthy manner without being properly, what's the word I'm looking for? Without being properly vetted and authenticated and audited to make sure that they're actually acting in a way that is not taking a single side or that is very neutral in that sense. So that was actually the biggest challenge, is that learning that not every problem should be decentralized, but at the same time, learning that we can actually expand our incentive mechanism to not just AI, but to really effectively create a coordination layer for anything that is a computational commodity, everything from compute all the way out to storage and memory and AI training and inference. That's what made it very interesting, and that's kind of what opened up the door for us in that way.
Yeah, actually, this panel is interesting because I think we started at similar time. I don't know, it was like about 4 years ago. So that I like, and all of us had a long journey to understand what is decentralization in AI. For us, we started actually from compute layer. Maybe many of you know FedML for federated machine learning. The promise of, let's say, decentralization at the compute layer is typically cheaper, scalable, like similar to internet, right? Why internet is decentralized, makes it scalable. The challenge with that, we realized, is nowadays actually, VC money subsidizes a lot of the AI and compute that you would get. So as an end user, maybe you don't feel it, that decentralized AI is really making it cheaper. So we have that, and that lets us scale. Then we move to the second layer, which is after compute, you have the model. The promise of decentralization in the model layer is more of building and ownership of the model, right? So for example, you have closed source, you have open source, but there is going to be community-driven models, right, that people will contribute maybe their data, but in a private manner, you would be participating in the training. For that, as you mentioned, actually, the challenge of it is that how would you coordinate across a lot of people to build a model? We were able to build a small language model, which is open source, decentralized train, right? And a small language model is very good actually for on-device. So that's where we saw actually there is a lot of opportunity to make the models decentralized for where the privacy matters the most, which is your phone. So you want the model run there. But then again, maybe you feel privacy, but you don't feel quality, right? So then we moved up, because to me, it should be all about something tangible benefit that you see from decentralization. Like, you try maybe ChatGPT, you say this is a great product. OpenAI, has this ChatGPT, you want to have that feeling. Then we realized actually there is an opportunity to get intelligence quality through decentralization across many models and agents collaborating. Right, so you see one path to intelligence, that's what OpenAI, maybe Claude would say, is that we are going to build better and better models to get to one form of AGI. I think there is another route, which is there is going to be a collection of many models, many agents that can do amazing things. And now we are actually getting a glimpse of it. For example, you try to really, the quality of the web pages or maybe slides you create is going to be higher than what you can create with Claude. Right? So that to me is amazing because we are starting getting to see intelligence scaling, not from model size. And I think we are just at the beginning of agentic scaling. Right? People build agents, but these agents don't collaborate. Maybe 3 of them will collaborate. And I think that's a very good opportunity for decentralization to finally get to intelligence quality that everybody can feel. That would be awesome.
I wanted to double click actually on like both of those, the topics that you both brought up around like what problems are better suited for decentralization and like what role sort of decentralized models have to play in a world where, you know, like the CapEx budget to train one of these like God models is, you know, absolutely insane. Maybe it's worth like just unpacking that a little bit more, especially given, you know, where we are, you know, potentially an executive order coming down, Chinese open source models might be off limits. Yeah, like where does that take us?
Go ahead, or should I? Okay, so it's a fun question. The thing about, you know, decentralization itself and where it's useful or not, that's kind of one question we always ask before we sort of incubate any given subnet. It's that, does this problem need to be decentralized? What is the benefit of decentralizing this specific issue you're trying to solve, right? Typically what we found is people who are trying to solve a problem for the sake of, let's say, for example, in a way crowdsourcing the technology or crowdsourcing a solution or optimizing for a function that they might not have the solution to yet, those typically tend to benefit the most from decentralization. The ones who kind of tend to go for, let's say, a private approach, things like, okay, well, we need compute, so we're going to create the subnet so people can give us some subsidized cheap compute. Those typically don't end up doing so well because that sort of problem, decentralizing that comes with a cost as well. And that cost usually is either in man hours maintaining this or specifically in the design of that decentralized portion that you're creating. Because decentralization also means in some ways trustless, right? You need to find a way to actually create a permissionless trustless system where the incentive mechanism will punish people trying to cheat and the people who are sort of, let's say, doing it honestly and well are rewarded accordingly. That is a very difficult game theoretic problem for a lot of different approaches. If you're approaching it, for example, for even a very simple problem like compute, proving the compute exists and that compute is, you know, is owned by this specific miner or this specific individual is not an easy problem. And spending time doing it is actually more costly than just using, for example, a centralized approach like AWS or something like that for a problem, if this is your primary approach. But if you're solving for, let's say, we can use the deepfake example again. Yes, the actual algorithm to actually create a permissionless and trustworthy system where you can actually get the information you need, like, for example, a defect detector, as a given example. This would actually be a much better use of your time than creating a model that is super massive and super expensive to create to actually solve this problem. So I think in some way it actually gives us a big chance to actually compete with the big guys in some ways when we actually grow to that size. And you're actually able to, you know, in a way, what's what I'm looking for? In a way, create a better ecosystem where everyone's contributing at the same time and everyone's kind of rewarded fairly, but at the same time you're actually getting your goal that you need, which is to kind of create the next, let's say, for example, frontier model.
I think there's a really good point there from Alara, and the whole space has had to mature on in the past few years of like, originally those promises were, hey, we can just compete directly with like centralized AI. Like we'll make a bigger model and things like that. And there's various reasons why in the very, very long term you can claim that more powerful like kind of God models can be made through decentralized means, but you have to overcome a significant number of hurdles to get there. And I think what the entire decentralized AI space has realized is that the extra costs and the extra friction of doing something in a decentralized way mean that the only viable way to do it is to be selling something that is only achievable via decentralized AI. And like Allah said, I think for like deepfakes, that's explicitly, or deepfake detection, that's explicitly you need trust. You need to pay for totally decentralized trust because you could not trust the single company that would do that process. And that's a realization that kind of we at Jensen went through when we started with that kind of idea of, hey, we can train a model on every device in the world, and then realized actually it doesn't make sense to do that to compete with like OpenAI, but it does make sense to do that to create a model that actually is completely transparent and could be trusted by everyone because it's been trained with the same principles as blockchains. But I think when you go through that process, actually, you really have to significantly narrow down what it is that you're doing. And I think it's probably obvious to a lot of people who've watched the decentralized AI space develop, that has happened and has to happen. Every company has to figure out a really specific niche that they go after. And obviously, BitTensor exists as a kind of meta layer above that, where obviously they are looking for those companies individually as well. But it's been a really clear narrowing that's happened for the space. And as a kind of founder going through it, it's an interesting thing to see happen. Like you have all of these really long-term like beliefs about what's going to happen in the space, but to be realistic, you have to find that use case that somebody's explicitly buying the trust here. That it's not like a byproduct. There's no space for that in the kind of decentralized AI space anymore.
Maybe I just add, I think there was a lot of things that was mentioned, but I would say maybe also the monetization layer. Like if you believe that intelligence is decentralized by nature, meaning that many people, all of us have ideas maybe in one part, and then you want to encourage people to build something bigger together. And that's where decentralized AI is going to be a very good mechanism for encouraging people to contribute to that. Maybe I give a specific examples. These are now, maybe last year, these was just maybe dream to have next year, but right now we have them. For example, think about this, you create, maybe you have some ideas about lyrics writing, right? You can start working with an agent that writes in your own style. Somebody else may have an idea maybe about being a musician, writing another one that can compose the music, and somebody else maybe has a good taste of singing, creating an agent, for singing. They can come together and create a song that is having a beautiful lyrics, having beautiful vocal, beautiful music. And we have seen examples of this. Actually, they published it on Spotify. These are great songs, but encourage people why they should come together. If you just work and prompt and run AI to generate it, even you don't appreciate it because maybe you don't know about some part of music generation. So I feel this is a new form of intelligence, maybe very different from a black box, like a God model that answers all questions, that is created by the people, and you need incentive mechanism. Why should you join this network, and why should you make it better? So I think that's great. Like, crypto is great for that.
Totally, yeah. Awesome answers. In many ways, each of you mentioned and double-clicked on like one of the residuals from crypto almost, in that like this industry has like flourished, right? And then tokens are doing what they're doing, and DeFi and all that. Are there like other primitives that come from crypto land that you think are underexploited and could be like different approaches for like decentralized training? And there's a question in there also around like sparse agents, mixture of agent frameworks, which I think you touched on, but also like sparse models, which I think like Ben, you're also working on, right? And Allah too. But yeah, what other primitives are ripe for like exploitation for new approaches?
Yeah, it's a good question. I think it depends how you break it out, but I think one of the biggest ones for us is that the like transparency principle of blockchains, of like, you don't necessarily need to tokenize something. You don't necessarily need to like have it operate across a blockchain, but you can have a load of people around the world doing something in a transparent way that's like comparable between them. And actually maybe that's enough. And you could build a business with that property where kind of it looks like open source, and then like you develop a kind of open source model, but maybe you didn't need to wrap it in a token. Maybe you didn't need the kind of bootstrapping mechanism of a token, but all the kind of other nonsense that comes with it necessarily. Like you could have just had the transparency, and like maybe there's an slight extra cost to that, and that's all you bought. I think that's one that we think about a lot. I think there's also like governance and like voting systems and things that don't necessarily need tokens underneath them, where actually what we're saying is large groups of people want to be able to kind of direct something or have a say in how something executes. Tokens provide a nice like Sybil kind of resistance mechanism and things like that, but like, again, they actually come with a shitload of baggage that you don't necessarily want. So like, is there a way that we can just get what we want out of it, like the Sybil resistance and like the governance system, and actually throw away the rest of it? And I think there's probably, as the market like goes through its cycles, like founders get pushed to have those like difficult, to ask those difficult questions and answer them themselves of like, do I just inherit everything and build a new layer one, or actually do I like just take the bits that I want because that's all I want to make people pay for, and like discard the rest because I don't need it? So yeah, transparency and governance systems I think are quite interesting, but there's others for sure.
I would say maybe philosophically, I think those are the mechanics and maybe underlying math of it. But philosophically, there is also this belief that, in crypto, that, you want to have the ownership. I think the same scenario is happening with the AI. I'm actually worried. I mean, these tech companies, if they control such a, very strong model, right? We have a lot of students, parents, they ask, what should my child study? What is going to be their future? I think these are the things that as a society, everybody is worried about. It's not joke anymore. It's like every, parent, if you have a child, you think about what should they study? What is going to be their future? And I think, again, I believe that there is going to be a different form of intelligence. It's not just going to be one big model, right? There is going to be maybe different type of intelligence that we would need, something that is more human, something that connects with the problems we want to solve, right? So those aspects would matter than just optimizing, one utility. I think those things matter, especially if we are at the time, I think you mentioned, like debates on open source model versus closed source model. These are very important societal debates that we should have. And kind of, I would also view crypto, I mean, we do a lot of work as research as open source, right? Also, crypto is a champion of open source, having transparent, not only seeing what the product is doing, but seeing what everybody else is doing. So we collaborate together. I think those things matter a lot these days.
Yeah, I think you got my idea. I was going to say open source. The one thing I was going to say is one of the main primitives that started with crypto was open source software, right? Like people were trusting systems more because they were open source. If a crypto project was closed source, people were like, what is this? This is weird, yada. And all of it started with the Bitcoin white paper, and that's where kind of things cascaded from there. But this is where it gets interesting. It's because really, I think both your projects and BitTensor as well, and every other project right now that's a utility token, they're all trying to incentivize the creation of open source, which makes it very interesting because now you no longer have to kind of take the approach of, say, altruism, for lack of a better word, for open source. A lot of people, it kind of started with, back in the late 80s, early 90s, when the open source movement started, and it was the belief that software should be free. And this was, kind of growing up, not wanting to pay for licenses, I felt the same way. But as we kind of built these projects, everybody kind of realized that, actually incentivizing the creation of open source, there's nothing wrong with that. And you actually end up with better software that is more auditable, that you can actually look through and you'll know what your models are doing. And I think open source AI is blowing up in a crazy way, especially lately. I think everyone's kind of read that, the Google paper, the Google leak that came out a few years ago, where it was basically saying that we have no more moat because open source is catching up. And that's actually what's happening. I think genuinely in the future, due to crypto projects and due to just regular open source AI, what's going to happen is people are going to realize that they might not actually need all that power, right? I need something that works, that's good enough for me, right? I think yesterday Anthropic had a big outage. Most of my team's productivity went down because of that. But interestingly, anybody who had their own, anybody who had their own open source model they were deploying and working with, they ended up doing fine. So I think it's kind of the return of open source and the return of owning your software is kind of being driven that way.
Heck yeah. All right, we got 1 minute left, so 20 seconds each. A lot of tailwinds right now for like pushing smaller, pushing more specialized, more open, et cetera. If there was one thing that moved over the next 6 months, call it, that made the space hyper bearish, what would it be?
Hyper bearish?
Yeah. Like as in like the tailwinds became headwinds.
Oh.
Yeah.
I'd have to say probably the movement of sort of the bigger players into the ecosystem. That would be a big one.
Yeah, good one. Simon?
Yeah, for me, I think, as I mentioned, is group intelligence. I think we are now all intelligence, one model, one agent. Group intelligence is going to be the next maybe exciting thing.
I think it's something that would make us hyper bearish. It would either be like insanely strong regulatory action that just like shuts down the ability to like use open source models or something, or I think like the AI market completely imploding, which it very well might do, which would take us, it would hit us as well. I think there'd be benefits to that, but at the end of the day, like there's going to be a blast radius, and I think it's quite clear that a lot of the centralized AI companies are like leaning over the front of their skis, which might be right. They might be correct in doing that, but at a certain point, that stops working. And I think when we hit that point, it's going to like ripple through everything, literally everything, given the amount of capital that's going through like the entire financial system. So like we're all going to get hit.
Epic. All right. Thanks, guys.
Thank you. Appreciate it.
Thanks.
Thank you. I do have bullish take. Thanks,
Awesome. So next we'll have Daniel Marin, who is the founder and CEO of Nexus. The topic of the talk, the title of the talk is Self-Improving AI Software Factories. So welcome, Daniel.
Thank you. Hello, hello.
Thank you.
All right. There you go. Hello, everyone. This will be actually a fast talk. It'll be just 10 minutes. I used to be a student here, so thank you to the Stanford Blockchain Club and BAST. This is probably like the 5th time I talk in one of these conferences. So this time I wanted to talk about something quite different from the rest of the topics discussed here in like crypto land, and that's of AI software factories. So just some context about us. At Nexus, we have a blockchain, the Nexus blockchain. The Nexus blockchain actually was launched in mainnet 2 months ago. It's traded worldwide across many of the major centralized exchanges. I want to talk about some of the software innovations that we're doing to our stack. IT, Kun. It seems like it's not, Nope. All right. It seems it has some, there you go. So, I want to talk a lot about what we do at Nexus. The important thing at Nexus is that we have a blockchain. It's EVM compatible. We actually have an upcoming exchange and stablecoin. We have many partners in the industry as well. But what you're seeing here right now is actually a 3D visualization of our code base. So you can see that we have like our brand, marketing, strategy, engineering, many other topics. It all lives in a single monorepo. And what you're seeing is essentially what we call the company brain, which is just a 3D visualization of all of our code files. Interestingly, I'll go back for a moment. Something that we are interested in doing here at Nexus is just automating at 100% the software development lifecycle. So what that means is we work very thoroughly in understanding all this context and being able to improve the machine one step forward. But how do we do that? How can we fully automate what we're doing? So at Nexus, we think a little bit in a mathematical way. Pretty much what we want to optimize is that at every moment that we improve the code, that we essentially improve this formula right here, which is that the probability that the code written is correct, given that it was accepted into the code base, is greater than or equal to, smaller than or equal to some factor. I will explain what this means in a moment. I want to give a small example of what we're doing, which is a lot of the code that we have is written in Rust, and we want to derive a mathematical model of the blockchain and the exchange. And we want to do so automatically. Indeed, we have a very large Rust code base, and we want to build what you see at the left over there, which is what we call a monograph, which is a full mathematical specification of everything in the blockchain and in the exchange and everything else. I will explain how this works. Once again, we are trying to tackle the problem of building self-improvement software factories, right? So the question is, how can you hand all of this code to a swarm of agents, have the swarm of agents analyze it, interpret it, and improve it one step forward? What you see at the left, as many of our crates in Rust that we have implemented. And then the question is, how do we implement this, right? And so the way that people do this right now, and we have actually been automating this, is what we call a generator judge agent swarm. So what we do is we grab pretty much, we spawn a swarm of agents that generate a mathematical representation of all of our Rust crates, one by one, right? So you may imagine the funding rate crate, margin crate, liquidation crate, Oracle crate, order book. All of these crates that comprise the blockchain and the exchange go through a process where mathematical context is generated. After that, we dynamically spawn another swarm of agents that analyze this work and refute the mathematical system that is created. Then we aggregate all of these mathematical compositions and we compose them further into a unified mathematical model. And after this is completed, we spawn a new swarm of verifier workers that verify the mathematical correctness of the model. And at the end, we produce an output. This output is a global mathematical understanding of the system, of the blockchain. I'll skip this. This is pretty much the output of what it looks like. So what we see is essentially like a book of all the generated math that determines how the exchange works and finds multiple series of errors, conclusions, things that the engineering team needs to work on, so on and so forth. Indeed, this system is a fully automated system that it also improves. So what you're seeing here is a series of versions of the system from version 1 to version 10 that pretty much enhance the coverage, the quality of this mathematically generated system. The whole point being, I'll remind you, which is to take this piece of code, which is pretty much the exchange or the blockchain code, and fully understand it, generate a complete mathematical model, and then from there continue improving it, right? So I'm only showing a part of the process, right? What you're seeing here in this pipeline is a process that seeks to understand and generate a full mathematical model of the system. Interestingly, what we found, this is a little bit complex, but what we found is that the way to achieve self-improvement is by combining something that we call the deterministic mass and the non-deterministic mass. The deterministic mass is a set of tests that test the quality of the code base, and the non-deterministic mass is a set of qualitative assessments on the generated code base. All of this gets produced through this pipeline of software generation and produces a final output. Now, this is a little bit strange, right? Like we're in 2026. This was probably not possible, in 2025. Obviously, the world has changed significantly. It was a dream of many blockchain projects to build a full mathematical model of their software. There were some projects in the past that tried this, and it would have taken you a bunch of mathematicians to generate this overall. What this reduces is, instead of needing like 5 to 10 mathematicians to produce this model, and by the way, we really do need this model if we're a perpetuals exchange trading system, because it's a highly mathematical system, we only need one mathematician, right? And that mathematician is the human that comes at the end of the pipeline, reviews the mathematical model, and then further tunes this mathematical machine. So, sorry. So, I'm not here to, say that we have, a sort of breakthrough or something, but interestingly, Paradigm, for example, the venture capital firm, was also recently working publicly on a separate but related project, which is automated formal verification of a compiler from Solidity to its bytecode. And we found that fully automated formal mathematical modeling of a complete exchange is now something within the reach of what's possible. So I just have 40 seconds. Where am I going with this, right? Or where is the industry going? I think it's non-controversial, especially here in Silicon Valley, to be able to talk about the concept of self-improving software. And I think that something that we will see soon is what you may consider self-improving blockchains, right? And so, in layer 1 landscape, a lot of things have evolved, since the time of Ethereum. At Nexus, we have a layer 1 blockchain, etc. It is kind of crazy to be able to think that we may be able to have systems that are able to fully reason about themselves and self-improve. I think that the companies that implement this in the most aggressive way will be significantly in front of the other ones. Obviously, there's a lot of risks too related to cybersecurity risks, but that's for another topic. So, with the crypto markets being down and people, not putting a lot of attention to blockchains, I would say, this is an exciting area of development. So that's it. Just want to get everyone excited about the future of blockchain. That's pretty much it. Thank you.
Yeah. Cool. Awesome. Oh, there he is. He's right there.
Oh, sweet. All right. Thank you, Daniel. And next we'll have Alexander Lom, who's the founder and CEO of Pluralis. And we'll have Jake Brookman, founder, CEO, and managing partner at Coin Fund. And the topic is decentralized training performs.
Thank you.
There. Yeah,
Right.
sorry.
It's okay. Hello, everybody. How's everyone doing? My name is Jake Brookman. I'm founder and CEO of Coin Fund. Been looking at the decentralized AI space for a number of years now. I'm very excited about what's being built here. And today I have with me Alexander Long, founder and CEO of Pluralis, which I think is one of the foremost companies operating in the space of decentralized AI training. Welcome, Alex.
Thank you very much.
So, all right, we're going to keep this fairly not too high level. We'll still get into some engineering speak here, but maybe let's start with decentralized AI training. Tell us what that is.
Yeah, so it's basically you're training normally in a data center. You have all the GPUs co-located. Decentralized training is, one, can you split up all the GPUs, have them in many places, and two, have many people in the run rather than one person do it themselves. That's basically the high level.
Right. So the predominant narrative of AI, right, is that you need these giant data centers with very high-end compute, with very, very high bandwidth links between the GPUs, and a lot of energy to create large frontier models. It's getting to the point that some companies are buying nuclear power plants to power these things. And decentralized training is the idea that, well, actually, we might be able to do the same kind of training that people do in these data centers, but in a swarm of much more consumer hardware.
Yeah,
right?
it's very powerful. The idea is, can you open the layer up? Is basically it. It's like today it's, one entity, huge amount of money, huge amount of capital, like you said. There is no accessibility to any kind of normal person at the model layer. To me, what's most interesting about this is, can you open that layer up? Have many people collaborate, train the models together, own them together, have like something that, it's very cliche at this point, but it's like, can you have something that looks like open source at the model layer, which is just completely lacking today.
Okay, so there's two things to talk about there. One is like, can we actually do that? And one is, why do we want to do that? So let's talk about, can we actually do that? Because, 2.5 years ago, there's a pretty strong consensus that this was impossible. So what makes this impossible thing possible today?
Yeah, so the typical order of events is, right, like someone gets interested in this, they're like, okay, this would be great if we had this ecosystem, let's look into it. And then you look into it and you go, oh, I need really high bandwidth links between the GPUs. This is how you do normal decentralized training. All methods rely on this. If I want to do this multi-party distributed setup, I don't have these high bandwidth links. I can't use most of the existing stack. Forget about it, So that's like the first problem you run into.
And how do you guys solve that problem?
Well, you have to do research. So the core thing is what Pluralis does is not alterations to existing models, but like we actually think of them as new architectures that are designed to be trained in the setting. So the research is called Subspace Networks. We published it in NeurIPS last year, and we have a bunch of follow-up work about it. And it's very similar to a transformer. It's 90% the same, but you have very small alterations at the output of the blocks, and you have a sort of decomposition that occurs. And the result of it is you get massive compression on the output of the blocks. And if you have massive compression on the output of the blocks, you can transmit it over much lower bandwidth links. If you can transmit it over much lower bandwidth links, different people can operate different parts of the blocks over WAN, and you sort of get this.
So give us an idea of like the kind of team that it takes to make an advance like this.
It's like, it's open, it's research work. So this is something where like the beginning of Pluralis was me. I was a researcher before this, and it was me and a bunch of my colleagues that were just doing ML research, and we just worked on this problem for about 6 to 9 months until we had sort of some initial progress. And yeah, it's like open research, that's basically what it is.
Right, and what kind of credentials do you need to, publish papers in NeurIPS?
Well, it's getting harder. It's like getting more chaotic, but you need like, PhD researchers, done a bit of time in industry, done their postdocs, these kinds of things, and understand large-scale training dynamics, which is often, sometimes you get people who are very good at research, they're not really quite familiar with how the models work.
The way I tend to think about it is, and I see this as an investor in a number of different areas, but there's basically kind of a hardware process where hardware is improving, becoming more powerful, compute is getting more powerful, memory is getting bigger. And at the same time, there's another group of people who is optimizing the algorithms that go on top of that hardware as well, right? So I think the insight here is, if you change the algorithm by which you train, you can actually make the training happen on different kinds of hardware. And actually, in your case, it's heterogeneous hardware.
Yeah, this is right. There is model and algorithmic co-design happening with the hardware, and this has been happening for a long time, actually. So, literally since AlexNet, it's like, okay, the models are really good on GPUs. Let's look what else the GPUs are good at. We design models that train fast in this way. NVIDIA puts out various types of links, like let's take advantage of the links, let's design the models that are best trained this way. So this has been happening since the start of deep learning, like algorithmic substrate co-design. And when you're talking about decentralized training, you're literally talking like a branch off that tech tree. We're like, okay, we're looking into like a new substrate. It requires new types of model, not just at the model layer, but in the distributed systems layer and distributed training layer. And you can redesign it to be suited to that new substrate. That's what this is requiring.
Okay, so we have some, some confidence that this kind of decentralized training can now work. Maybe mention like what has been the progress in the decentralized training space? Like how big models have we trained over the years?
Yeah, well, there was kind of like this big wave last year in this where there was there was a bunch of data parallel runs that happened. So there's different types of training. It's actually very important to understand. You know, you have data parallel runs where you literally take the model, you clone it. Every single participant has a copy of the model. You compress gradients. Right? This is very similar to the federated learning setting. And this is an old technique that's been known for a long time. The initial runs that happened were all in this setting, where it was, okay, you know, we're going to train a big model, but you need 8x B200s to train this thing, because that's what's required to hold it. So there was Intellect 1, I think, was 13B. They trained a 13B model. Noose did a 13 or something, and then started training a 40. And recently there was a 72B model trained in this way. But it's very different to what Pluralist does, which is you're actually splitting the model up over participants. And this falls under the domain of what you would call model parallel training.
So just to summarize, like the data parallel, like basically the way I understand it is, when you're breaking up the data, you still kind of need, you know, big GPUs, right? Because you need these models to fit into the memories of GPUs. So I think that still is progress in decentralized training, but it gets you up to like 100B, maybe 200B. And then what you guys are doing is you're saying we're not just going to break up the data, we're also going to break up the model itself. And when you break up the model, then it starts to fit on smaller
You
GPUs.
become unbounded by, like, you can train very large models with arbitrarily, you know, small nodes. Many people can participate.
Right.
You don't have this problem of like, okay, I go over 72B, I can't fit in on a single node anymore. What do I do? And you know, every participant's hardware requirements goes up and up with model size.
Right.
You delineate those things.
So you go from training that's happening on high-end hardware to training that can happen on any kind of hardware, including maybe even the latest MacBooks.
I mean, we'll see about the MacBooks. I definitely not anything. Like, you can use 5090s, RTX 6000 Pros, RTX 4.
So consumer NVIDIA GPUs.
High-end consumer NVIDIA, right? Because one would think, like, even these older GPUs, they don't have the hard, like, you can use them, but they're just not enough. You know,
Okay.
basically the situation.
So what's the largest model that has been trained in this model parallel way?
In like decentralized model parallel was the one we just did, which was an 8B, Pluralis 8B.
8B.
Yeah.
And how big do you think that will get over the next, let's say, year?
I think we'll see models in like the hundreds pretty soon.
Okay.
Yeah.
All right. So maybe we've established and managed to convince you guys that we have enough kind of research progress to try this. The next question would be, okay, like why would we want to do this? Why would we want to go from training models in data centers to training models in swarms of, you know, consumer gaming devices?
Yeah. My position here is that I think all this open weight stuff is great. Like, everyone wants open weights, right? There's very few people aside from the people in the labs that don't want this. My position is this doesn't go far enough. And I think this has sort of become a bit clear to people with the latest Kimi release, where everyone was cheering on Kimi. It was very positive. Everyone liked this thing. And then the license comes out and it's, you want to vend this and you got to pay us 30%, right? And suddenly everyone went really quiet and was like, oh, maybe open doesn't mean free. And you have the same problem of, like, you're developing this platform dependency on the model, even when it's open weight. And so to me, the motivation for decentralized training or protocol learning is, can you get a truly neutral substrate here, where it's actually like just this bedrock that you can build on, and there's community development happening. No one can turn this thing off. No one can yank it out from under you. It's just stable, you know, and you know, very analogous to, like, do you want the Linux of the models versus Windows? Do you want the Postgres versus the Oracle DBs? Like, this happened at every layer of technology ever, and it hasn't happened yet at the model layer. And to me, decentralized training is the answer to that question.
Yeah. So one of the points that you were getting at there is that the sustainability, right? So everyone is saying the answer to the centralization of AI, you know, the fact that OpenAI and Anthropic are kind of eating the world with their products, right? Is open weight models. But what nobody talks about is who is going to pay for these models, right? Because if you want like a serious competitive model, this is a training process that could cost you $100 million to over $1 billion, right? And you know, what I think people sweep under the rug when they have the open weight discussion is that in order to get that capital, it's the same companies that out of the goodness of their hearts are opening up, you know, the weights. But when that ceases to be expedient for them, they might not do that anymore.
Yeah, I mean, I have so many opinions on this, right? It's like, why is China pushing open weights like progressively? Like, we can see this is like hugely geopolitically motivated at this point, right? I know it's not exactly what you asked, but I kind of want to go on a spiel. Sorry. Like, if you look at what's happening, it's like Quen was closing the model weights. They literally, you know, a bunch of people in that team resigned because the rumor is, hey, the Gwen executives sat around and were like, why are we creating billions of dollars for other people? Why are we doing this? Gwen's just now gone completely open again, right? At the same time as she's done a speech being like, China is fully embracing open source, right? So a lot of this, we're now in like act 2 of this whole thing, where this is like clearly like a major geopolitical issue, and the geopolitical powers are beginning to influence the development of this tech. And I think anyone that looks at this and looks at those sequence of events and goes, it is secure and reasonable to continue to build on Chinese open weight, it's just very naive, right, about what's going on. This is not a situation where this is being done out of benevolence. It's just not realistic to believe that's the case. So yeah, that's my issue with the open weights.
So maybe talk a little bit more about, you know, so how does decentralized training, so we have this neutral substrate, but how do we solve the capital formation problem?
This is a good question. So this is where I think it's fundamentally different to those other examples I mentioned, like Linux or MySQL, where you could just release code and it could have community development. You have to have some kind of sustainable, incentivized compute, right? Because the fundamental difference between the models and something like Linux is you are not simply donating time to work on the models. Like they're expensive to create. So someone somewhere has to bring in compute. And this is why I think there's sort of this massive, you know, everything I've talked about until now is just AI. There's no crypto in it, right? But the second you're like, wait, there is no sustainability here unless I can bring on like tens to hundreds of megawatts of compute into the protocol, you must involve incentives. And you must allow people to have ownership of the resulting models. And so, you know, our thesis at Pulse is if you split the model up, it becomes a protocol asset. No one can pull it out of the protocol. If you can do that, you can meter ownership to it. If you can meter ownership, you can do things like, hey, you put in 10% of the flops, you have 10% of ownership of future revenue. And this is what closes the loop here and makes the thing actually sustainable, rather than, you know, we're all just volunteering compute.
Right, so essentially, the model lives in the protocol, which just means that the weights of the model are split among the participants. There's no single owner of the weights, right?
It's a really key property, yeah.
It's key property. And what that allows you to do is it allows you to have a business model based on the inference of that model.
That's right. You get like exclusivity of inference. If you don't have, like, you basically do programmatically what Kimmy just did with a license, you know?
So that's different than an open model. Like, my understanding is you could theoretically create an open model on in a decentralized swarm and sort of give away the weights. That's definitely an option. But the more interesting option is that you build the same business model that OpenAI and Anthropic have, but you have it be kind of collectively owned, publicly owned.
Yeah, I just think it's a matter of realism, you know? Like, okay, we can get this, you know, there have been projects before where just with volunteer compute you had a huge amount. So Folding at Home got a ton of compute, right? And it was just volunteer only. There was no incentives. So you clearly can get a certain way. My view is like, you must incentivize and you must give ownership to make it all the way, to get enough compute to do really big models, which I think is what you have to do, and to like make it not a one-off effort, but you know, there's now this like independent, continual supply chain going on.
Okay, I want to cover like 2 more issues of decentralized training, which people often bring up. You know, as a decentralization investor, I've seen a lot of different networks that are decentralized come up over the years, and a lot of times they don't work as well as centralized alternatives, and sometimes they're even like more expensive. So I'm thinking about like Ethereum, fees when they were cost like $200 to put in a transaction or something. So, some of the questions that people have had about decentralized trading is like, is it cheaper or is it more expensive? And also, is it slower or is it faster than this more traditional type of trading?
Well, definitely for now, or last year there was nothing. Like, it wasn't even working, right? So last year it was forget about cheaper or slower, like non-functional, right? We're now at the point where the run we just did at 8B, there was about a 30% overhead on centralized. Like, that's pretty exceptional, frankly. The fact we're within 30% this quick is pretty nuts. That's just going to keep coming down on like a curve, You have the big immediate improvements. Now there's lots of small things. We're not in a situation where these runs are now significantly more expensive than centralized. It's like we're actually already there.
Okay, and then the last question, I guess, from like a pluralis perspective is, can you talk about like what you've launched recently, which is Agora? What is Agora, and how is it going to kind of help this process?
Yeah, so we did the research which unlocks the possibility. Agora is the rewrite of that distributed training stack I talked about. So you have all of these distributed training libraries like DeepSeek, Torch Titan, Megatron. None of them are multi-party. None of them allow many people to participate. So you have to literally rewrite that whole thing. You also don't have the fundamental communication primitives. You don't have nickel, you don't have glue. So you have to rewrite all these things to be able to do like a multi-party or reduce, right? And Agora is basically all of those primitives plus the distributed training layer. And then we did it with the first model with the Pluralis 8B. So we had, I think it was 300 or so people, big mix of GPUs. We did it only with consumer because we wanted to make the point like, hey, if you have if you went and bought a 5090 to do local inference, you can use it for training, right? We wanted to make it very clear. And yeah, we trained that model with 500 B tokens. We showed the evals. It finished a few weeks ago.
Okay, so in the future, will other people be able to train their models on Agora?
Yes.
Okay. I know we're like running out of time here. Thanks for coming on, Alex, to tell us about Pluralis. I guess just as a last point, what can people here in this room do to learn more about what you guys are doing, and what can they do to participate?
Yeah, so we have the code up on GitHub. It's there for anyone to like poke around with and have a look at. We're going to start to launch some things for like, nano GPT like speedrun type things, right? Where if this is interesting to you and you want to come in and contribute to algorithmic innovation, we're going to do it very openly. We also have the protocol learning workshop is happening at NeurIPS this year. If anyone's going to that, we'll be running that. There'll be a lot of activities and speakers and like sort of academic discussion there if you're on the ML side. And there's just going to be more of these runs. So if you have 5090, RTX 6000, good GPU, like, please join.
Awesome. Thanks, Alex.
Thank you, guys.
Awesome. So now we're getting to the end of the panel. So last panel we have Bailey Wang, founder and CEO of Prismax, Matt White, former CTO of AI at Linux Foundation, Eric Cheng, founder Open Source Campus, and the moderator is Gil Rosen, founding partner at Blockchain Builders Fund. And the topic is about China and open source AI. So let's welcome them to the stage.
Thank you. All right, we're in the last panel of the day. Exciting. All right, let's get the energy up here. This is a topic that is extremely, interesting and that I'm passionate about, and I think these folks here are as well. So why don't we quickly get started and just share kind of what your name and what you're currently working on. Matt, I know that this is a great one for you.
Currently working on, there's like a former beside my name, my title there. So currently working on getting some rest, but for the last 3 years, I've been leading AI at the Linux Foundation, PyTorch Foundation, and kicked off our Agentic AI Foundation. And so embarking on a new chapter now.
And what does it mean to be leading AI at like the Linux Foundation?
Actually, quite like broad. So like 2 years ago, we developed this model openness framework, which was sort of to set the level of like what's open science, what are open models, to try and bring the industry together on a common framework for model releases. And so working on some of these other like tangential projects, out of that came the OpenMDW license, which is the first permissive model license that's specifically designed for open models, to address like the deficiencies in Apache 2.0 and MIT. And then
by open models, you like open weights or like open models, like open source models as well?
Yeah, so
or all of the above?
what we tried to do is classify, because open weights meant like you could have a permissive license or a restrictive license. And so that's kind of like a catch-all for all models that are released with weights. With the model openness framework, we kind of leveled things at the open model. So if it's released on a permissive license, it's an open model. Okay. And this is where, 3 years, 4 years on, we're still like having these like conversations about what does this definition mean. But ultimately, at the end of the day, it's to try to get the labs to be more open about what they're doing, release more verbose research papers, and push people towards open science, which is like, give us everything, right? Like everything from your training data all through to your recipes and all of the sort of complementary code.
Okay, awesome. So the standards for open models in general.
Yeah.
Awesome. Bailey, what about you?
All right, hey everyone, my name is Bailey. I'm the CEO and co-founder of Prisma X. We're a physical AI company focused on providing high quality data embodiments and standards to help advance the state of physical AI. One of the reasons we got started and one of the reasons we're here at a Web3 conference is because I really care about openness in research and openness in robotics. Robotics has traditionally been a space where everything has been built in the open, and there's been a lot of research sharing. And we think by putting it on sort of like decentralized, crowdsourced backbone, we can help keep things that way and keep things going well.
Awesome. And last but not least, Era.
Hi everyone, my name is Era. I'm founder for Open Source Campus. We're a open source foundation, have been incubating a lot of open source companies like News Research, Featherless AI. Matt and I, we actually met about 3 years ago. We're one of the few early open source advocacy in the city. I remember back in the days was like Llama. Llama was the first like open source way we like raising the flag. And fast forward now, we have been working with a lot of the amazing even overseas open source companies like a Mistral, like a Minimax, Kimi, those guys as well. And then last week has been crazy. We helped like Hugging Face co-founder Clem to organize one of the open weights march in response to general open weights push in the United States.
Awesome, amazing. And again, News Research is Hermes for those of you that, which I think has been really holding up the flag in kind of these open harnesses, especially in the wake of OpenClaw getting snagged up, and we'll see what happens there. All right, so recently there's been, I feel like whoa. Don't die. We need more open source.
On the cliff, always.
So I feel like open source and self-sovereign AI are having a heyday right now, basically kind of in response to a lot of the issues around Anthropic specifically, right? So there was the Trump administration initially censored Anthropic, censored Mythos. Then we had Alex Karp of Palantir became an unlikely supporter of against Frontier Labs and I guess of open source, because he was basically saying that all the Frontier Labs are going to steal your data and train it and compete with the companies that they're serving. And Anthropic was actually recommending censorship of open source models, right? And there's a huge outcry there because if you're a company and you want some sort of alternative, now you basically have none if it's censored. Why is open source and open weight so critical for LLMs, for VLMs, for robotic models? Like, what are your views on why we absolutely need to have a rich and ideally diverse, though now it's slightly more Chinese, open model ecosystem? Why don't we start with Era?
Sorry, it's me.
Yeah.
Okay, yeah. I think the first realistic factor this year, actually, I think with a lot of agent workflow loop happening in the space, a lot of company in US has been adopting AI for a while. They're using cloud code or closed source model. The reality is the bills start to hit. We have been having a lot of conversation with the Fortune 500 company in the United States. It's now it's becoming more realistic, even from the CTO office in the CFO office, start to think about what's the cost control. So they have been starting experimenting with a lot of the open source models themselves. In the US, there's only a couple handful. So some of the, like GLM, the blowout really excited a lot of people. However, geopolitically has been very tricky, to access the overseas model. So they are also very actively looking in the space to find an alternative solution. But the second part is I think a lot of the, like you say, not your waste, not your intelligence, right? How those enterprises want to control their own intelligence stack is very critical.
I guess I can speak a little bit from sort of the research and development side, right? Robotics is a very emerging field. There's a lot of unknowns in how these models actually run. And openness is critical there because every generation of open model is the guidance to build the next generation of even better models. Without this, all of the it wouldn't be that $10 billion got invested into robotics. It would be that $10 billion got invested 10 times into 10 robotics companies, each of which spend $1 billion. And that's a heck of a lot less punch than $10 billion aggregating, right? That's been the tradition in robotics, and it was the tradition in early language modeling too. GPT-2, BERT, they were all open, and every generation built on the next. Even though GPT-3 wasn't open weight, the architecture was known, and that was really important because this idea of calibrating the performance against the scale of the model, the type of attention, the context window, was really important in building the next generation of better products. Now, if you go look at I guess there's really only 3 closed models now: Gemini, Claude, and GPT-5. Those guys won't tell you what type of attention they use, how many parameters are, what they do, how they're trained. And this creates a big black box where the industry and the researchers can't really move forwards. The smaller researchers don't have the money to go run a full parameter sweep for $10 billion. They need this kind of guidance to make the small advancement that come together to make the industry better. And I think that's why the latest, Kimi K3 has been super important because it calibrated that a sparse attention model with 3 trillion parameters is probably what Claude Opus 5 is. And that'll enable a lot of building and iteration to build better domain-specific models, et cetera, et cetera.
But this almost seems like, even with the open weights, is that actually open source, right? We don't know exactly what the underlying models are, how it's been trained. So we're kind of just still guessing or building on top of it as much as we want. We're not actually, we don't actually have that same collaboration that you have.
A true open source purist would say it's not open until the data recipe is released, but data costs a lot of money, so it's a bit unfair to make people give away the data for free.
Matt?
Yeah, I agree with Bailey, science compounds, right? So the only reason why we're here is because of the Attention Is All You Need paper, which was open, released as open research. Then we, GPT-2, 3, and the story goes on and on, right? And so the innovations that are happening now out of Chinese models, these are being adopted in different architectures. We see this with Thinking Machine's latest model. And so science compounds, right? This is open science. We call, when you release the data sets and all of the artifacts, that is open science, right? You're full transparency. You've actually created a detailed research paper. You're not writing a fluffy technical report. And so these are all, this is key. But if you're an researcher, this is key. But if you're looking at this from an enterprise perspective, you don't really care. You don't care about that part of it, right? You care about cost and performance. And so this is where, you touch on this, intelligence per dollar, right? How much intelligence am I getting out of this particular model? Or this, family of model backed by a router, whatever the case may be. And in the enterprise, you can realize cost benefits because you have lower inference costs. These models are highly optimized. There is a necessity to optimize, and in Chinese labs, there's a lot of this, optimization engineering is a very strong focus, and not a single model gets released out of China that doesn't have some sort of new, form of attention, or it has some sort of, core architectural differences. And so this is kind of like the stage where we're at, where we have the closed labs. They're very much focused on compute up. Compute up generally results in, pushing costs down to consumers. And at the end of the day, you can get higher adoption rates by reducing the cost of intelligence, make it more democratized, and share access to, more broadly to intelligence.
Yeah, completely agree. I think I'd actually add one more item there, which is like actual national security risk or even risk of censorship, right? So if you're the French government, you don't want to take the risk that if you piss off Trump, all of a sudden you don't have access to intelligence, and that's running your military or running some critical functions of your government. So I think this idea of censorship resistance and sovereignty of your own models is absolutely critical. And then even on top of that, from an enterprise side, there's also, Canva basically got displaced with Claude Design, right? And there's this fear of, are you actually helping Frontier Labs train your competition? So I think even beyond the research side and the cost side, there's actually, as adoption grows, there are huge swaths of these sectors that just can't afford to be dependent on Frontier Labs that could censor them or displace them.
Yeah, the interesting thing about censorship is it's multi-tiered. So there is censorship built into Chinese models because they're legally obligated to do that.
Well, the censorship of the use and the censorship within the model. Yeah.
Right, and then on the API side, it's at the discretion of the organization, the company, Anthropic, OpenAI, to decide, right? And it's not just censorship, it's throttling, it's reducing performance levels, it's deciding whether you can do anything that's related to deep learning or AI research versus, and then you don't have your own
traces, you can't
Yeah, very little transparency, right?
Yeah, so you teed up my next question perfectly, which is there's fears in the US of China-aligned bias and censored models, which I think is so secret that these models are kind of aligned in many ways and do have some censorship within them. There are potential backdoors. Are there true national security concerns? The U.S. has been talking about censoring these Chinese models, U.S. government, and obviously Anthropic and OpenAI are very happy to potentially limit any competition. Curious what your thoughts are against these national security concerns. Can they be mitigated? Will our robots go rogue if we watch Team America or something? So why don't we start with Bailey?
Sure.
And then we'll do Matt.
I guess this concept of national security is an interesting thing because it's a many layered question, right? The original concern was that LLMs that are not aligned with American values would be used to spread disinformation, which would be used influence elections, influence opinions. That's largely passed, and the conclusion has been the internet's full of slop no matter what you do, and the presence of the language models doesn't really change that. Internet's full of lies. It's fine.
Yeah, but if you ask your Kimi model about Xi Jinping and it gives you something that is factually incorrect.
There's the very odd, I asked the model a negative question that goes against the official values of its country. By and large, I think outside of very specific things like what happened in Tiananmen Square in 1989, the Chinese models have been generally found by the community to not be that cranky, surprisingly, at least in English. I don't know how they talk in Chinese, but at least in English. We've even had ones that even say that bad things happened in 1989 at Tiananmen Square now, which is interesting. I think the other concern is this novel one of cybersecurity, which I think is a much more tangible one, right? The internet is not secure. It's full of old software, buggy software. I once saw something about the OpenSSH key was not prime or something, the prime was actually composite. It's full of garbage. And right now, the reason why there aren't huge systematic attacks on, say, smaller e-commerce sites is because the amount of work required to exfiltrate the information is expensive. With these large-scale automated attacks, it's no longer an if and when of, is your e-commerce site going to hack? Your e-commerce site will get hacked if it has security flaws, which will create this one-time fiasco where a bunch of data gets exfiltrated from these insecure, smaller websites. And we have to figure out what to deal with it. if the data being exfiltrated are private information and credit card numbers, who's responsible for the fraud charges? And that's like a complicated problem, which I think people need to be responsible about. But it's not an existential crisis. It's not like the world's going to end because Etsy is getting compromised by AI. It's just super annoying, and MasterCard and Visa are going to say something about
which
it.
can happen regardless, though, right? It just means Americans can't be the ones to do it. It's mostly people outside of America.
It is absolutely ridiculous to ban Americans from using other people's models, because then you're basically saying the Russians can hack us, but we can't use the models to hack them back.
Yeah. Era?
Yeah, frankly, even in the robotics space, have been very spicy. We work with like Dmitriy, a few folks. I'm sure Bailey has experience. The reason like robotic ban in some of even the Chinese company has been crazy, like to the point like we know some that good they cannot even get a visa to like get accepted to it. So like it definitely escalating. But I think like when it comes to like national security, there's like a bilateral, right? Like just like China has been sanctioned in some of the cloud, right? Cannot access cloud. U.S. will of course should have their counteract, right? So that's on the politics side. But I think
But there's a difference there because China can't control how the cloud models are. Like they can't fine tune it further. They can't, right? Whereas if you have an open weight model, there are things you could like. You can actually mitigate that, right? You can remove some of these things.
Yeah, some also people there. We saw like some tweet. There also people find like cloud sometimes actually distill from Chinese model before it's well from Quen. So it's like a recursive loop, right? Like
I mean, cloud distilled from all of our information and the entire internet without compensating.
Yeah, so I think there's all like a relative risk to who basically situation.
Matt.
So, a lot to unpack. Distillation is a scientific method. It is not a form of exploit. If you exploit or violate the terms of use, then you should be banned. That is something entirely different. It's a contract issue. It is not stealing intellectual property from a model that stole intellectual property to begin with. The Chinese models, I assure you, are not being intentionally backdoored and having, especially on the agentic models, like having code in there that's intentionally trying to exploit. What may happen is like agentic collateral damage, which is that if you don't do enough safety testing before you ship a model, and I mince no words, like Chinese labs are not doing very much in that space, and I would say like a lot of labs are not doing a lot on that space, but Anthropic, and I will give you, Anthropic and OpenAI are doing a fair bit of safety research, and that takes time. The Chinese models, they generally want to ship them as fast as possible to reduce that, the frontier backdraft, right? And so they get close to the frontier if they move faster and they ship the model faster. And that means less safety testing. And so like Andrew Yao from Tsinghua, he's a professor there, he runs the AI college, started up this AI security and hub there, and I think it's really important because all labs should be doing safety testing, but that's what's going to reduce that collateral damage, right? Like running a bunch of harnesses or running a bunch of benchmarks to make sure that the model's not going to start going laterally and attacking Hugging Face, right? So but it can happen, and it's not strictly the model; it's generally the harness that is enabling that.
Okay, I guess in some ways maybe it's good that they're distilling from American models, because then they're indirectly getting some of the safety and alignment built in, because Anthropic and
hot take.
So please, if you're not going to do your own safety, then at least copy us so that you have some of that implied. Okay, great. So I want to actually go back to China specifically. Like Matt, you just came back from Shanghai, I believe you were saying. Era, Bailey, I think you guys kind of keep a pulse on what's happening there. I'm not sure when the last time he was there. What is life like there now in terms of proliferation of AI models and the diffusion of AI broadly speaking, right? So if we think about the diffusion of AI in general here in the US, it's been fairly slow overall, right? Is it faster? Does having an open source ecosystem that allows for more people to access these models in a cheaper manner actually enable this diffusion much better? And kind of what are you seeing both, I guess, on the robotics side, where there's an edge on manufacturing, but also just in general in everyday use and adoption within enterprise and consumer use? Why don't we start with Era, then Matt, then
Sure. Yeah. I think like two part, which we find very interesting, the dichotomy basically, right? Like U.S. historically in the capital market has been very like strong in enterprise. So most of a lot of adoption has been enterprise leading, right? Like consumer a bit slow. Where like in China it's the exact opposite, where like consumer market is one of the largest, right? Like all your WeChat or your different app already have like their like application-based AI have behind the scene. You train your own like basic company intelligence, right? Like for example, like Xiaomi, or they have their own. It's a very different like user behavior and market structure.
So like a Siri that works.
Basically, yeah. So basically, whatever like your Facebook have like a Facebook AI like determine all the like application. Application layer has been very strong in the Asia market, where US is very like cogen like workflow, that kind of market condition.
Yeah, I do see a lot of similar use cases between the US and China. There is a subsidized token budget that regular folks can get in China, which is meant to drive adoption. I've seen just as many crappy AI-generated presentations in the US as I've seen in China. The use cases I think are very similar. The chatbot stuff, as well as like the companion type AI stuff that happens, and then another one is so I went to Macau like 2 months ago, did a talk, and then was in Shenzhen for a bit, and at that time it was OpenClaw everything. And so I did like some impromptu talk at the OpenClaw Asia. And then go back a month later and everybody's talking about Hermes Agent, right? Like it's, whatever's fresh and new is and people are like, okay, I gotta go to this. They go to a station where people are getting agents installed and they're removing OpenClaw from their little PC thing, and then they go and get Hermes Agent installed. So there's a lot more experimentation I think going on the agentic side now, and there's a very
in China specifically.
Yeah,
versus
yeah,
the US.
and this concept of a one-person company is like super strong there. Like people want to be their own entrepreneurs. They want to run their own company, just them, have the agents do whatever they need on their behalf. And so they're very, AGI pilled, and like this, one-person company is such a big deal there.
Do you think this potentially mitigates against like tremendous economic displacement, that we have this huge fear in the US that you're going to have these companies that are AI first and they're just going to replace humans with AI, whereas if you're starting from the bottom up kind of consumer angle first and enabling the individuals, now you don't necessarily need to displace them because actually they're each more productive on their own.
Yeah, I think the tech market is very interesting, right? Because like in US, you have YC Combinator, you have like a startup culture is such a huge thing, right? In China, it's very, the big four in China, they pretty much predominate. So the startup culture is not as strong like compared to US. Okay. That's why I feel like for the individual, you have a chance to do your own startup. Not even have to be a startup, like an entity. Like it's an appealing concept for them.
Really?
I think one interesting difference is the general broad social acceptance of AI in China is very strong. Like ever since the early computer vision days, this idea of smart devices, AI, like just adopting technological change is a positive thing in China. And by far, everything from the government to the regular people have accepted the fact that AI will bring about positive change in the country universally. Whereas here, we have a huge population that says we don't want AI because it will bring change and we won't benefit from it. Part of this, I think, has to do with the storytelling. The US tech industry has somehow become the most hated industry in the world in the past 10 years. And some tech founders like Darrell and Sam Altman have become like there were war criminals that have bigger followings than Darrell Amadei does right now. So we sort of shot ourselves in the foot. Right? You go look at DeepSeek. He's this eccentric, smart guy who beat the Americans, super clever, started his own hedge fund, used that money, train a model. It's a great story. Whereas here you go look at Darrell and it's billionaire CEO dissatisfied with the thought of corruption tries to tamper with the government in order to remove that competition. It's not good storytelling here, and I don't really understand how the US-based AI CEOs have managed to so badly botch the narrative, because it is a nice thing, right? Not having to make your own spreadsheets or do this drudge work is an awesome thing, and the guys in China are embracing this to start their own businesses, learn new skills more quickly, as they say in WeChat, give it to the lobster.
Maybe it's Silicon Valley is a little bit of an echo chamber, and we don't really listen to anyone else. Just look at the signs on the 405.
Yeah.
All right, last question here. fast forward, we're 2 years out, right? Not 10 years, but 2 years out. What does open source or open model, open weight models look like? What does the diffusion of AI look like? How is AI and physical AI incorporated in our lives? Do we each have digital twins? Do we have robots? Has AI broken the world? Curious what your thoughts are. Matt, why don't we start with you?
We're all living in the metaverse. 2 years from now.
You get to give Mark Zuckerberg all this money?
Well, if we have extra compute, then we can use it to run the metaverse, right? So I think open models persist. I would love to see greater global competition. The only way that we move the dial towards AGI, whatever that means, is to continue to all work in that effort, right? So I think we'll see a lot more open models. I don't, if you subscribe to the idea of like China versus US, there's a very good chance that Chinese models overall are going to be at the frontier, and we may be playing catch up. Unless some things change here in terms of our ecosystem and in terms of labs that are well-funded and access to compute to be able to train.
Maybe then we open source our models so that we can all collaborate to beat China.
There you go.
Bailey?
I think there's going to be increasing commoditization of compute and frontier models across all spaces, right? Certainly in robotics, that's what we count on, that a lot of things will become commodities and much more accessible. But I think it's largely true. Right now, there's a big NVIDIA bubble, which is causing NVIDIA's margins to reach all-time highs. They're like not 3x, not 10x, they're like 20x right now. And I think that's causing a sort of push-down effect on the industry, where unless you're very wealthy, it's difficult to compete in the foundation modeling space. But the NVIDIA, the CUDA hegemony is not going to last forever. Eventually, there will be a functioning other accelerator, possibly from AMD, but looking, who knows. And I think that's going to have an important washdown effect on the rest of the industry, because once you have access to compute, a lot of the nasty capex that goes into building a foundation model goes away. It'll feel a lot more like software, where anyone can go and play and dream, right? But AI feels like hardware right now, where you buy this manufacturing plant, design the model, then go manufacture the model weights and hope it sells. Getting AI to look a lot more like software is going to be really helpful in sort of broadening the landscape and getting us more competition.
So we just need more data centers in space.
We really need lower NVIDIA margins, but that's something that NVIDIA would really like you to not have.
Era?
Yeah.
Why don't you close this out?
For sure. I think one idea we have been advocating for the past 3 years called edge intelligence. Basically, to borrow a book from a lot of the digital asset conversation, how you have your own sovereignty of your intelligence. About 3 years ago, that's mainly the early inks of open source model on your own intelligence stack. You have people like a tiny box of Sky, have your own chip basically. Fast forward now, I think this actually becoming a bigger narrative story. So the whole tiny team, super entity become can you own your own intelligence and your own company entire full stack. For company, can you do your on-prem AI, right? You find your own model. So the edge intelligence is something we are excited, and I think in the next 2 years, the story will play out.
I like it. All of the intelligence is with us. And that's kind of the thesis that we've got as well around self-sovereign AI. So guys, thank you. This was a ton of fun.
Yep,
you were much less doom and gloom than I might have expected. So we're leaving here on a high note.
Yeah.
Excellent. Thank you, go. Yeah.
And that's a wrap. Stephen Kuhn, thoughts?
On the spot. What a day. Thanks for sticking it out to the end. This is my favorite day of the year. So thanks for sharing it with us.
Yeah, thank you for coming. I think a lot of people said they were not expecting this. So it's a lot of good conversation, high quality conversation, good turnout, good speaker here. So really glad. In the morning I have finance, and afternoon more AI. So definitely feel like the future of crypto and blockchain. It's coming together.
Yeah, it's a good future. I mean, we breathe life into this, right? So you can see everyone that's excited about the adoption of these technologies, and we're stoked.
Excellent. Well, let's call it there.
Thank
you,
you,
everyone.